In a previous video, I shared a 4-hour segment from my crypto investing course, and this video on my channel got a lot of views, and it received a lot of positive feedback from everybody who watched it. And this video course I've previously sold for $1,500, but today I've decided to give you another 5-hour segment from the course completely for free in this video. Now, this video course explains what I believe to be the #1 strategy to be making money from the crypto market. It's also the strategy that I've been following that's made me millions of dollars since I got into crypto in 2017. Now, to re-emphasize for you why this strategy is so lucrative, #1, it's beginner friendly. So it's very simple to follow for new investors. You don't need to be an expert. There's a low skill barrier. Like I said, you don't need years of experience. You don't need to be an expert at macro. You can follow this strategy with limited experience. There's a very low time commitment. So this is a hands-off strategy. We're not going to be day trading, flipping meme coins in the trenches. It's a more hands-off strategy that could take you maybe 5-10 hours a week. And it's also scalable. So if you have $1,000 or if you have millions of dollars, this strategy has the potential to make you money from any of these different capital sizes. Now, to summarize what this strategy is that you're going to be learning in this video, it's basically long-term investing into new altcoins that have 10 to 100x potential, not guaranteed, but potential. Researching projects, basically following my 14-step fundamental analysis checklist to determine if a project is worth buying or not. And also how to buy these coins during market capitulation so that you're entering when the upside is the most asymmetric, and then how to exit these positions when the thesis plays out. So in total, between the 2 YouTube videos, the previous one and this one, it's about 9 hours from the video course. The total course is about 30 hours long. So there's still a lot that you haven't watched if you watch this video, but I'm actually going to be giving away this course completely for free. If you would like to get free access to the entire course, there's a link in the description below. A quick disclaimer before we actually get started on the rest of the video with the whole course. The first thing is I want you to watch attentively and take notes. This is a 5-hour video. This is not the type of video that you click on, watch 5 minutes of, and then disappear. This is a very long video with an insane amount of alpha and knowledge that you're going to be learning in this video. And you also have to understand, if you're watching this video relatively closely to when I've posted it, you're watching this video when the market sucks. Crypto's dying, there's not many people making money, but this is the perfect time to be learning a new strategy that has worked for me to make me life-changing wealth, and it could work for you to also help you make a lot of money as well. Now is the time to be learning, because back in 2019, when crypto was also really bad, and back in 2022, when crypto was also really bad, I was learning. I was spending 4, 5, 6 hours every single day reading into the market and trying to learn how to make money from crypto. If you're not doing the same, you're not going to be ready for the next bull run. And this course is going to help you get set up for what is to come, which is the next bull run in the future. So get out a pen and paper, start taking notes, and watch very closely as we are about to start the course. This video is also not financial advice. All I am doing in this video is simply sharing my own personal experience, what I have done, and it's worked for me. It doesn't mean it's going to work for you. Doesn't mean you should follow it. You should just take it as educational information only. And also, this course might seem a little bit jumbled, where you've watched an hour of it and you haven't actually got into the actual strategy. But just understand that all these different components that make up the course, like market psychology, the tax and banking infrastructure, the specifics of the strategy, how to do fundamental analysis, all these different things which might not be the strategy, they're all just different pieces of a jigsaw puzzle. And the idea is that you put them all together and then you'll have the full picture by the time you've gone through the entire course. So that's everything I wanted to say. Let's get straight into the course. Lipstick on a pig. This is another section of the mindset course, which is really important. And basically what I need you to understand in this section, to summarize it all in one sentence, is that 90% of crypto is just this. It's a pig, which is gross and fat and disgusting, and you would never want to touch it. But they put lipstick on it. They put a little bit of lipstick on it, and then you go, oh, wow, this is the future of finance. Oh my God, I can make risk-free money here. Wow. You know, I really need to be getting into this. This is going to make me financially free. No, most of the shit that you think is just going to make you all this money is just a total scam. And I want to get into the mindset that you need to be able to avoid scams, to be able to avoid rug pulls, and, you know, save you tons of money from all the shit that you don't have to lose money on. Because there's a lot of scams in crypto. And honestly, some of the scams I'm going to break down later in the course, you're going to go, oh my God, I didn't realize that was a scam. Thank God I watched this and now I understand it. Because the problem that the biggest reason that people get scammed is they just don't understand the context of what's going on. They don't know how the money is being made. The biggest thing is just you don't know who the money is being made from and why. So yeah, lipstick on a pig, this is 90% of crypto. And I want to teach you basically in this video the different mindsets that you need to implement in order to avoid being scammed. And I think later on, we'll go into what exactly these scams are and into depth on why they're scams. And here's like a little bit of an overview of what the scams are, just in case you're interested. This is what we'll cover later in the course. Trading bots and dollar cost average bots, they're scams. High yield farms. So if you like lend your money in crypto in a high yield farm, it's pretty much a scam. Prop firms, this is not really crypto related, but it is related to markets. We'll cover that as well. And yeah, but basically this is the mindset that you need for not being scammed. First things first, assume everything is a scam off the bat. Because 90% of crypto is a scam, you're better to assume that the thing that you've just found is a scam than that it isn't, right? Imagine you're trying to find a wife and 9 out of 10 girls you speak to would divorce you and destroy your life, and 1 out of 10 wouldn't, right? You would probably be safe to be assuming that every girl you spoke to was dangerous and that you need to see that she's good first before you put a ring on her finger. So that's sort of the mindset. You need to just at least be, it doesn't mean you have to avoid it completely, but just have the mindset that it's very likely that the thing you've just found, which you think is going to make you money, is probably going to turn out to be a scam 9 times out of 10. Because that's the truth about crypto. Now, if you don't understand who you're taking money from, it's probably money getting stolen. It's probably your money getting stolen, right? So this was really apparent in the whole yield farming craze of 2020, right? You'd go to some yield farming app and it would say, deposit your money and make 20% a month. And you'd go, whoa, I can make 20% a month. I don't need to buy coins anymore. I can just make a free 20% a month on my money. But the thing is, you deposit money without understanding who you're taking money from. Because I don't know if you've seen this part of the course yet, because this part of the course is really important, the one I'm about to refer to. Markets is zero sum. So if you make money, you took it from someone else. So if you find something that says make 20% a month, and you make 20% a month, you just took 20% of someone's money every single month for your ability to make that money. So you have to ask the question, if I am able to make 20% in the month of December, who lost 20%? Who am I taking the money from? And if you can't answer that question, it's probably your money getting stolen, right? And we'll go into how exactly your money gets stolen in these high yield farming operations later on in the course. But that's another important mindset you need to remember. Number 3, if it sounds too good to be true, it probably is. So ever since I was 18 or 17, whatever, I really wanted to make heaps of money. And I found a lot of things that I thought were going to make me money along the way. And I got myself into a lot of situations where I got excited and I thought I was finally going to get rich, and it never paid off. And I just got pissed off. It happened like at least 5 times in a row. I thought I found the thing that was going to make me rich, and it just didn't work out. And it took me a lot of times of this like false hope and naivety to eventually figure out, what is an actual genuine opportunity that can make me money and what is a scam. And it takes time to develop that pattern recognition. So the general principle you need to understand now is just, if the thing sounds too good to be true, it probably is. Because making money is a competition, because none of us make money, we only take money. So if we're all taking each other's money, if there was an opportunity that was really easy to make money, wouldn't everyone else be trying to make it as well? So you have to understand that making money is almost always a fair playing field in every single money-making sector. Sometimes crypto goes into a bull run and it becomes really easy to make money, but eventually that gets priced in. It's never always an easy money opportunity. It's just something that happens temporarily. So if you find something where it's like, oh yeah, for the next 5 years, this is going to be a crazy opportunity. It's going to be easy money. It probably won't. It probably will just be good for a month or two, and then everyone tells their friends about it, everyone does it, and then the opportunity's gone. It's like inefficiency, right? When there's inefficiencies in like sort of certain financial marketplaces, they get filled because people tell their friends, hey, look, I just made 100K, come try to make 100K. Their friend comes in, and then their friend tells their friend, who tells their friend. Eventually, you get everyone trying to compete for the same easy money, and it's not easy anymore because now there's competition. Next point, you need to develop a bullshit detector. The only way you can really do this, though, is through first-hand experience. So honestly, I think you can't avoid getting rugged in crypto. I think you have to get rugged a few times to learn how not to get rugged. And when I say rugged, what I mean is, let's say the founders sell all their tokens and just leave the project. That would be what's called like a rug pull. They like pulled the rug from under you, you fall into the trap, you're dead. That's what the metaphor is about. So the only way you can learn to spot a rug pull or learn to spot a scam is to basically get scammed or to get rug pulled, unfortunately. So if this is your first market cycle and you found some sort of lucrative opportunities, you know, too good to be true opportunities, maybe they are good, maybe they're bad, but you should probably not put too much money into them, at least for the first few times, because if you do get scammed, well, you didn't put too much in, but you just learned a valuable lesson. So yeah, you lost $1,000, but you just learned how to avoid scams for the rest of your life. So it's a trade-off. You just took $1,000 course on how to avoid scams, and the course fee went into you losing money on the scam, right? It's like a course. You go to university, you pay $40K for a degree, you know, you just lost 40 grand to learn how to, you know, to learn things. Well, in crypto, you pay your tuition to the market in your first market cycle, right? In crypto, you generally don't make money for the first 3 years because you don't know what you're doing. It takes you a few years to get to get up onto your feet and walking around and running. Next point, if money yields 5% a year and someone offers 10% returns or more, ask yourself, why would they take my money and not someone else's? So let me explain this a bit simpler. If you are holding $100,000 in your bank account and you're asking yourself, you know, like, how do I grow this money? One option is you can, in the US at least, you can lend your money to other people who borrow it from you, and you can collect a 5% return. At least right at the moment, it's around 5%, right? 5%, almost risk-free. So basically, you make a zero-risk 5% return. So what they call it is the risk-free rate. The risk-free rate of the markets right now in the US is around 5%. Let's Google this. Risk-free rate, United States. I think it's around 5%. The 10-year treasury rate is 4.47%. So you can see it's almost 5%. 10-year risk-free rate is 4.42%. So you can make every year 4% returns without risk, because now there's always risk with everything, but it's sort of like it's like a, I guess you call it like societal collapse risk, essentially. But anyway, that's another topic. So if the risk-free rate is 5% a year, this is what people get for lending money. Why can you deposit your money into a yield farming operation, for example, and make 10% returns a month? Because if you could make 10% returns a month with low risk, wouldn't everyone put their money in it? And then if everyone puts their money in the thing making them 10% a month, wouldn't the yield go down to the risk-free rate? Wouldn't it go down towards the benchmark rate? Because remember, any money that you make has some sort of risk associated with making it. And the more money that you aim for to make, the more risk there is, right? The reason why the stock market doesn't make you as much money as the crypto market is because the stock market doesn't have every coin drop 90% every 4 years. The risk and the reward is sort of like an even distribution. Crypto, more volatile, means it goes up more and down more. Stocks, less volatile. It goes down less and up less. When you lend your money and you can get 10% a month, what is the extra risk that you're taking for that extra reward? Because remember, more reward equals more risk. You never are going to find an opportunity where it is low risk and super high reward, because those opportunities get found by every other person, and that opportunity gets what's called priced in, right? Let me give you an example of how something gets priced in, okay? So let's say there's a yield farm, right? You deposit money, they lend money. For you to have your money lent, there must be a borrower. So let's say there is 100 million in dollars wanting to borrow. That means $100 million can be deposited to be lent, right? If you are lending $100 million, that means someone borrowed $100 million. For every dollar that is lent, there is a dollar that is borrowed. So let's say this yield farm is paying out 20% per month, right? there's some super lucrative yield farming operation and they're giving you 20% a month. For you to make 20% a month, someone is losing 20% a month. So if you make 20% a month, right, like here, you make 20% a month, that means this person here is losing 20% a month, right? For you to make 20% a month, this guy has to lose 20% a month, right? You lend your money and the person who's borrowing from you pays you money. That's how it works. You give a friend $10, you tell them you have to give me 15, the friend gives you back 15. The friend paid you a 50% yield. If this person here who's borrowing money from you can go to the United States, right? Risk-free rate, and they can borrow money here for 5% a year, right? Why would they pay you 20%? Why would they pay 4 times more to borrow money if they could just go to the United States and borrow for 5%? Well, the reason is because there is inherent risk underlying the fact that they are lending you this money. So what are the risks here that you face as a lender that you don't face if you lend your money for 5% to the United States? Well, let's list the risks. Smart contract risk, third-party risk, liquidity pool draining, and the stablecoin going to zero. Founders rug pull, right? These are the risks that you take on when you lend your money for 20% returns, right? So yeah, you can actually make higher returns lending in crypto, but there is risks that they won't explain to you that most people ignore. So you deposit your money, you get a 20% a month return or whatever. Well, what happens when the code behind the operation breaks? You know, did they code it properly? Because sometimes they don't. Third party risk. What happens if something with the founders leave the project and then they take everyone's money somehow, right? The third party somehow fucks you over. Liquidity pool draining. This is a complicated one, but generally when you lend money in crypto, it's one way is through liquidity pools, right? I don't want to really get into this one, but basically like the liquidity pool can get drained, which means that you have no way to get your money back. Stablecoin going to zero. If you lend USDT, what happens if USDT crashes and goes to zero, right? So there's a lot of risks associated with this operation that they won't tell you. And it's not necessarily a scam in this example, but it is lipstick on a pig, right? They make it seem like it's this amazing thing, but it's not. You took more risk, and that's why you get more reward. And the way I like to view these sort of setups is you earn, let's say it's 30% a year. You earn 30% per year and risk losing all your money. So the risk to reward setup is 3 to 10, right? You risk 100% of your money to make 30%. In markets, in crypto especially, you want to chase asymmetric returns. You risk 50% to make 1,000%, right? That's a 20 to 1 risk to reward. That's the setup that you want, 20 to 1. You want 20% upside for every 1 risk, right? Risk to reward. But when you do farming, you risk all your money to make 30%. Because if any of these problems happen that we just listed out, smart contract risk, liquidity pool draining, your money goes to zero. So you lose everything just to make 30%. It's not worth it in my opinion, right? So let's get back to the talking points. That was a little bit of a ramble, but I think you guys will find that useful. Let's rehash that point. So if you make 5% a year and someone offers you a 10% return or more, why would they take my money and not someone else's? That's sort of a separate point. But anyway, the point here to summarize it is, if the risk-free rate is 5% and someone's giving you more than that, the reason they're giving you more than that is because there is other inherent risks which you probably don't even know exist, or you probably are ignoring. And you need to understand what these risks are so that you can weigh up what is the risk, what is the return. And the goal is that you want to find asymmetric risk to reward setups. So the only legit too good to be true investments come from networking plays where you have an edge over everyone else. So you have to consider this, right? If the baseline amount of money you can make without risk is 5% a year, and someone is offering you 20% a month returns, on, let's say, like a sports betting operation or a trading bot or a yield farm, every single person on the planet would take this setup if it didn't have much risk. How many millionaires are there in the world? There is 60 million millionaires in the world in 2022, so there's probably more. 60 million millionaires. Every single person who's a millionaire has money that they need to put somewhere to try to grow it, right? And so if there's an opportunity that exists where they say, we can make you 20% a month returns with low risk, 60 million millionaires would put at least $50,000 into that. Now, let's say 60 million times 50,000, right? How much money is that? $3 trillion would be going into an opportunity that could make 20% returns monthly with low risk, right? So why you, some random person on the internet, some broke person, why would they take your money to give you a low risk 20% monthly return when there is 60 million millionaires who have more value than you because they're a millionaire? They might have businesses that they run. They might have a network that this person might want to get access to. Or maybe they're a friend of the person making the business, and the guy who runs the business that gets 20% returns, maybe he wants to only make his friends rich, right? Why would they take your money when you're some random fucking person and not someone else's? You're at the bottom of the totem pole. Why do they care about your money? Well, the reason is because it's not a good opportunity. It's too good to be true. Now, there is some examples where my friends are making 20% monthly returns or whatever with a low amount of risk. But the reason they got this opportunity was, in this example here, making 20% a month with sports betting, and he doesn't do anything, is because he is directly connected to the guy who runs the operation. And the reason the guy takes his money on and not someone else's is because they're friends and they're in the same network. And the guy who runs the business gets value from the guy who invests, my friend, because he has an insane network of all of the major influencers around the world. He's worth multiple millions of dollars at 23. And he runs many big businesses in Australia related to marketing agencies. He's got connections to modeling agencies, etc. So he's got a lot of value. So why would you, some random person on the internet with zero value, have your money get taken by this operation when that operation could just take money from people who actually provide genuine value? That is why the only legit too good to be true investments will come from networking. So if you didn't have to network and really have to like work hard to get access to an opportunity like this, then it's probably a scam. Let me give you an example of like one of these scams. Okay, so here's an example of a bot, right? This one's called, this revolutionary NFT trading bot offers up to 15% monthly stablecoin returns with a proven track record. Basically, you buy the NFT, they make an average monthly return of 9 to 12%. So this is just a scam. This is just a classic version of this pig right here. This is just this pig. It's a auto trading business that doesn't make money, but they've turned into an NFT project to basically scam you, right? So this is the sort of shit you need to look out for. Another mindset hack, you need to understand that your favorite coin isn't going to change the world. It's just a marketing spin to convince you to never sell, because every single project's goal is to basically make you buy and make you never sell. Because if you never sell, you are the best possible outcome for this project. Because if you never sell, then they can sell and they make all the money, right? Because once the project's out, once they've sold out their positions, they don't really care, because then it's only you that's in. If they don't hold any of the coins, they've sold them all, then it's only you. If they've sold 10 million of coins, they're all rich. They're rich now. Doesn't matter what happens after that. So their goal is to convince you to buy, hold, and let them dump on you, and then you can go and sell later when it's worth zero, right? And always remember, everyone's first priority is making $20 million, so their parents are retired, kids have generational wealth, and they can have total freedom. Every single person on the planet wants to be rich. You have to assume altruism with anyone in crypto, right? None of these people in crypto come here to make you rich, really. Like, obviously they would like to see everyone wealthy, but generally in crypto, for 90% of the projects and things that people build, their wealth comes at the expense of yours. They got wealthy because they took your money. So when, these people, they launch these projects, they say, we're all going to get rich together, we're going to make a big project, we're going to take over crypto. They got rich at the expense of you getting poor. That's what always happens, because it's zero sum. They make every money that someone makes, every dollar that you make, you took from someone else. So you need to understand that everyone's top priority in crypto, they're all here to make money. You need to remember this. So whenever you find a project that's like 20% yields or whatever it is, and it sounds too good to be true, you just have to remember this. They're trying to get rich. So how are they making money off of you joining? And last but not least, crypto is still the Wild West 6 years after I originally joined. I remember when I got into crypto in like 2017, all the videos on YouTube were like, yeah, it's the Wild West. It's crazy. Be careful. Nothing's changed. It's still just the same. It's just as sketchy now. And none of the concepts with any of these projects are proven. Like, we're all trying to invent the future of finance in real time and hope none of it blows up. Like, we're basically creating the railway while the train's speeding across it at like 30 miles an hour. We're like placing down the tracks as it drives. That's what we're doing with crypto. None of this shit's proven, yet we're building billions of dollars of financial infrastructure onto a track that hasn't even really been tested and built yet. You know, and most of these projects, they're just rehashed scams with lipstick to make you think they're changing the world. Like that project that I showed you, the NFT trading bot, that trading bot has been a thing that scams people for 10, 20 years now. Like, the bots were around 10 years ago, and they're all just rehashed into new markets. So back then it was a Forex trading bot 10 years ago. Now it's an NFT trading bot. Soon it's going to be a friend tech trading bot. Soon it's going to be another different trading bot. It's just like repackaged scams. So yeah, this is the mindset you need to have. You need to understand that 90% of crypto is lipstick on a pig, and you need to be really, really careful that you're not getting yourself involved with one of these. All right, so let's talk about in this video how to capture outsized returns. So in crypto, obviously everyone ends up making a little bit of money. Most don't end up keeping it, but most at least make money. So what I want to talk about and show you in this video is how you can not just make money, not just keep the money that you make, but outperform the market and make outsized returns where your portfolio is going up 10, 20, 30, 50, 100x from your entries. Now, if you're watching this and you just want to do a 2, 3x, you're not looking to outperform and make outsized returns, you don't actually need to implement this advice. This advice is for people who want to extract the maximum amount of profit and the people who want to be told what mindset in order to do this. And this is the mindset and the different things you need to consider when trying to capture those outsized returns, okay? So here's some guidelines to outperform the market. If you found the coin that you want to buy from Twitter, you've already fucked up, because any coin that you're seeing shilled by big accounts on Twitter has already had a large portion of its upside priced in. So I always reference Toshi as an exemplar of a coin that I've made money on and I've done well on, because it's just a really good case study, and it's the most recent case study as of when I'm filming this video. I'm sure there will be better case studies in the future, but they haven't happened yet. Toshi's the one that's happening right now, you know, December 10, 11. So Toshi, when I came up with the thesis, so you can see here, number one coin to 100x is bull run. This whole thesis that I made on Toshi, no one was really talking about online. It was just me. No one really cared. And now, today, Toshi, it hit $45 million market cap at its peak. And I had a look at the cash tag for Toshi. I think it's cash tag. And you can see all these big accounts tweeting about it. So 34K, bunch of likes, me tweeting about it, this guy tweeting about it. You can see a bunch of accounts with followers. And also, there was another guy who tweeted about it. Yeah. He said, put my cock in the tushy and she wah wah when we bonk. So, like, this guy is like the face of Solana, right? 150K followers. All these dudes on fucking Twitter starting to talk about Toshi as it's at a $35 million market cap. So if you found a coin when it's talked about everywhere on Twitter, then the upside's massively priced in. I bought it at 2 million market cap when no one was talking about it. And now you hear about it on Twitter and it's up 16x, right? And if everyone on Twitter is talking about a coin, this coin is about to give standardized returns or no returns at all. So when I buy a coin, I hope that no one's talking about it. And when everyone starts talking about the coin that I buy, I get skeptical. So for example, I bought Solana. I doubled my position like 3 months ago. It's up 3.5x roughly, right? Bought it at $20. It's now 72 or something. So at the time, no one was, a little bit of people talking about Twitter, but nothing crazy. Now everyone's talking about Solana. It's all they can talk about. And I'm a little bit concerned, like, okay, well, a lot of the upside's now priced in because everyone's talking about this coin. Same thing with Toshi. Okay? Because when you think about it, right, there's a bird shitting hierarchy in terms of information that gets put around on the internet that can make you money. And the earlier you are, the higher you are in the hierarchy of receiving information that makes money and in understanding narratives, the more money that you make, right? The earlier that you get in. So inner circle groups of crypto OGs was what I was in. Me and some other high level people talking about Toshi. And I came up with a thesis, I ran it by them, and they were like, yeah, this is solid. And they gave me some extra points. So we accumulated inside of the inner circle. And obviously the paid group, my mastermind, I was telling everyone, I sent the video that I filmed, guys, let's buy Toshi, let's get in. And these guys in my mastermind all bought Toshi at a $2 million market cap. Now I start, after it doubles in price, I start talking about it on Twitter. And I start, shilling it. $5 million market cap, $10 million market cap. Obviously it's still early, but it's not as early as what we got. And so I bought it at 2 million market cap. It went to 40, that's a 20x. You buy it at a $10 million market cap, it goes to 40 million, that's only a 4x. So the difference between being early and being later is actually a huge multiple on your money, right? A 4x on $1,000 means 4,000. A 20x on 1,000 means 20,000. You make like 5 times less money by being late. And as well, at the bottom is like YouTube and Facebook groups and stuff. And these guys are our exit liquidity. So our performance comes from buying something that nobody or limited amounts of people know about. The period of outperformance comes from one person knowing about it to 100 people knowing about it. And when I say knowing about it, I don't even mean knowing about the coin. I mean knowing about the thesis, the idea behind the original reason you bought something. So when I bought Toshi, I showed you the video. The whole thesis was Coinbase is going to be the retail chain of this bull run. They're going to send all the users there. Toshi's the face of base. It's named after Brian Armstrong's cat. It's down 90%, blah, blah, blah. Now everyone's talking about the thesis that I came up with, or at least I built the level of depth that the thesis had, and no one else had spoken about it to that depth. And it's being talked about everywhere on Twitter, and now the market cap's like fucking 40 million. That is what happens when you find something early and you ride the coin up from being something that no one talks about to everyone talking about. And that's how you capture outsized returns. Now let's go to the next one. Outsized returns come from where you don't expect. So when you buy a coin and you already know exactly why you're buying it because everyone's saying that this is what's going to play out, that's not where outsized returns come from. It comes from when, generally speaking, things that you had no idea about or that most people have no idea about, right? Bitcoin ETF. Everyone knows about the ETF. You're not going to get outsized returns. You're going to get a standard 2-3x on Bitcoin, but you're not going to get an outsized return because everyone's already talking about it. And here's a quote for you. The thing I find most interesting about investing is how paradoxical it is. How often the things that seem most obvious on which everyone agrees turn out not to be true. That's what we just talked about. Everyone talking about Toshi. It's the next big thing. Makes me think this thing's going down 80%. Makes me think that the top is near. That we're going to enter a period of standardized or zero performance going forward for a bit, and then outperformance later on. So this is just how investing works. The safer, more comfy you feel in the position, the less upside the coin has. So when you buy something, it has to be extremely painful. If an investment makes sense and feels safe, you're late. When I bought Toshi, it felt good from an intuitive standpoint. My subconscious recognized that it was a good investment, but it felt terrible from a instinctual standpoint because it had gone down 90%. The chart looked terrible, and I was, no one else saw what I saw, so I was a little bit concerned. Maybe I'm not right. Maybe I'm wrong. So that was the best time to buy, right? Because I wasn't comfortable, but my intuition was speaking to me. When your intuition is confident, but your instincts and emotions are not, that's a perfect setup for a coin that has asymmetric upside to give you outsized returns, right? So whenever you buy something, what you need to keep in mind is, did this feel good? Did this feel terrible? What did it feel like when you bought? And whatever your answer is going to tell you how much you're going to under or overperform the benchmark return in your market, in your industry. If it felt terrible and it turns out your thesis for buying was correct, you're going to make a fuck ton of money. Now, in crypto, to make outsized returns, another guideline is you want to be either smart, early, or cheat. Now, I don't recommend cheating, but you pretty much want to be smart or early. The people who made the most money in crypto were just simply early. Look at all the idiots who bought SHIB before it went 1000x. I've spoken to a guy who once had 2% of the supply of SHIB, and at one point he sold it too early, but at one point it was worth like $400 million. If he had held, he didn't have to be smart, he just had to be early, right? Because it went up that much. If he just bought and held, he would have been worth $400 million at the peak. So you want to be smart, you want to be early. Generally, early is the best because a lot of smart people actually don't even end up making money. Now, next up, your best investments will be the hardest to buy in the moment and hardest to sell in the moment. And Warren Buffett said, what the wise do in the beginning, fools do in the end. When I bought Toshi at $2.5 million market cap, no one else was really interested in buying. No one really understood the thesis, but I did. And what the wise do, me, in the beginning, the fools do in the end. So everyone's buying Toshi now at a $40 million market cap. The fools are buying it now, right? The smart people buy it in the beginning. So when you buy something, again, consider how hard it was to buy. When you sell something, consider how hard it was to sell. Give it a rating out of 10. How painful was this? If it's less than an 8, then you aren't buying when the upside is massively asymmetric. Now, 10% of your decisions will bring you 90% of your profits. And there's a famous sort of tweet on Twitter. I couldn't find who originally tweeted it, but I found the content of the tweet itself. And it's obviously about trading, but it relates a lot to investing. So I'm going to read it out. In discretionary trading, the right position is almost always flat. The right action is almost always to do nothing. A few times a year, there's free money on the floor. Pick it up, then do nothing. Outperformance. This relates a lot to investing and making outsized returns. Basically, from an investing standpoint, what he's trying to say is this. In investing, the right thing to do is almost always nothing. You wait for the price to go down. You buy when it's asymmetric, and you hold until your thesis is played out. Maybe once a year or once every 2 years, you sell and you do nothing in between, and that's outperformance, right? Wait, do nothing, buy low, hold, sell high, done. Outperformance. Okay, that's what it looks like, because 10% of your decisions are going to bring you 90% of your profits. So many people do so many different things in the bull run, buying this, selling this, swapping this, blah, blah, blah. But there's only 10% of your decisions are going to make you 90% of your money. It was that time that you bought Toshi at 2 million when it really hurt that made you majority of the gains. It was the time you doubled your Solana position before it went 3.5x that made you most of your money. And then I did, all these little decisions in between, and I end up not really making much. And last but not least here, outperformance is not a coin, it's a moment in time, as every coin has periods of outperformance or underperformance. This is an important one to understand because I think I covered this in the course. It's not about the coin, it's about the process. And this also relates back to obviously capturing outsized returns, which is what this video is about. If you buy a really great coin, but you buy it at a time when all of these things were incorrect. So let's say, it was easy to buy. You weren't early. You weren't smart. You were late. It felt comfortable. You expect it to make you money. Everyone on Twitter is talking about it. And you found it from Twitter, right? Imagine you had all those variables met. It doesn't matter what the coin is. Any coin with that setup is going to lose you money or make you barely anything. So you can make tons of money on any coin if you're able to recognize when it is a very painful moment to buy. And if you can pick those moments with these coins, then you're going to get really great entries and you're going to outperform the market. And that isn't about the coin, it's about the process, like I talk about in one of the other sections of this course. Now, I think that's pretty much everything for this section. I just want to summarize it briefly. So if you want to outperform the market, you have to find coins that Twitter isn't talking about, not buy things because everyone wants to buy them on Twitter. You have to buy when it really hurts and when it's not comfortable. You need to buy when it's either a very smart investment, an early investment, or cheating, which I don't recommend. You need to buy coins that are hard to buy. So if it's something on Binance, it's probably already mostly priced in. The outperformance comes from buying something which is really hard to buy as it goes to a coin that's really easy to buy. Similar to what I said earlier, where it's a coin that no one knows about or no one believes in to a coin that everyone believes in is a good investment, right? Imagine you have a thesis which 0.1% of the market agrees with, and then a year later, 80% of the market agrees with you. That movement from no one getting you or believing in you to everyone believing in you is what creates the outperformance, right? So with Solana, for example, everyone was hating on Solana at like $8 at the bottom because it's like a dead chain and all this shit. And because everyone believed it was dead, only 1% of people believed it was alive and going to come back. Now, 95% of crypto believes that Solana is going to win and it's going to come back. So that movement from 1% believing to 95% believing is what has led to Solana outperforming massively and doing really well. So that's a bit of a summary. This is how you capture outsized returns. All right, guys. So in today's video, I want to go over a really fundamental concept to investing in crypto. And this concept is probably a top 3 concept to internalize in your brain. And I'm going to try to visually, verbally, and textually explain the zero-sumness of markets so that I can really burn this into your brain from a number of angles so that I hope that you have a nuanced understanding of what zero-sum means and how this is going to apply to your investing, okay? So there's a number of ways that we can look at this, and I want to go over each way and give you a bit of a breakdown. So I've summarized here all of the different ways you can look at zero-sum, and I've also got an entire little presentation for you. So this is an important one to be watching. Let's get into it. And I want to make this fun and exciting for you guys. So every dollar that you make is a dollar that someone else lost. So you have to imagine investing and trading and anything related to speculating in a market as a direct competition between you and another person. You're in the boxing ring. There's a guy across from you. It's either he wins or you win. You die or he dies. That's how the game works in crypto. Okay. It's the same thing as boxing. If you put $100 in and you pulled out 101, you made $1. You just took $1 from someone's wallet. So if you want to like visualize what trading might look like in a metaphorical sense, it's a bunch of people in a dark room with blindfolds on, with money in each other's pockets, and we're basically running around trying to take money from each other's pockets, right? That's what markets are. And you could only make more money by taking money from someone else's pocket. There's no money that's created out of thin air. Value doesn't just get, more money just entered. There's no fucking money that's just created out of thin air in markets. There's no like mythical, like everyone gets rich together bullshit. Like what you see on Twitter a lot is like, we're all going to make it. We're all going to get rich together. Wag me. We can all get rich if we all just hold all this 3-3, all this bullshit, right? None of it is real. Markets are zero sum. Okay. You either make money, take it from someone else, or you lose money, they took it from you. And markets are the same pool of capital circulating into the hands of different people. So that's sort of like that metaphor I said of people in a room running around with blindfolds, or the room's just pitch black. We're all just trying to pickpocket each other, right? Value is not created in markets. It's simply distributed. So whenever you see a new coin launch and it has a value, it sort of is value created out of thin air, but you need to understand that this money comes from somewhere. If $100,000 is put into something, right? $100,000 is all that can come out. You can't put in 100K and 150K come out. There's no like value that's created. It's just moved into different places. So let's say a new coin launches and it has a $50 million valuation. That's $50 million that's come from somewhere else. You can't just put 100K in the crypto and more money comes out. The same money comes out. If all of the money from crypto was drained today, there's no extra money that comes out. There's no like money printer in crypto, right? This is why the end of bull runs are often created by just an influx of supply. It's just at the end of a bull run, 1 billion fucking coins are made. And there's just so many new coins, so much new inflation of money. It all just gets distributed between too many different projects, and then the market just can't take it. It ends up entering a bear market. And then in bear markets, not many new coins are created. It's like the inverse effect. We have a lack of supply and we have all this new demand coming in. So that's how you need to visualize it, right? Value's not created. It's just simply distributed. Markets are like a game of poker. So,
here, this is what markets are like, okay? Markets are like four old dudes with kids sitting around a poker table. They all put in their chips. This guy's fucking rich. This dude bet everything here or something. This guy's got a little bit of money. This guy bet everything, looks like. And if this guy or this guy or this guy or this guy wants to make money, they can only take it from the other people's piles, right? There's no new poker chips that suddenly fucking appear on the table. No, you're just taking the money from each other. So this is what markets are. It's just instead of you sitting in front of him and looking at each other, you're both in your bedroom across the planet on a computer, and he pressed the buy button and you press the sell button and you swapped coins. And you're hoping that this guy here made the wrong decision. If this is you, he made the wrong decision and you've got his coins, and you know, the coin goes up in value and he made the wrong decision, right? That's your goal, right? This is what crypto is. The only people who can make money are governments. For the rest of us, we can only take it. So governments print money. They can make money. None of us are making money. You don't make money in crypto. You take money. You're taking other people's money, right? That's how it works. And, you know, to be honest, I say markets are zero sum here, but in reality, markets are actually negative sum. So what's the difference between zero sum and negative sum? Well, zero sum means he puts $1 in, he puts $1 in, he puts $1 in, he puts $1 in. There's $4. $4 gets pulled out. Right? At the end of this game, $4 goes to someone. This negative sum is he puts $1, he puts $1, he puts $1, he puts $1. So it's $4, and the winner only has $3 taken out. Where did that dollar go? Well, there's a concept of the house always wins, right? The house takes its fee. For you to have a chance of making money, you have to pay a fee for that ability to make money, to potentially make money. So the house maybe takes $1 and then someone here wins the 3. So in crypto, it's the same thing. You put $100 in on Coinbase. Coinbase charges you like fucking $5 to do that. There's also, when you convert your money to Bitcoin, there's maybe a little bit of a spread issue. So they collect money on the spread. And then when you go to sell your coins, you know, your $95, you end up losing another $5. So maybe you end up putting in 100, taking out 90. And that's, negative sum. The money accumulates into the house. Now, positive sum is another one where there's 3, negative, 0, positive sum. We'll get into that one later. Yeah, you can only take as much money as the market is willing to give up. And this is an important one to understand as well. Not many people talk about. When markets are super competitive, the people who are participating in the market, they don't ever lose much money. So because they don't ever lose much money, there's not much for you to take, right? If your counterparty has a very strict stop loss and they're very careful with what they do, they're never losing much money. You can't really take much. Where are you going to take the money from? It doesn't really work like that. When markets are easy, it's because there are a lot of idiots who just are gambling, chucking their money left, right, and center. You can make tons of money. And this is why crypto, for about 3 months of every 4 years, is the easiest place to make money in the planet, and fucking multimillionaires are printed 100 a day for that 3-month period. Why is this? Well, every 3 months of every 4 years, we get what's called exit liquidity. And exit liquidity is all these new investors coming in to try and make money in crypto if they have no idea what they're doing. They are willing to lose so much money because they're dumb that there's just a lot of money that you can take. So you can take as much as the market is willing to give up. If the market's willing to give up a lot of money, you can make a lot of money. Higher skilled market, no one gives up profit, you don't make any money. So how does this relate back to the mindset? Because this is a mindset topic. Well, when you're trying to make money in crypto like me or like anyone else, you have to view it as you're either taking someone's money or they're taking yours. Okay? The HODL meme that you see online it's bullshit. Outside of maybe Bitcoin, you shouldn't be trying to implement something related to HODL, because every shitcoin's end destination is minus 99%. Find me a coin that has been around for 10 years that hasn't pretty much died. It's only Bitcoin that hasn't died, and that's pretty much it. Some of you are probably saying, oh, but what about Litecoin? Well, let's have a look at Litecoin. Does this look like a coin that has done really, I mean, obviously it went back to its all-time high, but you have to view it as well from an opportunity cost standpoint. If you're buying coins that aren't going to new all-time highs, then you're underperforming the market. You could have bought something new that went 100x. Instead, you bought Litecoin, which went 5x, 7x, right? But the end destination for all these old coins, like what's another one? Peercoin. Let's have a look at Peercoin. You know, like these coins that existed back in 2016, their end destination is just minus 99%. Okay. So why is HODL a meme? Because these shit coins, there's just a repeating cycle of people getting rich and taking their money out and chasing the next big thing. Okay. Every trade has a buyer and a seller. So whenever you buy something, someone had to sell to you for that to happen, right? It's like a marketplace, right? You turn up at a fucking fruit marketplace, you give them $10, they give you tomatoes. Same thing here. So you need to think to yourself, why did someone give me coins? You both think you're correct. Only one of you can be correct, right? The price is either going up or it's going down. Who's correct? Well, you could be wrong, he could be wrong. You need to consider what both sides might be thinking when they make that decision, and you need to weigh up who is the person making the more logical decision. Who has the higher probability of their outcome being correct? Who has a greater edge in the market? You know, these are the things that you need to consider. As well as this is something we're going to go into a lot of depth right now. Markets are either player versus player or player versus enemy, right? What's the difference? There's two types of games in crypto. Let's get into this. This is important to understand. So there's two types of games in crypto. This is game number one, right? Game number one is called player versus player. So player versus player is basically what happens in a bear market. No one comes into crypto in a bear market. It's just the same nerds sitting in front of their computers, jerking off, you know, fucking buying and selling from each other, right? And price basically is just going up, down, up, down. It's not going to new all-time highs. It's, you know, maybe going down a lot, but it's just up, down, up, down, up, down. The same people buying, selling, buying, selling. It's a closed system. There's no one new coming in. It's just the same people buy, sell, buy, sell, buy, sell, right? And the game is negative sum because every buy and sell is a fee. Binance, Coinbase, Kraken takes a fee. You know, you put $1 in, these players who are the casino take a small percent. If you want to pull that dollar out, it's impossible to be the same unless you profit off someone else losing money, right? So this is what it is. Closed loop system. For example, let's look at this, right? Let's explain what I'm looking at here. Buyers are people holding cash, right? And sellers are the people holding coins. So in bear markets, it's a battle between buyers who want to buy and sellers who want to sell. So it's a battle between people with cash and people with coins, right? Sometimes in the market, there's a lot of people with cash and there's not many people with coins. Now, what happens when a lot of people want to buy something and not many want to sell it? Well, the price goes up, right? Let's do a little thing on Bitcoin to show you what I mean. Why did the price bottom here? Well, there was a lot of people who wanted to buy, demand, and there wasn't many people who wanted to sell, supply, right? When there is, you know, let's say this much demand and this much supply, the price is going to go up because naturally these people are going to try to buy. Like, let's say they want to buy a dip down to here, but there's so many people who want to buy this dip that they end up having to chase price higher. And this is what causes bull runs, right? A bull run is basically just a bunch of people, these people here with cash who want to buy, who never get to buy, right? It's just a bunch of people in cash who never get to buy and they end up just having to buy up here, right? Why is the price here and not down here? Well, there was a lot of people who wanted to get in and they've had to buy at higher and higher prices just to get their money into the market, right? That's the market cycle. So as a participant in a zero-sum game, the mindset you need to take is when there is a lot of people who want to buy and there's not many people who want to sell, you want to be getting into the market. If you were to have used this analysis, you would have been buying in this region because it would have been clear to you looking at data that, okay, there's a lot of bids in the order book. And I can show you the bids in this tool here. So you can actually visualize this with this tool here. So let me show you it. So you can see here, with this tool, the green is the amount of bids in the market, okay? So this is the Bitcoin chart. You can see it's the same chart as here, right? You can see this is the top, this is the bottom, top, bottom. You can see that the green is basically the cumulative amount of bids in the order book of Coinbase, right? I think we can do ETH, actually. ETH looks better, I'm pretty sure. And I actually already drew it. There we go. That's convenient for you. I've already drawn the visualizations. So you can see here that every time Ethereum hit a bottom, it was because we had a large amount of bids in the order book. Right here, lots of bids. And you can also see the color scheme here, right? This is a visualization as well of the order book. So you can see price comes down. It always bottoms when we have a lot of color, which is representative of a lot of bids. You can see, look how stacked the book is here. People were really wanting to buy. So what creates bull runs then? Well, a bull run is created by all these bids wanting to buy and then never being able to buy. And slowly as the price goes up, the bidders have become buyers, right? The bidders have become people who own coins. And when they own the coin, the next goal is to sell. So you run out of bidders and then eventually, we hit a top over here, for example. Like here, for example, you can see the amount of bids is very low. You can see there's a lot of asks, which is basically people trying to sell. Bidders become askers, right? Buyers become sellers. You get a lot of these. They get into the market. You get a lot of people buying here. They want to sell eventually, and then they end up selling here. You can see that every time we had a big spike in bidders, we had a big spike in asks. Why is this? Because if a lot of people want to buy, they end up buying, and they eventually want to end up selling, right? So that's how you visualize the concept of this, right? And then there's also the inverse, which is a lot of people want to sell, and not many people want to buy. This is when you want to sell, right? So we can also visually see this here with the amount of asks. Very high amount of asks here, right? A lot of people want to sell at the top. You can also see asks were very high here, but price went higher. So it's not always perfect on the sell side, but there was still a lot of bids in the market, right? There was a lot of bids. There was a lot of asks. It was pretty even, but you can see here the amount of bids was getting, very low and the asks were still pretty high. And you can see that boom, price went down, bids come back into the market. So this is how you visualize this concept with data, which is here. And you also can view it as a game of tug of war, right? In a game of tug of war, generally speaking, the side that has the most people wins. Now, obviously, this is a bunch of kids and a bunch of adults, but pretend that this is adults and this is adults, right? Buyers and sellers both have the same amount of ammo, right? Buyers are rich, sellers are rich. What you have to realize is that every time price goes higher, the sellers get more power. At $4,000 for Ethereum, the people who are selling have 2 times the amount of US dollars as the people at 2,000, right? So if they were to sell here, they might have $100,000 in Ethereum, but if they sell here, they've got $200,000 in Ethereum. The market cap of Ethereum might have been 20 billion here. The market cap of Ethereum might have been 40 billion here. I don't know what the market cap was, doesn't matter. But it's about the concept, right? Price went twice, went up 2x. That means the amount of power that the sellers have is now double. So whenever price goes higher, you need to keep in mind that the sellers have more power. They have more control over the market because they're wealthier. And the same on the inverse. The lower the price goes, the less impact sellers can have on the market because there's the same amount of people looking to buy. So that's why when price goes lower, it's actually more bullish because it's easier for the buyers to take over control of the market. That's why, down here, all the bidders, the price is way lower. Sellers have 80% less power and there's twice as much bids as there was here. Isn't that just as fucking simple as it gets with buying? So it's like a game of tug of war, right? If there's more people on this side, they're going to win. As well, this is how you can visualize it as well. So markets are this continual cycle of being undervalued, being overvalued. Buyers have control, sellers have control. You're really afraid, you don't want to buy. You're really bullish, you do want to buy. It's this perpetual cycle of fear and greed. Buyers have power, sellers have power. Lots of buyers, lots of sellers, and it's just this perpetual cycle, okay? Now, there's also a second type of game in markets where it's called exit liquidity, player versus enemy. So in this game, it's the buyers versus sellers. But in this game, it's buyers and sellers are teaming up to take money from exit liquidity, which is retail at the end of the bull market. So let's visualize the total market cap for crypto, right? This is the total crypto market cap, right? During this period here, we had all these headlines coming up about crypto. Bitcoin tops 50K. Newer investors think it's going to go higher. You have all these people on TV talking about how bullish crypto is, right? They're all telling you to buy crypto. What this news does is it brings in tons of first-time investors, tons of people who have never done crypto before, who barely have any idea how markets work. And this is a powerful and profitable, extremely profitable period of the market because we head into what is called exit liquidity. Exit liquidity is what every single person in crypto dreams about because alt season and exit liquidity are the same thing. Exit liquidity is basically a bunch of idiots buying crypto who we are clearly better than at the game of crypto, and we basically take all their money, right? This is why there's a very common concept in crypto called you don't make money in your first market cycle, you only make money in your second and your third market cycle, but we'll get into that a bit later. But basically, you can see here that in this game, it's closed, right? The walls are shut, no one new is entering. It's just these people. But in this game, we have all these people outside of the game coming into the game. And it's interesting because all of these people who were once competing against each other can all make money together at the same time as long as we have new people coming into the game, right? It's a very, very powerful concept. So I wrote all of this down here. Markets become positive sum in a sense during the player versus enemy mode. Anyone who stuck around during PvP is infinitely smarter than the PvE newcomers. And it becomes easy mode to make money because these people have no fucking clue what they're doing. They don't know that crypto is extremely volatile. They don't know that we have 4-year market cycles. They've never really had first-hand experience in this market. They're fucking newbies, right? They don't know what they're doing. New participants all lose money, and most of that money is actually given to the older participants. So exit liquidity is a game of these people giving their money to these people. Right? This relates back to the idea of you don't make money in your first market cycle, only the following ones. Crypto is a perpetual cycle of first cyclers, so people in their first market cycle, losing all their money to the second, third, and fourth cyclers, who are people, who've been in multiple bull and bear markets, who then, those who stick around in the next cycle, they end up taking the profit from the next group of newcomers. So these guys come in, right? All these people. Then the bear market starts. They all lose their money, but they become these people. And if they stick around into the next bull market, they are these people. And then another group of these ones come in and they give the money to to the old new money. Right? I hope that makes sense. And so if this is your first market cycle and you're watching this course, the chances of you actually making good money this bull run is close to zero. Very, very, very rare that anyone makes money in their first bull market. It's extremely rare. And it shouldn't even happen. If you make money in your first market cycle, it's almost going to be a bad thing. Unless you can learn really quickly alongside a mentor and get guidance, it's probably a bad thing that you make money. Because the only way that you learn the lessons to never lose all your money is to lose all your money once, right? You cannot avoid losing all your money and knowing not to lose all your money until you've lost all your money, right? You cannot know that the fire is hot until you've been burnt. So anyone who tries to avoid losing all their money is just delaying the inevitable. You will lose all your money at some point. This is the inevitable outcome, right? People think that they can just skip that whole process. Oh no, I'll just be an instantly profitable investor. No. In crypto, it's so volatile, it's so risky, it's so tricky. It's difficult. There's so much to learn that if you end up making money, you're not going to learn the lesson that you need to be that you need to be very careful, that you don't keep your money on exchanges, that you self-custody, that you don't hodl. All these things that you can only learn after making the mistake. You can only learn this stuff from first-hand experience. The only way that you could possibly have a chance to make money in your first market cycle is to get direct guidance from a professional. So if you navigate the market alone, you're never going to know when to sell because you're going to be relying on your own knowledge and people's free information on the internet, which is not enough, right? If it was enough, I would have had a bunch of people tell me, hey, I sold at the top because I listened to a dude on Twitter. Like, imagine someone said that. Hey, Daniel, yeah, I actually sold all my money at the top because some dude on Twitter told me to, and I actually saw a tweet and I listened. When have you heard anyone say that? No one says that. No one has gone, oh yeah, this YouTuber, bro, he just put a video up at the exact near the top and I actually sold everything and never bought. And I just kept my profit. I've never once heard that story. And I've spoken to multiple thousands of people in crypto. right? From all levels of experience. So yeah, the only way that you could even possibly make money in your first market cycle is if you get direct guidance from a pro. You need to be working closely alongside someone who's already experienced everything, who can tell you, okay, don't do this, don't do that, and who can hold you accountable to make sure that you exit at the top. Well, you're just not going to do it. You're just not going to be smart enough. And yeah, the ultimate goal of these two games is during PvP, you want to survive. You're not trying to get rich here. The goal of this period is buy here, not here. Don't blow up your money. Don't get wrecked leverage trading. Don't get wrecked on, FTX. Don't get wrecked yield farming. Survive, buy, and then wait for the exit liquidity. Your goal during exit liquidity is to be super fucking aggressive during the first part of exit liquidity. It is to take on risk, and then it is to exit. Right? Exit liquidity is called exit liquidity because it is the liquidity, the new people entering that you exit into. Your goal is to sell to the retards. It is to sell to the normies. So whenever this period comes in the future, you got to sell to the normies. When this shit starts going off again on the TV, you can see 50,000 Bitcoin. This was near the top. When this shit starts going off, exit into the liquidity of the normies. Now let's summarize what I've just talked about. Player versus player markets is existing market participants competing against each other during the bear market when no new money is entering. It is very hard to make money during bear markets, but accumulating long-term positions here is where the big money is made once we enter a bull run, and it's PvE, player versus enemy. Markets are zero or negative sum by nature. Crypto is negative sum. But during this player versus enemy period, markets become positive sum as we have new buyers entering the market. Everyone in crypto can make money at the same time for as long as new participants are entering. This is why when we're in a bull run and everyone on your Twitter feed is bullish, that doesn't mean sell. Because every single person on crypto Twitter can all be making money together. And as long as we have new people, normies coming in, we can continue to make money together with no one losing forever. As long as we have new people coming in, to offset the selling. If 100 people exist in crypto now, if one guy makes money, another loses, right? PvP, zero sum. But if 1,000 people were to come into crypto, these first 100 people can all make money together off of the back of the new people coming in. So it's almost positive sum, right? You put in $1, you pull out $1.50, right? Let's visualize this. Joe puts in $1, I put in $1, Stephanie puts in $1, Alex puts in $1. So there's $4 in crypto. There's $5 outside of crypto. Let's say $6. We'll make it even. So there's $4 in crypto. There's $6 out of crypto. Right now we're in PvP mode. If I make money, it was from this person, right? This is me here, right here. I'm trying to survive. If I make money, it's from this person or this person or this person. But if these 6 people move in here, this person can make money. So they can become 2, right? They can become $2. $2. And there's also, so it's 4 gone, right? So cross off 4. Let's get rid of these 4. And then there's $2 that we can make. So maybe he makes $1 and then I make $1. So I've got $3. He's got $3. These people all lost money. And then there's 2, right? So we can all make money together if there's new people entering. That's how you visualize that. That's a positive sum game.
This video is on pattern recognition database. This is a really important one to understand because as useful as courses are, you cannot skip the process of truly understanding what someone is saying firsthand. Words can only convey maybe 2% of what you need to understand to truly conceptualize anything that I'm saying to you. So if I say to you, you need to buy low and sell high, you understand only 2% of what I just said. Because there's 98% of that concept around buying low and selling high, which you cannot learn until you have downloaded a pattern recognition database, right? And what is a pattern recognition database? A pattern recognition database is basically you live life and you have 5 senses, and these 5 senses take in data: sight, sound, smell, taste, touch, right? The 5 senses. They take in data from the world. You interpret the data. You find patterns in the data of what is good and bad. And then whenever you see the same things again using the senses, your brain recognizes the pattern and it notifies you. So for example, imagine back in the caveman days, you're roaming around hunting animals with your friend and you see a lion. You've never seen a lion before. Your friend gets chased and eaten. You watch him get eaten. You run away, you survive. Now you're like, holy shit, I now know I need to stay away from lions. Because your five senses have interpreted the lion, what it sounds like, what it looks like, maybe what it smells like, all these different senses, right? You now know what the pattern of what you need to avoid is in the circumstance of a lion. So if you ever hear the same footstep pattern, if you ever hear the roar of a lion, if you ever see the lion again, your pattern recognition database will kick in and it will notify you instantly to stay away. And in investing, it's a very similar thing. How do I know what to buy and what to sell? Well, it's just pattern recognition database. I can determine if something is a good or bad investment within 30 seconds. It does not take long because I just am using my subconscious pattern recognition database to help me make decisions. Decisions do not take a long time. When you know your shit, you can know the answer to everything almost immediately, right? This concept of needing to research and and sleep on a decision. No, your brain knows what you need to do instantly if you have downloaded a sufficient pattern recognition database and you have sufficient intuition to dictate the decision. If you look at every single good investor in the world, they all have the ability to determine if an investment is good or bad within 30 seconds, right? You can put the investment, the thesis in front of an investor, and in 30 seconds, they will tell you, fuck, this is really good, or this is absolutely terrible. Because they have intuition. And intuition is the highest form of knowledge. It is the deepest form of knowledge that you can possibly utilize to make a decision. And I made a meme. I like making memes to help you understand things. I made this meme to help you conceptualize what I'm saying. So when people are deciding, let's say, any investment related decision, what to buy, when to buy, etc., if you copy someone, it's actually not bad if you copy someone, but you have to do it correctly. But let's say someone goes on Twitter and just copies someone on Twitter, right? That's the most retarded, low-level sort of decision-making process that you can follow, right? You are outsourcing conviction to a stranger on the internet. You are literally a tiny little monkey brain, right? That's what this level is. The next level is critical thinking. So critical thinking is using your conscious brain to analyze. It's you consciously looking at the data, taking it into your conscious brain, and then deciding what it is that you want to do. Okay? It's better than copying some dude on Twitter, but it's not the best. And then the next level is deciding from instinct. So instinct is the generational wisdom that comes downloaded at birth, right? Why is it that when a fucking ant is born, it can just immediately know how to walk? Why is it that when a baby is born, it just starts crying? How does a baby know how to cry? This is instinctual things downloaded at birth. It's like the software. When you buy a new computer, it's got software pre-installed, and then you add the things afterwards, right? You add all the programs after. This is the next level, and you can use instinct to help determine decisions. Now, when you think about it, using instinct in investment decisions, it's actually the worst way that you could approach investing, okay? Because your instincts generally run completely opposite to what you need to do in market. So for example, your instinct is to follow the herd. That's an instinct. That's not something you learn. That's something that's ingrained in you. You follow the herd. That's why everyone wants to do it. So if you implement follow the herd in your investing, you're just going to buy at the top and sell at the bottom. You're going to only do things when it is the consensus decision that it's a good decision, which is never when it's a correct decision. So if you decide things from instinct in investing, you're going to lose money. But the useful thing with instinct is if you do the opposite of what your instinct is, you actually end up making the right decision. So that's why it's above critical thinking. You can actually counter trade your own instinct because you can never remove instinct. You can simply understand it for what it is. And then the highest level of decision making in investing, the one that you ultimately want to get to, is your intuition. So you can see my intuition told me to buy, right? Your intuition is the fastest, quickest, and easiest and most accurate way to make decisions, because intuition is a perpetually accumulated wisdom from lived experiences which manifest in our subconscious mind. So you live your life, you make mistakes, you learn from the mistake, you remember the mistake, you've downloaded the memory and the lesson, and then you do that 10,000 times over, and you actually pick up patterns. And this is what I refer to as the pattern recognition database, right? You live an experience like the lion, you know not to go near lions, you've now built an intuition. You now know just intuitively that when you hear the rustling of the bushes and you hear the little sound of the lion going, "Arr," you know to run. The intuition tells you, holy fuck, I need to just start running. I don't know why, but I just need to run. You don't see the tiger. You don't know that the tiger or the lion is even there, but you're already being told to run away. That's because your intuition, this deep-rooted, accumulated wisdom, is manifesting subconsciously, right? In the conscious mind, you look at something and you consciously recognize it. The subconscious mind is a process happening separate from you, right? The subconscious mind is ticking over without you even knowing. Your subconscious mind it's like a separate you. It's not even you. It's like a different human in your brain telling you, hey, start running. The lion's here. I know you can't see it and I can't tell you that the lion's here, but just you got to start running. That's intuition. I want to give you a little bit of a quote here on intuition, which was from a book called, I think it's from a book called The 30-Second Mind. And it's a really interesting book. I haven't read it, but I read the summary, a little bit of a summary on it. And it's really interesting. It breaks down how, you can basically make all the best decisions within 30 seconds. And it aligns with a lot of what I've learned. So let's give this a read. That is why intuition is so useful. While you are sifting through the data, your gut feeling, as we often say, has accumulated a whole archive of undetectable signals, some positive, some negative. For deciding, the gut will then either confirm or deny the preliminary decisions of the rational self. All decisions should be considered provisional, subject to the approval of intuition. If you feel that doubt arises, examine it. It may be fear, a habitual reaction based on long-established mistakes in your self-image, or it may be the wisdom of intuition that guides you in the right direction. So I think the key point here is, for deciding, the gut instinct confirms or denies the preliminary decisions of the rational self. So to put that simply, because I know you read that and didn't understand what I just said, it went in one ear and out the other, so let me explain it. Consciously, we go, okay, do I buy this coin or not? Consciously, okay, yes, I want to buy the coin. But subconsciously, in your intuition, maybe your brain's saying, nah, I'm not sure about it. There's a level of conviction that you don't feel like you have. That is your subconscious mind not giving you the approval through intuition that you should be making this decision. And what you need to do is, instead of listening to the conscious brain of, objectively, I look at the data and it makes sense, don't listen to that side. You need to listen to the intuition of, this doesn't feel right. The gut feeling. Now, feeling in investing is a tough concept because the worst investors use feelings and the best of the best investors use feelings. They both use feeling, but the feeling of the beginner investor is based off of instinct, and the feeling of the advanced investor is based off of intuition. Can you see the difference? A beginner investor will feel like buying at the top because instinctually they had to follow the herd. The best investors listen to the feeling of wanting to buy because they've downloaded an intuition from lived experience that they need to buy when it feels the worst to buy. That's the key difference between a good investor and a bad investor. It's listening to instinct versus listening to their intuition through lived experience, through the pattern recognition database that they have downloaded from thousands of hours of making mistakes and learning and understanding what they need to not do. Okay? So that's what it's saying here. Because you need to understand that the brain is a very complicated, nuanced, and complex organ. I guess you could call it an organ. I don't know. Maybe let's call it an organ, right? It's so more complex than we can possibly understand. And the way that I like to look at it is that our conscious mind is only the very tip of the iceberg. The way that the subconscious mind works is so much deeper than you could possibly comprehend. Intuition is just something that we do not understand. Maybe there's some scientific studies on it, but most humans, and I think no human truly understands how gut instinct or intuition works. It's sort of a gray area. It's very complicated, but it's something that's so important for you to use, right? Because humans, and pretty much all animals in general, never really had self-awareness. From what I can understand, I'm not an expert on this stuff, but consciousness is a component of self-awareness, right? We have the ability to have conscious thinking because we are self-aware. But most living organisms do not have self-awareness, and I think they don't really have conscious thoughts. They only have the instinct that they downloaded at birth, so the software, and then any of the apps that the computer has downloaded, so the subconscious lived experience of intuition, right? The animal knows that when humans jump forward, it knows that that's an attack, and it recognized that the last time it got jumped by a human, that it had to fly away or it was going to get picked up and eaten, right? That's a lived experience. That's a subconscious instinct to know to fly away. But the conscious, the animals don't have. So you can understand that, like, this is only a small new component of the human brain. The existing instinctual side, the intuition, and I said subconscious gut instinct, but what I really meant here is the intuition, right? The intuition, the lived experience is a much, much deeper component to making decisions. And a lot of you guys, you ask me, and I really hate this question, Daniel, do you have like an exact process to finding the best investments? What's your step-by-step process? And I hate this question because it just reflects a lack of understanding of this concept of intuition. The meme goes, but you must have an exact process for determining what to buy. Come on, there must be something exact that I can follow. But the truth is, just listen to your gut. That's all I do. I just listen to my gut. And another way of explaining it is 99% of your research, it's just a surface level filtering process until your intuition identifies the good investment and pretty much knows that it wants to buy within 30 seconds, right? And the problem is, you guys really think this part is important, right? You're always asking for step-by-step research processes, but it's the research component is only the surface level. If you don't have the intuition to identify the good investment, then this stuff is sort of a waste, right? Because you don't have the intuition to recognize subconsciously what is good and what is bad. So you only rely on the very surface level research in the conscious mind. It's not a very good way to research things, right? The best investors have just this intuition that the thing that they've researched is going to perform well. And they also have obviously the supporting research, but the final decision was made by the intuition. Just like in that quote that I showed you before, all decisions need to be confirmed, or they need to be approved by intuition. You can do all the research at the surface level that you want. I can give you the whole step-by-step process, but unless you have this final component of approval by intuition, then you're not going to be able to do very good investing. Okay? So how do you get the intuition? Well, let's go over that now. If you don't have a pattern recognition database, what do you do? Well, you have pretty much two options. You either follow the pro or you become the pro. It's pretty much all you can do. Now, follow the pro is basically find someone who's already downloaded a really good pattern recognition database, who already has a gut instinct for investing, and then do what they say. Now, this doesn't mean find your favorite Twitter guru and just copy their tweets. That's retarded. You need to work closely alongside the pro, okay? You have to work alongside the pro very, very closely so you can get their information as soon as they send it, and so that you can get every piece of information, not just when they buy, but also when they sell, when they cut the position a little bit, when they add to the position, you know, all of this. And if you want to follow the pro, as in me, the pro, then I have a mastermind community which literally does exactly this. I tell you exactly what to do, and you can pretty much just copy me, right? You don't have to go through the whole crazy process of downloading a pattern recognition database. You can just use mine. So you either use mine, pay to use it, or you build your own, spend thousands of hours to build it. So you have a choice. There's no right or wrong decision, but if you don't want to spend 3,000 hours downloading your own pattern recognition database, then I'm right here. Okay? But let's say you wanted to become the pro. So let's get into that. How do you become the pro? Patterns are developed, the pattern recognition database is developed, and the gut instinct is refined. The gut intuition. Let's more talk about intuition, right? Instinct is not as important, intuition. It's refined after accumulating thousands of hours of relevant life experience. So in life, you learn the most from the things you did wrong, from the mistakes you made. So the key is you want to make as many mistakes as possible with the least amount of loss per mistake. The problem with investors when they begin learning how to invest is they put in heaps of money in their first market cycle, but they don't understand that the first market cycle was never really, the one where you're supposed to get rich, right? You're competing against people like me when it's your first market cycle, who can basically spend 30 seconds and know whether something is good or bad. Whereas you have to spend hours and hours and hours. You can't compete with that. You can't compete with me. You literally cannot beat me, right? You take too long to decide if something is good or bad. Meanwhile, I can look at it for 10 seconds and I know immediately if it's good or bad because I've already done the work to be able to make fast decisions. What you need to do is make as many mistakes as possible. As I said, reduce the capital risk per mistake so that you can stay in the game because you have to be able to survive. If you take too much risk when you are in your high mistake prone stage, you're just going to end up losing everything. Because 80% of the mistakes that you can make, right? 80% of the mistakes can only be learned through first-hand experience. You cannot, like, you can watch this course and I can tell you what not to do, but 80% of the things I tell you not to do, you have to actually make that mistake yourself and learn it yourself. I cannot tell you, don't do this on everything and you can just magically avoid it. You have to make the mistake yourself because the amount of required mistakes means that without following a pro, you simply cannot put the win rate in your favor. At the beginning of your investing journey, it's near impossible to keep any profit because just the sheer amount of mistakes that you cannot avoid just makes it near impossible to not lose money, right? 80% of the decisions you make are going to be wrong. And so unless you can magically make so much money when you're right 20% of the time to cover the 80% where you lose, you're just going to end up losing money, which is fine. It took me years to make money in crypto. I didn't make money till like 2019, till the start of the bull market. Even into 2020, like even 2019, I didn't do very well. I ended up making and then losing money. It was only really in 2020 where I started to do better. I had to invest thousands of hours to download a sufficient pattern recognition database just to minimize my mistakes to the point where I made more moves than wrong, more right moves than wrong, right? You eventually make so many mistakes that you know what not to do so that when the potential mistake comes up again, you don't make it. And you eventually just avoid so many mistakes that you make more right decisions than wrong, and then you end up in a profit, right? That's investing. Now, I really need to emphasize here that the 30-second mind, the intuition, is a quantum tool with unimaginable power that is unknown by 99% of humans. The more you lean into your intuition, the more success you will have in investing, in life in general. If you listen to your intuition, the most deepest, most complex, the most advanced, the most accurate decision-making process that you have, the more you lean into it, the more success that you'll have. Okay? Now, again, I want to reemphasize, you have two choices now. You either follow the pro or become the pro. All right? Follow the pro is my mastermind. I show you exactly what to do. We get you to 7 figures together. Or you get to 7 figures by becoming the pro yourself, which takes a bit longer. All right, so let's talk about types of capitulation, because people always talk about in crypto, oh, like the market's capitulating, and like, you know, they always reference capitulation in regards to price. And I feel like a lot of people don't know that there's 2 types of capitulation, or at least I would view markets through 2 types of capitulation. Capitulation happens twice in crypto. It happens when prices crash so much that you just want to get out of the market, you can't take it anymore. And capitulation also happens when prices go sideways for so long and the market stays dead for so long that you just give up. So you either sell after a crash, so you either sell due to like losing money, or you sell basically because you're not making money, because the coin seems dead. And if you look at it from a Wall Street cheat sheet sort of example, you can see that prices crash, you get to basically the bottom, and when you get the capitulation, this is the price-based capitulation. You sell because you think the thing is dying, but then the thing reaches a bottom shortly after you capitulate, and it goes sideways. And anyone else who did not sell during the crash will get shaken out mostly during the time-based capitulation, which is where things will go sideways for 6 months to a year to maybe even multiple years. And this part is actually a lot harder to deal with than this part due to the distance from the bull market. The further away from the bull market you get, the longer it's been between the coin going good, the harder it is to deal with the fact that, you know, this thing might be dead. But it's funny because the further away you get from the top of the last bull run, the closer you get to the next bull run. But people don't understand that, and that's why they sell during the time-based capitulation. So I've wrote a little thing here. Let's go over it. The hardest part of crypto is not just surviving the crash, it's surviving the incredibly boring period after the bottom is in, where price will do nothing for 6 to 18 months and make you think the coin is dead forever. Bitcoin has done this, as you can see here, multiple times. So let's go back to 2015, right? We had the final capitulatory crash, and then we had the time-based capitulation, price basically just going sideways and making you think it's dead for about an entire year, right? March 15 till September 15. Or it was more back here, January 15 till, October 15. So it was like almost a year of sideways, right? It's a long time for price to not do much. And if you go up to here, we had the crash from 6K to 3K, and then we went sideways for many months, and then we went up. I remember this period here. When the price got here, everyone was expecting it to drop, so they all started shorting because they were using a 2015 fractal. So they were like, you can see here, the first pump, the second pump, they thought it was going to crash. All the shorts got liquidated, huge short squeeze, okay? Now, let's go to the most recent one. We have had price capitulate basically to the bottom, and then we had the time-based capitulation. So once this bottom was hit here, June, it took about 6 months to hit the bottom, January, and then price went up afterwards. So time-based capitulation, as I said, is much harder because the distance from the current price to the last uptrend becomes even larger. The only way to navigate these two periods of capitulation is to understand they repeat and they happen every single cycle. So the reason that you would sell during price or time-based capitulation is just that you don't understand market cycles. If all you did was wait for capitulation before buying, you wouldn't have any problems because you would only be buying at opportune times. Let's say you sell the top of the bull run. This is why there is no rush for you to buy back into the market for the next bull run, because you think that, I'd have to buy as it hits the bottom. No, the whole market has to go through 6 to 12 months of a time-based capitulation. You're going to have plenty of time to buy once the bottom's in. So you shouldn't be trying to catch a falling knife when you're trying to, get in during what you think is the bear market, right? You don't have to. The price always goes sideways. Crypto does not do V bottoms, right? You have multiple months once the bottom is in to buy. And you can see that every single time, except for COVID. But COVID was not a market cycle crash. COVID was a once a century black swan event. It sort of broke the market structure temporarily, the market cycle. But during normal market cycle capitulations at the right time of the cycle, during the bear market, the bottom's in, and then you have 3 to 12 months usually to buy. In order to not fuck up the crypto market cycle, this section's all about understanding crypto and market cycles and whatnot. To not fuck it up, you just need to understand that there's two types of capitulation. And you don't have to rush buying the first one because the second one is coming too. And that one happens for a lot longer of a period. And especially for altcoins, like look at certain altcoin charts. They are going sideways for a lot longer than crypto, than Bitcoin, because Bitcoin is the first one to rally. So the alts generally have like an extra 6 months of sideways action. So you can see here, right? From 2015 till 2017, XRP went sideways. That's also a large attribute to why it pumped so much. And we're going to get into why that is later. So you can see that, altcoins tend to go sideways even longer. So it's even less important to buy a crash on your favorite altcoin. The longer the time-based capitulation goes on, the smarter, wiser, and stronger the holder base becomes, and thus the harder it becomes for prices to drop. And the further the price can rise. Anyone buying during price-based capitulation and time-based capitulation is going to sell at much higher prices, right? If you are buying XRP after it's done nothing for 1 or 2 years, you're buying because you're a smart person. You understand that this is a good thing. Every dumb person looks at XRP doing nothing here for 2 years and they think, the coin's dead. But that's what dumb people think. But smart people who've experienced market cycles understand that, holy shit, this chart is insanely bullish. Look at it. It's only going sideways. And look, they were right. XRP went like 100x. That's what price is at. Not even, it's like half a cent, and it went up to $3, right? It went up more than 100x. It went up like a lot. So you can see that during these price and time-based capitulations, the market is changing. The holder base is changing significantly. And it's a symptom of the market cycle, what's happening. And I want to show you a visualization to help you visualize what happens during time-based capitulation. So there's two supplies of a coin. There's the liquid supply, the float that you can buy on exchanges. So let's say that's like 10% of the market. So let's say you go to Binance and Coinbase and all of that. There's all these like liquid tokens that you can buy that get traded back and forth between all the day traders and stuff. That's what you would call the float, right? The float, like a business might make $100,000 a month, but they're only going to have a float of, let's say, a few $1,000s in the till. Right? They're not going to keep the whole business's bank balance in the till. They're going to take it out. Sort of like with crypto. And this supply here is the actively traded supply that gets handed between traders, right? And there's this supply which never touches the market, right? Most coins never actually get bought and sold. They sort of get just left to nothing. There was a stat that came out about 6 months ago. I think it was like 70-80% or something of all NFTs are still in the hands of the original holder, which is a crazy statistic. So for example, like this punk apparently has never been traded, right? And there's a lot of people who do this. They buy things and then they never sell them, right? And let me show you a statistic here. You can see here that long-term holders supply as a percentage of circulating supply. So 75% of all Bitcoins are now in the hands of long-term holders, meaning that most people have been holding this thing for a very long time. And that is to show you that most coins never actually get traded. Most NFTs never get traded. Most stocks never move. They sort of just exist in dormancy, right? I would call it the dormant locked away supply. And so a time-based capitulation, what is going on in the background with these two things is that the available supply is shrinking and the dormant supply is increasing. Because what's happening is that people are looking, let's say, at the XRP chart, and they see, oh, wow, this thing's in an accumulation range. It has lots of good news coming out. The team's developing, working hard. The bull run's coming back soon. Fed's lowering interest rates. They see that this coin has a bright future. And so what they do is they buy up the available supply that they can, and then they move it over to their ledger, or they take it off the exchange or whatever it is, and they hold it in a dormant state. They stake it, whatever they do, right? They lock it up, whatever they do. And that process is what is called time-based capitulation. It is the process of the weak hands selling and the coins going into the strong hands. People talk about that a lot, right? Bottoms form when weak hands sell to strong hands, and tops form when strong hands sell to weak hands, right? So let me show you a bit of a better visual here. So at the top of a bull run, you have a large tradable float which was created by the dormant locked supply selling. And you can see that in this photo here, right? 2018, the beginning of 2018 was the lowest point of long-term holders. Why was that? Well, during the entirety of this bull run, coins were moving from the dormant supply of the long-term holders into the hands of the tradable float, the people on exchanges. Now, because new people are constantly entering Bitcoin during this uptrend of 2017, the price didn't immediately top. But the impact of the coins moving from the dormant supply to the tradable supply has a very significant impact once that demand coming in, that crazy level demand, starts to fizzle out a bit. And the people who are coming into the market are not necessarily smart investors. So these people are not necessarily buying here and moving it here, right? A lot of them are more traders, or they're maybe a holder that's not necessarily long-term. They're just trying to make a 2x, or they're the type of person who will buy something and then sell the bottom. So these are not strong hands. The further you get into a bull run, the more tourists that enter the market, the weaker the hands that they have, the more chance that they sell, at a low price. And that impacts the quality of the price of the holder base of the coin, right? The later in a bull run, the higher the coin price goes, the lower the quality of the holder base, because you're getting the tourists, the dumb people who don't know what they're doing. And so you can see here, it's a movement this way. At the bottom, the tradable float shrinks as the long-term holders accumulate, expecting, an uptrend to form. And this is why looking at the chart to determine what to do is really important, because when you look at a chart, every single person who holds the coin is also looking at the chart. And so if the chart looks a certain way, the people who have the most coins, who are the smartest people, are going to make decisions based off of what they see. So let's say, for example, XRP, right? It's gone absolutely ballistic up here. You have to ask yourself, when everyone looks at this chart, what is everyone thinking? Well, the dumb people are thinking it's a great coin, so they buy. The smart people who hold all the dormant coins are probably looking at this and thinking, okay, it's time to take profit. And so the dormant supply is shrinking. It gets smaller as the price goes up more and more and more, as this chart looks worse and worse and worse in the eyes of the smart people who know that they need to take profits, right? And the smart people are the ones who buy early, and they're the ones with all the profit. Coins move from weak to strong hands at the bottom and vice versa at the top. Tops occur due to the available float increasing from whales offloading to the point where the market cannot handle the increased supply and price falls. Because when you think about it, the tradable float is just the coins that get traded between people on the exchange. It's just traders. So there's two types of people in the market. There's people who buy and sell the tradable float, and there's people who move coins between here and here, right? There's two types of people in the market. There's the day trader who keeps his money here, and then there's the investor who either increases or decreases the supply of the tradable float. So when you look at the volume of a coin, high volume, low volume isn't the only consideration. It's about who created that volume. Was the volume driven by a whale who has now increased the tradable float by 2%? Is the volume from a whale taking off 2% of the tradable float and he's not going to sell until the price goes up 10x? So you have to try to use data like this data to understand what the volume, not just what the volume sort of means, but who is behind the volume. And this is an important concept to understand to identify time-based capitulation, because when prices are going sideways, you can use data, you can use on-chain analytics in order to determine who is buying, who is selling. So let's say you look at a coin and you see people who have been tracked as a smart wallet, as in someone who is, has a history of making money buying bottom, selling tops, and you find that they're buying another coin that's going sideways. You know for a fact, basically, that the coin that they're buying is not a tradable float coin. It's a coin that's now a dormant coin. So they are decreasing the float. And when the float is decreasing, when you can see the smart people are accumulating in a coin, you can basically confirm to yourself that, yep, the time-based capitulation is coming to an end. These people are betting on this being the bottom. Price is probably going to go up. They probably know something that I don't. And it's the same vice versa. At the top of the market, you see the really smart traders start to sell, or near the top. You have to ask yourself, oh, okay, this is not just any normal seller. This is a seller making the float bigger, which is bad. I don't like big floats. Okay. So I did a thread talking about this book here, and it was a very interesting book. I read it like 4.5 years ago. You can see July 2019, and it relates to capitulation. So eventually a level is reached or some change in conditions appears, which causes these scale buying orders to be partially or entirely withdrawn and selling orders to be substituted on a scale up. Now, what they're referring to with the selling orders is there are all these orders to sell from dormant coins now going back onto the exchanges, right? It's the dormancy moving to the float. And the bull market will not go up much further after this change takes place. So it has now become easier to produce declines than advances. When there is a large amount of float, larger than normal, there is more coins that the traders have to basically be buying. There's more coins that these new investors have to be buying in order to make the price go up. Because when you think about it, right, when the tradable float is really small, you do not need much people to buy for the price to go up, because the price of these coins is determined by the price of these coins. But in order to make this price go up, you only need to make this price go up, right? Let's say there's one tradable coin and then there's 10 dormant coins, right? If this one coin becomes worth 3, let's say, in 3x is in value, so that's now 3, this becomes 30. But you only needed to buy 2 in order to have a 20 impact, right? And the problem, it happens when each coin that moves from here to here, right, is actually 20 times the power of this one, because this supply, like each 1% of coins that sell from this side is 20 times the power of the 1% of coins on this side, because this supply is so much larger. So let's say only 1% of these move, right? That's a much larger, that's 20 times more than the 1% of this side. So this is the problem with when coins move from the dormant to the float. It's creating pressure and it's creating resistance for the price to go up. And this is why in crypto, a lot of coins, like for example, SWI will launch with only a very small float, because it's a lot easier for the price to go up. You can see here, the market cap is 600 million and the fully diluted valuation is 6 billion. So it's only a 10% of the supply is available to purchase. So it's a 1 to 10 ratio. So when these coins become liquid on the market, they're going to have a very large impact on the float. And this is why these VC coins tend to not perform well, because over time, they have coins getting unlocked from the VCs. It's basically making the float size bigger over time, right? Now, a coin which shows this sort of really well is Lido, except Lido has managed to escape the problem of a massively increasing float. So if you look at the price of Lido, right, it is sideways, hasn't really done anything. But let's look at the market cap. Oh, wow. Look at that. Lido on the market cap chart has been going only up, meaning that all the VCs who bought this thing are getting unlocked and they're making all this profit because the market cap is still very high. But the price for the people buying on the exchanges is not making them any money. This is why I never bought Lido, because it's just such an inflationary piece of shit. So this is an example of the dormant supply, right? Constantly moving over to the tradable float because the coin has a very high FDV, fully diluted valuation, versus the circulating supply, right? Let me write a note here. When the circulating supply is low and the dormant sort of FDV is high, when the dormant gets unlocked, it has a huge impact on price. Now, what is the difference between dormant supply someone has chosen to lock up versus VC locked supply they don't want locked up? Well, when the VCs get unlocked, they want to sell at whatever price. When the dormant people buy and lock up, they only want to sell at a massive profit. This is the thing. People who buy coins from the tradable float and they move them to the dormant locked supply, you're able to buy at the same price as them. So you're able to buy during the period where the smartest people think the coin's going to go up. When you have to buy a coin that has all these VCs on board, you're not able to buy at the price that they bought at. So as immediately when they get unlocked, they are going to sell and they're going to increase the tradable float. Right? I hope this makes sense, guys. Because when you think about it, right, let's say a coin does a fair launch, the coin launches at this price, and then it goes a little bit lower to here, and then it goes up to here. You are able to buy here at any of these prices, right? You can buy any of these prices. But when a VC coin launches, the VC gets in here before the token comes out. The token comes out here. Maybe the token gets to here. But the lowest that you can buy is at a 3x, let's say, of the VC entry on a lot of these coins. And so it doesn't matter what the price is that their coins unlock at, because they're locked up, doesn't matter. They will massively increase the tradable float because they're at a massive profit. So that makes, but the VC game is not good when you buy VC coins because they have an unfair advantage during the accumulation process, which you do not have. That's why I do the VC game. That's why I do pre-sales. That's why in the Mastermind we do all these pre-sales, because we become the VC and we get a competitive advantage. We get entries that no one else is able to get. Now, let's finish reading this section. The bull market will not go much further after this change takes place. It has now become easier to produce declines than advances. The situation is the reverse of that described above, and a bear market follows. So let me show you another example of a coin which is filled with VCs. Sweet, I just talked about this one. It's underperforming the market massively. Look at it. Its bottom was 40 cents and it's now at 60 cents. It's gone up 50% from its bottom. How much are we up from the bottom? Solana's up 7x. Toshi's up 30x. Toshi has all its coins released. Even Ethereum's up more. Even Bitcoin's up more, and Bitcoin's like a fucking humongous asset, right? So this just shows you the weight the VCs have on the price. It's like a permanent increase of the float, right? VC coins have a permanently increasing float as they get unlocked. Fair launch coins have a fair playing field for accumulation during the bottom and only have increased float when prices have risen massively. Now, I only just came up with this as I make this video, but it's so true. I just learned something teaching you guys. Wow, it was amazing. Let's read this last section and then we'll wrap it up. In a bear market, pressure appears in the place of support, right? So the float increases as more sellers and buyers. The scale orders are mostly to sell as the market rises. Only a small following of purchases is obtainable on advances. Hence, the activity of business in a general way falls off as price goes up. The end of the bear market is marked by the reappearance of support and the removal of pressure so that prices rebound quickly and sharply from declines. So what does the reappearance of support look like? Well, let's show you again. I really like to emphasize this because I want you to be able to visually understand it. The reappearance of support is the float available on exchanges being accumulated by people who move the coins into dormancy, right? And I want to show you as well what support coming into the market looks like using this data set right here. So this data set I'm going to show you shows you the amount of bids on exchanges. And you can see here, if it's going to load, that at the bottom, when the price is at its bottom, the bids are at its highest. Anyway, you can see here that the green is the bids, the lower it is, the more the bids there are. So the bottom forms when you have the reappearance of support, which is bids, and the removal of pressure, so the decrease of the float and the increase of the dormancy. So yeah, that's basic explanation of everything. I hope you guys got a lot of value from this one. This was useful. All right, let's talk about one of the most important fundamentals to analyze on any project that you're looking to invest in, and that's the community. So community is, I would say, a top 3 component that you need to look into when you're doing fundamental analysis. Now, why is this? Well, a coin is only able to have value if there are people who hold the coin. And it's only able to make you money if more people hold the coin. And that's only going to happen if the community grows. And one of the most important factors for a coin going up is its community growing. And it's the ability for the existing community to attract new people to come in and buy the coin, right? You have to think about who are the marketers that attract new buyers of a coin. I mean, obviously the team is important because they actually build the project. You know, obviously the team does marketing, there's influencers, et cetera, et cetera. But the actual community, the actual holder base are actually like probably the biggest affiliate marketers, the biggest sort of group of people who bring in new holders of the token for these projects. Okay. Now, obviously the team, like I said, is important, but the holders are so important for the coin's growth because they are the marketers. They're on the front end. They are the ones in the trenches tweeting about the coin, making videos, telling their friends to buy, you know, going in other groups and mentioning the coin. Like they're the ones who spread the gospel. They spread the word. And so as you can see here, that crypto is basically a Ponzi scheme because a Ponzi scheme, you make money off of the back of other people who join the Ponzi scheme after you, right? But that's the same thing as making money in crypto. If you find a coin early and you sell it later on, you made money because you found it early and you convinced someone or someone else convinced someone to buy it after you bought it, likely at a higher price, and then you sell to them at that higher price. Now, obviously, Ponzi schemes and coins are a little different because you can be early and you can still lose money, right? And you can join late and you can still make money. A coin can make later buyers wealthier if the coin was to go down 90%, right? That doesn't so much exist in Ponzi schemes, which makes the game a little bit different. But still, the basic concept applies, which is the earlier you are, the smaller the community, generally speaking, the more potential upside because it has, you know, if the coin is to grow to a size of any of these other projects that currently exist, you'd be making significantly more money than buying a community which is already huge. Same thing with Ponzi schemes, right? You want to get into the Ponzi scheme as early as possible. You don't want to be getting in when there's millions of people in the Ponzi scheme because there's just so many more people that you need to get in now in order to sustain all the people that got in before who were early. And this is how, you know, if you're looking at each red dot as a person, you know, you've got each person referring to friends, right? You start with one person, they tell 2 friends, who tell 2 friends, who tell 2 friends. And this is sort of how these communities grow, these Ponzi schemes grow. It's, you know, each friend has a friend and eventually enough friends join where there's no more friends who haven't bought. And that's when the Ponzi scheme and the coin dies. So when do communities fail, right? How does a community sort of drop off? A coin will stop going up in price. A community will stop growing when 2 things happen. You either lose the early community members, so you lose affiliate marketers, because remember, every single holder is basically an affiliate marketer. You make money because other people come in and buy the coin, right? Like, for example, if I buy a coin and I'm a holder of the coin, I don't build the coin. I'm not building the tech. All I do is sort of sell this product. So what I do is I buy the coin at $1 and I go out and I tell everyone, you should buy this coin. And they buy it, let's say, at $2 and I sell it to them at $2. I made money by selling them the product of this coin, but I didn't actually have to deliver on the service, which was the team building shit, right? So you can see that the holders are the affiliate marketers. And a coin is only able to grow if it has enough affiliate marketers to offset, the people that it loses, right? Because as a coin goes up in price, people take profits and they might end up leaving the community. So as the coin goes up and people leave, you need to replace the lost affiliates in order to keep the coin going up. Now, the second reason communities fail is that later on, as the coin is growing, the new people, the late community members, they don't bring in enough new people to sustain the Ponzi to keep going higher, right? So let's imagine like this is the Ponzi scheme, right? The higher it goes, the harder it is for each affiliate to find more people. Let's imagine this is everyone in crypto, right? And let's say a particular coin has been bought by this many people, right? This little red square. It's very easy for these people in this red square to find more people to buy because there's just so many of them. But let's imagine the coin was this many, right? Let's imagine this entire red box here is like red, right? Imagine this whole box here is red. How many potential buyers are there that these affiliates can find? Well, I mean, there's a lot of affiliates, but now the box they're pulling from is a lot smaller, right? There's only so much more growth that can happen. And that is when a coin has really priced in a lot of its growth, when everyone has bought it. And that's why smaller coins make you more money, because they have a larger group of people who will eventually come into the coin, ideally, right? Let's talk about the best community. So the best community has the following, right? They have cult-like fans who never want to sell, and they have cult-like fans who tell everyone to buy. Because if you have this, you have the two most important fundamental concepts of, making something go up in price, which is low supply and high demand. Because it is only supply and demand which dictate prices. At the end of the day, it's all about supply and demand. So what is supply? Well, supply is like the coins. It's the selling pressure. It's coins being sold. What is demand? Well, demand is like fiat currency or stable coins or Bitcoin, whatever it is, going into a particular coin. It's the demand to get into a particular investment. So the best communities in the world are able to do two things. They're able to minimize the selling, so the supply, and they're able to maximize the amount of buying. So they're able to maximize the demand. And so when you're analyzing a coin's community, you're basically analyzing for finding how good they are at these two things. How good are they at minimizing the amount of people who sell, and how good are they at maximizing the amount of people who buy? And you minimize selling pressure through, a number of different things. For example, you might make the holders lock up the tokens. You might create a culture that makes people never want to leave. You might sell the dream of how much higher the price is going to go and why they should never sell. You might create a cult-like community where anyone who sells you're viewed as bad, you're viewed as an outcast, you're viewed as an idiot, right? How do you bring more people in to buy? Well, you have to teach your holders how to sell. You have to teach your holders how to be affiliate marketers. You have to encourage them to bring their friends in, to bring others in. You have to make your holders use the products and services that you build so that the revenue numbers look better, so that it looks like you have lots of users. You have to, encourage your community to go out and spread the word, spread the gospel, right? That's sort of the basics of how you would go about growing a community as someone who's running a project. Something you need to consider when you're looking into these communities is that as the community is growing, as the coin's going up, you're attracting a lower and lower quality of participant, because the type of person who looks for something early that hasn't necessarily gone up in price is usually going to be someone of a higher quality, right? The early days of a new project is where you have the most committed and unique and intelligent group of participants, right? That's when the community's at its strongest, right? Typically, when the community's small, the culture, the vibe, the law is very, very strong, because it's only a small group of people who are generally more aligned on certain beliefs. And as the coin grows in price, you sort of venture out into a subset of people who maybe don't align on as many beliefs and ideas and culture and values as the original community did. And so, as well as this, let's say there's 100 people who the team behind the project have converted into a certain type of community member who believe certain things, who have a certain vibe, and they interact with a certain culture, right? These 100 people now have to, when 1,000 people join, pass on that culture. Because as a founder of a project, there's only so much of the vibe, culture, and law that you're able to pass on, it's not infinitely scalable. Eventually, the community is going to grow so big that you need other people to do the work for you. So for example, when I worked inside of Hustlers University, the largest online education platform on the planet, we once had 0 students. And then we went to having 150,000 students. And the entire way across this, one of the most important parts that we focused on was curating the correct culture. Now, how did we do this? Well, we viewed the entire operation as an army-like structure. So we looked at it as, you got the leader, you've got the lieutenants, the generals, you've got the people who are in the trenches, you've got different levels on the hierarchy. If you want your pyramid to grow, you have to make sure that you have all the different components of the pyramid, right? You need the base of people at the bottom. You need the next in command. You need the next in command. You need the guy at the top. If your pyramid structure ever lacks in a certain area, the pyramid's going to collapse. Okay, so inside of Hustlers University, there was different tiers of people. There was the members, right? Let's draw a person here. There's the normal member, and then above them is the apprentices, and then above them is the professors, right? This is what I was. I was a professor. And then above them is the people who run the business, right? The leaders of the business. And so this pyramid is only able to grow assuming we keep enough people in each level of hierarchy to sustain it, right? So as this base level grows, you need to grow the amount of apprentices, you need to grow the amount of professors in order to sustain the business. Because when you put 100,000 people inside of a Discord community, what ends up happening is that you dilute the law, the culture, the vibe. And if you're not careful, it just becomes this mass of people just spamming shit. And so what we ended up having to do is we had to give these apprentices, we had about 40 of them, we have to really focus on giving them the culture, the law, the vibe, so that they can pass it on to the people below them, right? So in this chain of command, you have the people at the top, they speak to these people, who speak to these people, who speak to these people, who speak to these people. And it is the vibe and the vibe and the law and the culture from the top guy, which gets passed down to each level, and it allows the pyramidal structure to continue to grow. And, why does the army, one of the largest communities, gatherings of people of different levels, take the structure that it does? Well, they figure that if you're trying to create a hierarchical structure that works with millions of people, that you probably should structure it like this. And in our business, we thought, well, they are the best in the world at structuring communities, in creating hierarchies. Why don't we just do what they do? And that's why we did this. And so in all these communities that exist, I'm telling you this to give you an idea of the context of what a community is. As the community grows, if you're not careful as a project founder, you're going to dilute what was originally there, and you're going to end up with thousands of people in a Telegram and a Discord who just ask when token, when moon, when token going to go up in price, and you're just going to sit there like, what happened to our once strong community? It's very, very sad. And this is what ends up killing a community. You get all these tourists, right? You get a large swath of non-culture fit tourists come in and they just ruin the entire vibe. And everything in crypto is about vibe. And whenever developers or smart people who are trying to build a coin get harassed by thousands of retards in a Discord, they go, I don't like this. I'm going to go move my attention and skills somewhere else, somewhere where I'm surrounded by normal people. Because what you need to realize about coins is that the holder base of a token, with a lot of these tokens, is just the biggest cesspool of retards imaginable. There was a NFT mint today for Mochi for its NFT, and they were 10 minutes late with the minting, right? You had to wait 10 minutes after the minting date to mint. And I was on the voice call in their Telegram chat, and it was just so fucking angering. Just this group of retards, like, asking the dumbest questions and complaining, and I was like, man, what a group, what a cesspool of just the worst of humanity in one place. And that's what these coins come as they grow. Just a total cesspool. If any of you have spent any amount of time in a Discord, you will understand how stupid and shit these communities are when the tourists come in. And, you know, if your job as a project is to be able to sustain a strong culture and keep the smart people even as the project grows. And so this is sort of the three sort of stages of what you can expect to happen, right? At the start, it's green, everything's great. Small community, everything's at its strongest. You got great affiliates. You know, the affiliates at the start of the community attract the most amount of people per affiliate. And that allows the project to grow from zero quite quickly. And then you get to like the mid-sized community. The culture's still there, but it's not as strong. You know, there's a lot of tourists and the affiliates are not very good. And then you get to these big communities and, you know, they don't end up building anything. The community turns to shit. All the smart people leave and they go to the next big thing, the next small community. Okay. And this is like a general sort of idea. If you want to make the most money in crypto, if you want to implement the strategy here to make 100x returns, your goal is to find these projects. Okay. When you go and buy Ripple, you're buying this project. Okay. When you go and buy an old coin, let's say, what's a smaller old coin? Something like Decentraland. You're buying this, okay? You want to be focused on finding small, committed communities. That's where the 100x returns are. For example, Toshi. When we bought Toshi, that was a classic example of this one. Now, another concept to understand, this is all the sort of theory behind communities, is two types of holders, two types of community members within an ecosystem. So you've got the dead weight and you've got the useful holders, or I guess useful stakeholders in a particular project. So the best projects have the highest percent of useful stakeholders, and projects end up dying when the community becomes a bunch of deadweight holders. So what is a useful holder? A useful holder talks about the coin, they engage in the community, they're using the different things that the project's building. So for example, let's say the project is a DEX, right? A new revolutionary DEX. A useful holder is using it and giving feedback, right? They're also maybe building projects within the ecosystem. So one of the stakeholders is developers. You know, they help new members basically understand things and answer questions. They create memes, art, and culture, and they stake their tokens, right? These are all useful holder attributes. When the holders are useful, they're able to attract more buyers and they don't take profits, right? If you have someone who's passionate about the community, on average, they will hold the coin longer and to a higher price than someone who is a dead weight holder just trying to make a quick buck. Okay. Now, what does a dead weight holder look like? Well, they buy coins to sell later. That's their only goal. Buy low, sell high. They're more a trader than an investor. They don't care about the community, nor do they want to engage in it. They don't stake the tokens because they just want to dump them quick. They literally don't even look into the coin, and they build nothing to support the project. So I would say that for a lot of these investments, I am a dead weight. I am not a great sort of community member. You know, I'm not fucking promoting coins. I don't pump and dump coins. For Toshi, I think I would be considered a great useful holder. But for, you know, something like, let's say, Solana, I mean, I guess I'm telling people that I buy these coins, but other than that, I'm really not a useful holder. I'm not really using these ecosystems. I'm not staking my Solana because I want to dump it eventually. I'm just buying to sell later. I'm just trying to take money from the market. So I would be an example of mostly a deadweight holder. And yeah, what ends up attracting deadweight holders? Well, basically a number of things. Number one, focusing too much on price and profit. So when coins talk all about the money you're going to make and, you know, all the profit and the coin's going to go to the moon and all this bullshit, you're going to attract a really low quality person who cares too much about money. It's the same thing with dating. If your approach to get girls is to drive around in a Lamborghini and talk about how much money you have and wear designer clothes, you're probably going to attract the type of woman who wants you for your money. And if she wants you for your money, she's probably not going to stick around. Same thing with community. You attract people with money, they're probably just going to want money and they're probably not going to stick around. If you attract people with good times, culture, vibes, changing the future, building something to help other people, you're going to attract a much higher quality community member, someone who's more likely to be a useful stakeholder. Another problem is if you bring the wrong influencers on. So some influencers have a community of people just trying to, you know, flip a coin. Bad idea. You want to invite influencers who will talk about the coin, not just in terms of how much money it can make, but how it's actually going to transform the future. And another problem is, you know, not having an ecosystem, in inviting ecosystem for people to participate in. So you're not going to get a useful holder unless they want to be useful. For example, I am a deadweight holder, but with Monad, I am a useful holder. I'm telling everyone about Monad. I was actually spending time in their Discord. I very rarely do this because I'm so busy doing things, right? But Monad was this one exception where it actually fucking got me. They actually turned me into a useful stakeholder. The fact that they could convince me, someone who never ever gives a fuck about these communities, to be a community member is absurd. That shows you how good the Monad community building is, that they could actually fucking get me. A really core concept you need to understand about communities is that a good community, a really great community, is almost indistinguishable from a cult. And I would say that coins aren't necessarily directly cults, but there is a lot of attributes of a cult which you see in the best performing assets in crypto. Let's imagine a coin goes up 100x. You buy it at $1, it's now $100. You put in 10 grand, you're now a millionaire, right? That's probably your first million you've ever seen. In what universe would you not sell? Actually, a lot of people don't sell when these coins go 100x. And that's what enables these coins to go 100x. Why do they not sell? Well, number one, they're fanatical cult members. So when you're a cult member of something, you don't want to leave. You're not allowed to leave. They would want to see you die before you ever left the cult. And also another thing is people have locked coins. So if you hit 100x, but you're locked for 5 years, in the Hex staking scheme, then it can go up 1,000,000x. You can't sell. There's nothing you can do. So those two attributes is what, makes a coin go up 100x. The most important one, in my opinion, is, how many fanatical cult members are there? So let's analyze a cult in crypto as a case study for, an idea of a good community. Now, I don't endorse you to buy Hex. I think Richard Hart's a terrible human being. He is a psycho. He's manipulative. He's the definition of a cult leader. And I'm going to explain to you how that is. So there's a sort of post here about Hex. It is a bit of a scam, in my opinion. Now, does that mean you can't buy Hex and make money from it? No, you can absolutely make money from Hex. I know people who've made millions from Hex, but you have to be careful with these sort of coins not to get sucked into it. So what Hex does is they use expertly created FOMO marketing tactics. They build a cult-like group around itself, and they use deceptive numbers and comparisons to make it seem legitimate. So Hex is a very interesting project. What they do is you basically lock up your Hex tokens and they give you a return on your money, right? You lock $100 and they give you X% a year. They compare this staking process, this yield generation process, as the first high yield blockchain certificate of deposit. So they call it a certificate of deposit, right? The difference between a traditional certificate of deposit is that when you lock up, let's say $1,000, they go off and they lend that money to someone else. That money that is lent to someone else, they have to pay back with interest. So that you lend someone $1,000, they've got $1,000. In a month, they have to pay back $1,050, right? For example. So when they hand back $1,050, you would receive extra money than you put in, right? Maybe you split it 50-50, right? And you get back $1,025 a month later. So you made $25 profit. That's what a traditional certificate of deposit looks like. But with Hex, you lock up your tokens. Where do they get the money from to pay you out interest? They just print more tokens, which is completely fucking retarded. They literally print more Hex to give it to you. So there's no yield generation, it's just inflation. There's no loans, so there's no actual genuine value, and there's no utility because it's not being used for anything. It's just printing money for the sake of printing money. And if you look into the history of Richard Hart, he has a history of getting him involved in these sort of in similar things to this. And he has a history of I think he used to be a hypnotist or something, right? And if you look at this photo here, you can sort of see it, right? So let's look at some characteristics of a cult right now that we've gone over Hex. They're focused on a living leader to whom displays excessively zealous, unquestioning commitment. That's exactly Richard Hart. The group is preoccupied with bringing in new members. So that's all they talk about, bringing in new people. They're all preoccupied with making money. That's all they talk about. You're not allowed to question anything, right? You're not allowed to have doubts. For example, I put a video out on YouTube called How This Man Scammed the Whole of Crypto. And this was my most hated video on YouTube by 10x. And all the comments are saying shit like, you made me want to invest in PLS. Thanks, Glauny. Misinformation, misunderstanding. Buy some Hex. Right now is the best time to buy. I've made a shit ton on Hex, even though it's down 99%. Guess you missed the boat. This token will exist for forever with or without RH. Great clickbait though. Like there's so many fucking comments hating on me, and everything I said in this video was completely reasonable. Now, some people agreed with me. And look, this guy's like, have you taken the time to understand the code? You know F all about Richard Hart and Hex. This guy is absolutely clueless. Funny how you did not debunk the arguments of Richard. Quotes use to frame it. So you can see here that everyone was hating on me in these comments. And what was the characteristic? Questioning, doubt is not allowed. I'm not allowed to question Hex. It just is great. Another thing was the group is elitist. So right, they view themselves as better than everyone else, and they say that they're the hexicans, right? If you hold Hex, you're a hexican. And they view Richard Hart as this messiah, this god who's going to lead them to endless money. And another really important part is that it's very polarized in terms of an us versus them mentality. So it's like when Andrew Tate says, like, the Matrix is attacking, you need to escape the Matrix. It's a very much a cult-like characteristic where you're either with us or you're against us. It's us versus this invisible force which is trying to take us down, right? And that's what Richard Hart does. It's like, oh, everyone in crypto wants us dead, and no one understands Hex. They don't want you to make money, blah, 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 blah. Now, here's a little bit of a summary of what I just said. Charismatic leader, holders are focused on attracting new buyers, questioning is punished, elitist, holders are called hexicans. It's an us versus them mentality. They think everyone in crypto is against them. And this is a good little post on Hex as well. So you can see here that Hex stakes average 38% returns. It's from printing new tokens, inflating the supply. Hex went up 9,800%. Past performance does not dictate future gains. It's misleading. 12th in market rank. It's currently 201 in market cap, so it's misleading. He basically buys expensive shit to show people that he's so rich and that he can do the same for them. And there's a number of other red flags it goes over. This is an old post, but it's still interesting. Now, I'm not saying you shouldn't buy Hex. I'm not saying Hex is a bad investment. Disclaimer. You don't hate me if you're a Hex cultist if you watch this video. I'm just trying to explain to you, what makes a good community. A good community is a cult. Hex was a cult. It was probably the best performing token. As you saw, it went up 9,500%. So 9,500x, which is an absolutely insane return, right? Hex was probably I think it was the best performing asset in all of crypto, as far as I'm aware, one of the best, right? And it was a cult. That was one of the main factors. It was Richard Hart's ability to create at scale a cult community, right? Even though this coin was so big, it was still a cult. Now, I want to go over another case study of a really good community, and it's a project called Monad. So Monad's a layer 1, like Solana, like DOT, any of those other layer 1s. It's the same sort of shit. And they're building one of the strongest communities right now in crypto. And this is the project that I said I actually became a useful holder in. So let's look at the founder's Twitter account. What does he call himself? He calls himself the cult leader of Monad. What did we just say about cults? We just said that the best cryptos are cults. He views himself as a cult leader. I want to show you some sort of experiences that people on Twitter have had with Monad, which can sort of support what I'm saying here. The Monad Discord is an experience. Keone pops in from time to time to answer smart or silly questions. Bill is constantly shipping new events. Discord vibes and culture immaculate. Community is a ground layer for any crypto project. When I was forming my Solana thesis, the stickiness of the community, users and builders was the most heavily weighted criteria. In my book, Monad scores 9 out of 10 on this metric. Got to survive the test of time and FUD to get to 10. So Bill talks about here, the founder of Monad, 5 ways to spot a ripping community. Community is a strong reflection of a project's potential. So here's the 5 things. Time to last message, quality of the chat. This is a big one. So if you join a chat and it's just when token, when moon, when update, why is the coin going down? Shit community, avoid. If you join a community and you can't understand what's being said, that's a really good sign, because it's showing you that there's a culture and a specific law that exists that's been curated. And it's showing you that they're fucking passionate. They're passionate about this coin, and generally only smart people are going to be able to, run a project where they create their own law. And it's a good sign of the quality of the team behind the project. And like he says here, do they have an insider language? That's a really, really crucial component. Have they invented their own slang? If you go in Monad, they've got like 50 of their own slang terms. Do people feel like they know each other? Visual language. Do they use distinctive emojis, stickers, memes? Comments on posts. Whenever you see people talking about a particular coin, are they all saying the same thing, or is there depth to the community and what they talk about with the coin? Social proof. You know, how many smart people are in the Discord? That's obviously another really big one. So yeah, I think that's a pretty good overview of community. Now let's talk about this guy's post. He says that he's really excited about two ecosystems. It's Monad and Berachain. They share one really important thing that makes a lot of projects succeed, and it's a really solid community. One of the best examples of a solid community is Solana in the last bull run, and also this bull run. Solana is the only token that has shown this bull run that it has the possibility to achieve multi-cycle outperformance. It's also the top 3 in terms of developers of any coin in the crypto ecosystem. I think it's got a top 2 DeFi ecosystem. It's getting close to being better than Ethereum's DeFi ecosystem. So Solana has one of the strongest communities in crypto, and that has led to what you would call the stickiness of the developers, of the holders, of the builders of this ecosystem. And that's what you really, really want to see for an investment in crypto, that people don't want to leave. Even if the coin goes down, even if a bear market comes, even if times get tough, do people stick around? And right, another way to look at it is like, if you're with a girl and times have been really tough and she's still stuck by you, that's a wifey, right? That's someone you want to stick with. If a coin went through shit times, went through a bear market, went through a lot of FUD, and the community stuck with it, that's a wifey. That's a coin you want to put a ring on. That's something you want to hold for the long term. Let's talk about the Monad community. So this is the Monad Discord server. If you go into the general chat, you can just basically get a little bit of a vibe for it. So you can see that everyone in the Discord has a Monad-related profile picture. So Monad is the purple frog, okay? That's like their vibe. And they have their own little culture, right? They're all sending particular types of memes. The chat is very active. This one isn't as active as it usually is, but you know, you can see people are talking. There's a newbie chat, which is always popping. And if you go into the trade and DeFi chat, it's actually really high quality. There's a lot of smart people talking in here about the markets. Now, they've also got a Mon artist room, so you can see how much art is being sent. This was about 2 days ago, so you can see how much has been sent in the past couple of days. There's just tons of art being created. Memes, tons of memes being created. There's just thousands and thousands of memes. This doesn't even have a token yet. There's a room where everyone shares tweets about Monad, and basically everyone just engages with these tweets, and that just basically allows for just hyper growth, right? Remember I said the best projects teach their holders how to be good affiliate marketers. Well, they basically say anyone who tweets about Monad, put it here and everyone will engage with your tweet, right? So it just creates this hyper network affiliate Ponzi scheme growth effect where everyone just retweets each other and just grow into infinity and take over all of crypto. There's a voice channel. Every time I come in here, there's people in the voice channel talking. That's always a good sign. And yeah, so that's a bit of an overview of the community, right? Like that guy Bill said, those are the main attributes you want to look out for. You want to see that there's a unique culture, there's a vibe. People have their own. Everyone has the profile picture of the fucking frogs. And yeah, that's what you want to look for. How do you spot a strong community? So we just sort of went over that, but I've got a few more things here. So does the token have outlier price action? One of the strongest communities of this bull run was Kaspa, and we talk about how Kaspa, at the exact Bitcoin bottom in November 2022, Kaspa hit new all-time highs, and how Kaspa has had its own price action this entire bull run. And the reason it's had its own price action is it just has a very, very passionate, strong community. Does the project have its own unique culture, law, vibe? We've sort of gone over that. Is there a die-hard core holder base who can't stop talking about the coin? Well, go on Twitter. There's people who just can't stop fucking tweeting about Monad. Even I couldn't stop talking about Monad for like a month. How much of the supply is locked? I mean, in Monad's example, there's no token, but for example, Solana, how many Solana is staked? How active is their Discord or Telegram? Is it just retards asking basic questions? So as you could see in Monad, there was a much higher quality of conversation. It's not just when moon, when token, when. It's people like just talking shit. It doesn't have to be high quality. It could just be people talking shit. See, look, this is like high value conversation, right? He's sending shit. Is there a thriving developer ecosystem? How quality is the developer talent that they attract? So Pancakes Bra was one of the founders or co-founders or original team members of Friendtech, the social trading platform. And they fucked him over and he left. And the day he left, he got hired by Monad, which is a really, really smart play because this guy has basically, you know, being on the team of one of the fastest growing protocols in crypto, which was Friendtech, which made them tens of millions of dollars. And now they want him on Monad. So Monad is basically just poaching all of the smartest developer talent in the market. And we're going to get into why builders are important for a project's success. So yeah, you want to look into the developer ecosystem. This guy would not have gone and worked at Monad if he thought Monad was shit. So clearly Monad must be good and have a strong community, have a strong vibe that he wants to be a part of, because developers want to be a part of communities, right? That's why they fucking build things. They want to be around people who build cool shit, right? There must be something here that you need to look into. Another thing, is the team actually good at community building and scaling culture? So for example, Solana, I think, is a good example of scaling culture. And I think Monad is too. So what Monad did as an example of scaling culture is to be able to get into the entire server, you start off in the newbie chat and you have to prove that you're a human. So proof of human is just done through conversating in the newbie chat. You conversate in here enough, the mods recognize you're real, they add you into the rest of the server. And even beyond this, there's a private 999 person Telegram chat, which you only get access to, assuming other people have been kicked out, and that maybe you have to be good enough in the rest of the community to get in. And I'm not even in there yet. Okay, and I advise $50 million in assets, and I run a pretty solid brand online, and I'm still not in there. So that's to show you how tough it is to get into this sort of room. And the reason that this relates back to scaling culture is because they don't just let 3,000 retards enter the server, they're able to make sure that each person within this room has the basic foundational level of culture to then go on into the rest of the rooms, right? Because if you add 3,000 people without the culture, they're going to out-talk the ones with the culture, and it's going to completely fundamentally change the conversations that happen, and it's going to lower the quality of conversation massively. You need to ask yourself, do these projects have filtering mechanisms? Are they able to scale culture? This is one method. There's a number of ways that you can go about scaling the culture and making sure that everyone's on the same page. How much engagement does their social media get? So if I go on here, right, this guy's got 4,000 followers. Let's see how much engagement his tweets get. 100 likes, right? 150, 120. 130. What about this original tweet over here? How much? Okay, not too bad. What about Monad? Let's see how much engagement Monad gets. They have 140K followers. They get 2.5K. They get really good engagement considering the amount of followers they have. Another thing is, has their community changed their profiles to project specific imagery? If you go on to most of the tweets on things related to Monad, you'll see that everyone in the comments is engaging, and a lot of them have these specific profiles. Now, if you go on Discord and you go into the chat here, you can see that most of these people have the Monad profiles. You can see this guy does, this one does, it has the Monad hat. Is that one good? Yep, that's a Monad one. A lot of these are Monad ones, but it's sort of hard to tell, right? Like, that's probably a Monad one, but it's sort of hard to tell. But the Monad vibe is basically like a purple Pepe, right? Any of these purpley pink color ones are probably related to the sort of specific Monad culture. Okay, so you get the idea. To summarize what I've just said, the community is one of the most important components of, fundamental analysis, because it's ultimately the community which does most of the marketing in order to attract people to buy the token. And the community are the people holding the token, and what they do with their tokens is the most important. If a community is weak, they will sell a 2x. If the community is really strong, the token will go 100x and they won't even sell. And the goal is to find small coins with really strong communities, really passionate people with their own culture, their own lore, where the team is a master at selling the dream. They create mass hypnosis like Richard Hart. They are able to create culture at scale. They're maximizing for attracting and creating useful holders, and they're able to curate a thriving developer ecosystem, right? If all of those components are able to be ticked off and the coin is early, then you have found a gem which is worth accumulating, okay? And it doesn't really matter what sector of the coin is in. If there's a diehard community behind it, it's there for a reason. They must think something is being built here. And so the bigger the team can grow their Ponzi through having these things, which is like super important, the more money that you can make, the higher the token price is going to go. So finding a strong community is all about getting your hands dirty as well and navigating through the trenches. So how are you going to figure out if a coin has a good community? Well, you're going to have to get your hands dirty. You're going to have to do what I do, like go into the Discord, spend time conversating, right? Follow the Twitter, Discord, Telegram accounts of all the social medias of this particular project, right? See what is it quality people, right? What type of people hang out here? If you're trying to find a wife and you're in the club and they're all hoes, you probably shouldn't be there. If you're trying to find a wife and you're in the mall and there's wives everywhere, then that's where you should be hanging out. And that's what you should be spending your time on. So, is there high quality people in the community? Cool. Probably something you should look to invest into. A strong community must be felt through first-hand experience. And I want to relate something back that I forgot to mention to the importance of developers. Developers are incredibly important because it's the developers who build the shit that people end up using. And Microsoft, there's a guy behind Microsoft who I think he was like one of the main like sales guys behind Microsoft. I think his job was to like motivate all the tech guys. Not sure exactly, but basically there's a recording of him here where he's just shouting the word developers over and over and over again. And I want to show it to you.
Okay, so what is the $64,000 question? Holy cow, I'm going to have to tough it up now. Here we go. What's the $64,000 question for the field? What is the most asked question that I've received this week? What the hell are we supposed to do about .NET, Steve? It's a very good question, and it's got a very, very clear answer. Developers. The key to .NET, the key to industry transformation, the key to success is developers, 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 developers. Yes.
So basically, I hope you could hear that. What was the key to building the internet? Well, it's developers, because developers build the shit that you use. What's the key to building a successful crypto project? Developers. How do you bring developers? Well, you need a community. You need a strong community. You need a certain culture and a vibe and a law that attracts nerds to build shit. How do you attract the community? Well, you also need developers, right? How do you bring smart people together? Well, you need smart people. How do you get those? Well, you need smart people. It's like a chicken or the egg problem. But look, developers are important because they build the future. So when you're looking at a project, you need to look at how much of a thriving developer community is there. This is why Solana has been able to come back and make a major comeback. It's because it has a thriving developer ecosystem. Every year, they have these hackathons and they have a Breakpoint conference. And the hackathons and the Breakpoint conference are consistently year over year, even if it's bull or bear market, attracting not only more developers, but more just general participants of the conference. Okay, there's more projects building, there's more submissions for hackathons, more contestants. It's all just up, up, and up. And that is what has been able to have Solana be successful. It's attracting this developer and community that these other protocols aren't able to build, right? Outside of Ethereum, all these other layer ones have been shit. Neo, Cardano, Ripple, they're all shit. But Solana comes along and it actually has a chance at dethroning Ethereum because of the strength of its community and how much its developer ecosystem is thriving. Okay. Another way that you can look at building a community is making your holders rich. This is one last point I want to make. A community is strongest when its holders are all in profit. So if you have a token where you made all the VCs rich and you haven't made anyone from the actual community rich yet, they're not going to be super passionate and strong about the project. If you have a token where everyone who bought it has made money and it's just everyone's super happy and excited and made a bunch of money, that is a much stronger position to be in as a community, as a project, than if you fucking give all the money to VCs and the token's down 90%, right? Why is it that after a token has dropped 95%, it very rarely goes to new all-time highs? It's because they've just destroyed the community. They've lost the community all this money and they don't give a fuck anymore, and no one wants to buy that. You've lost your affiliates, probably. The diehard core holder base is probably left, and no one wants it anymore. Solana managed to escape this, I think, because it actually just has such a strong community that the price doesn't matter. But for most of these coins, the price is everything. So making your holders rich will build the strongest community of diehard fans because you did something for them. You helped them make money, they will help you. When you're looking for coins to buy, if you're looking at something that's down 95%, the odds are against you. If you're looking at a new, fresh, hot token where it's near all-time highs, the whole community's made money, that's a fucking gem potentially. So yeah, that's everything about community. Hope you guys found this one interesting. Was a lot of depth to it, but there's a lot to cover in terms of community. All right, so another one of the fundamentals that I look into when I'm analyzing a project is the initial distribution. Sort of beyond the initial distribution, the ongoing distribution of a project. And this one no one really talks about online except for a guy called Loomdart. And he has a really interesting tweet, which I think summarizes the importance of initial distribution really well. So much of a project's success or failure stems from its initial distribution. As more and more stuff moves on-chain, I feel like this will become a more important part of each project's story as people and projects eschew private funding for more open but more fair methods, and the typical distro and yeet and RDO method doesn't work as well as it once did. So basically, to turn this into understandable words, there's a number of different ways that you can launch a project when you release the token. You can do an airdrop, you can do a pre-sale like an IDO, or you can get VCs in, more private sort of investing, like a private sale, or you can basically make it open to anyone who is mining or liquidity providing, like providing value, and you give them tokens in exchange for that. There's a number of different ways that you can basically give the initial tokens distributed to your community. And there is successful distribution methods and there's unsuccessful distribution methods. And the projects which can get the distribution correct at the start are the ones that tend to do the best, okay? And when you're analyzing whether you should invest into a project, generally more so the newer projects, one of the key factors that you want to be looking at is how did they initially distribute the coins to their holder base? Because it is important, and we'll get into why that is, okay? So as I just said, there's a number of different ways that you can distribute tokens, right? You can do airdrops, initial DEX offerings, security token offerings, various reward mechanisms like mining and staking. And yeah, each one has its pros and cons. Regulation isn't a component. The difficulty of organizing it is another one. But yeah, there's a number of different advantages and disadvantages. So here you can see that Bitcoin, when it launched, it gave away tokens through mining. You mine Bitcoin, you get Bitcoin, right? There was no pre-sale for Bitcoin. There was nothing. Ethereum did an ICO. ICOs generally are not favorable, but I think it worked due to how early stage the ICO was and due to how good the project is. Uniswap, they did an airdrop. Compound, they did liquidity mining. And Yearn, they did a fair launch through liquidity mining as well. Okay, so there's a number of different examples here. Now, a token distribution structure allows crypto projects to apportion tokens to various stakeholders. So what you need to understand is that with a crypto project, there's a number of different stakeholders in that ecosystem. A stakeholder is someone who holds a stake in the success of a crypto project. So a miner and a holder and a team member all are different stakeholders, but they all have the same underlying goal, which is to see their project have success, right? That they're supporting. So you could say like, here's a stakeholder, here's a stakeholder. There's all these different people, right? But they're all connected to each other because they all rely on the success of the project for them to make money, okay? And you need to reward the different stakeholders correctly in order for your project to succeed, and that is done through the initial distribution. So do you just reward, let's say this is the miners, do you just reward these people, the miners? Do you just reward these ones? Do you just give all the money to the people who are, through an airdrop farm? Do you just give all the money to the team, to the VCs? Who do you give your money to? You need to think as as a crypto project, who are the most valuable stakeholders and how do I reward them in the best possible fashion, right? So the stakeholders are, as we just said, VCs, founders, community, insiders, the public, and the foundation, okay? So there's a number of different stakeholders who all want to see a project succeed, and each stakeholder has a different level of importance to seeing a project succeed. Okay, and it is a bit of a balancing game to get the initial distribution right. Okay, token distribution is not just a launch strategy, but a defining element that shapes the entire lifespan of a crypto project. From outlining the tokenomics to the final stage of community distribution, each step is crucial. Now, I want to emphasize this point again. The initial token distribution is a defining element that shapes the entire lifespan of a crypto project. It is so important to get right, and it's so important that when we use it as a tool to analyze the fundamentals of a project, that we need to consider it as one of the many fundamental characteristics that we look for. Okay, so why is the initial distribution so important? The people who hold a project's token are vital to its success, right? The stakeholders are vital, the ones that we just went over. So why? Because the holders, the stakeholders, are the main source of new buyers, right? And in particular, I think rewarding the community, the public, as much as possible. The people who actually support your project, right? So the people mining it, the people who are just like a part of the community. Rewarding the people who are providing the most value is really important, because these people who provide the most value are the main source of new buyers. So for example, if you're launching a project and you're looking for the best people to support your project, maybe that VC who just wants to flip a bunch of coins and doesn't care about supporting you is not a good person to pick, right? Maybe the high level guys who are just wanting to be involved with the community and love the idea of the project, and they just want to tell everyone, and they've got a brand on Twitter and they just want to tell everyone because they really love the project and they want to be a diehard fan. Maybe that's the guy that you should reward, right? You want to reward the people who are going to be the best fit inside of your project, who are going to provide the most value. Okay. And I have a term to describe that I just came up with in this video of basically how much value someone provides. And the word that I use is a community building score. Okay. So if you give and you reward during the initial distribution the wrong people, you're rewarding people who have a poor community building score, right? Because when you think about it, your holders are your affiliates, right? Everyone who is a stakeholder is essentially an affiliate for the crypto project, for the token, right? Because it's like a Ponzi scheme, right? When the project launches, maybe 100 people know about it. They all tell their friends, they build things that attract people, and that brings in maybe 200 people, right? These people are the early investors, and then they invite the next 1,000 people. And then if you do it right, these people love the project, and then they invite all of their friends. And the Ponzi continues for as many people that you can basically sucker in to buy. How do you determine how many are going to come into that particular coin? Well, it depends how good you can build communities. It depends how big you can scale it. Depends how good the tech is, depends what sector you're in, depends on how big the bull run is, depends how many competitors you have, depends on a lot of different things. But one of the main contributing factors is obviously that initial distribution, right? If you reward people at the beginning of your project who are the least likely to support your project, it's going to be very hard for your token to perform well, because you've given your token into the hands of people who are more likely to sell it and are less likely to promote it and bring in that demand that you're looking for, right? What you want to do is you want to reward through the initial distribution the holders who are the least likely to sell and the most likely to bring new people to buy. So maybe there is a VC, for example, Paradigm, who is really good at structuring incentive mechanisms and airdrops to basically beat competitors. So you maybe want to bring Paradigm on, not because they're going to promote your coin, but because they know how to attract users through airdrop campaigns, right? So that's a good example of a VC. You want to bring them on and give them allocation. Maybe you don't want to bring on a bunch of shitty influencers who are just going to talk about your coin and dump the allocation as soon as they get it. Maybe that's not a good person to bring on. Maybe you shouldn't reward the airdrop farmers who make 100 wallets and they farm it from a bunch of different accounts and they just want to dump the token as soon as they get it to cover their cost. Maybe you shouldn't reward those people, right? It is really important who you make rich and that you make the right people rich in the initial distribution. Okay. And so when you do a fair launch, right, when you fairly give away basically the initial distribution based on people doing actual things that provide value to the network, right, you're rewarding people with better community building scores, right? If you want to encourage people to do more good things, you reward the people who are doing the things you want to see. Imagine it's like children, right? You have a kid who's being naughty. How do you stop them being naughty? Well, you have to encourage the behavior that you want them to do. So if you see another kid, let's say there's like 3 different kids, right? One of them's being a little shit, one of them's being good. You reward the kid being good and you don't reward the kid doing bad. Why would you reward the airdrop farmer who's farming with 100 wallets? Or why would you reward the kid that's playing up and running around in the mud and throwing it at other kids when he's not doing what you want people to be doing, when you're rewarding the wrong behavior? So in the initial distribution, reward good behavior, which is, fair launch. Reward the miners, reward the early people into the community, reward those who provide value, right? And there's a couple projects in crypto who do a really, really good job of the community building. I think the best recent example of a good community builder is Monad, right? So this guy, Bill, is the co-leader of Monad. Also, the best projects in crypto are cults. So it's funny that he says that. And he basically says that good community creates more community. It's infectious. And this is true, right? The best projects in crypto have really strong communities. The community is everything. Now, this is not a section on community. We'll cover that in the community one. But this section is about the initial distribution, which is a core component in building a strong community. When you launch a coin and it was done through an IDO, or let's say an ICO, an initial coin offering, or an IEO, an initial exchange offering, where you're basically giving a bunch of random people who don't care about your project all the coins. They don't give a fuck about the community. They don't give a fuck about the coin. So you can pick 1,000 people to give your coin to when you launch it. Why give it to the people who don't even care about you? Because you're giving it to people with the lowest community building score. You're basically setting your project up for failure. You got to reward the loyal people, the ones who are doing the things you want the people to be doing in your community. And, a good community, when done right, it brings more people in because people want to be a part of it, especially in crypto. Crypto is just all community. There's no value. It's just all community. And yeah, again, it's a Ponzi scheme. The better your affiliates, the bigger your Ponzi scheme can grow. How do you get good affiliates? Well, you reward them and they will keep doing good. So holders with a good community building score are able to bring in large amounts of new holders or contribute value, which attracts new users. So there's 2 ways. They either do marketing or they build shit, which brings people in, right? That's the best possible outcome for, good community score people. And 100 core diehard holders is infinitely better than 1,000 pre-salers, just looking to basically pump and dump by getting a ICO allocation, right? They don't give a fuck about the coin. Look at all the ICOs and IEOs that died. Why'd they die? It's because they fucking gave it their coin to a bunch of people who don't give a fuck. It's like, imagine a girl who just fucks any dude, right? No one's going to take her seriously. No one's going to wife up a girl who, and I don't want to make this really like sexist or anything, but like if a girl just fucks every guy, imagine a girl who fucks every guy. No dude wants to take her seriously for obvious reasons. But if a girl is hard to get, if she really protects that side of her and, only wants to give it to the right person, the person that she gives it to is going to respect her for that so much more and is more likely to stick with her because of the value and the respect that they've created between each other, right? If she gives it to someone who respects her, they're going to respect her back. If you give coins to the people who bring the most value, they're going to give you value back. It's the same concept. You want a diehard loyal fan, not a bunch of people who just want to fuck you and dump you. And that's what, when you do IEOs, ICOs, VC stuff, that's when projects tend to run into a bit of trouble there, okay? And it's a bit like that movie Spartan, the 300 or whatever it's called. They basically took on multiple armies. And obviously it's a movie, but it's a good metaphor. They took on multiple armies significantly bigger than theirs with fucking elephant, fucking arrow shooting things and like just armies that just could not object. Like when you look at it, they just could not beat them and they won. And it's because a specialized army of 300 diehard, loyal, never going to back down people are going to build a community way bigger and way better, a project way more successful than 1,000 people who don't give a fuck about the coin, right? So the stronger the foundations, which is what we're referring to, the initial distribution is the foundation. The higher that you can build, it's like a house, right? You want to build a big fuck off skyscraper? Well, you have to understand that underneath the skyscraper is a bunch of rods going deep, 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 meters upon meters into the ground, which allows for the building to be built on top of it, right? You look at trees, right? The biggest trees that currently exist in the world. That's my tree drawing. I hope you like my tree drawing, right? They have root systems that you could fucking never imagine. Big ass root systems to basically hold up the tree. So if you're a community with a very weak root system, a very shitty initial distribution, you're not going to be able to build very big
because you don't have the foundations to do it. Okay. And this is why we use it as a fundamental tool, because if we come across a coin which is small and it only has, let's say, 100 core diehard holders, diehard, absolute ride or die holders, then we have found a very, very promising coin, right? Because what you want to find is this. Let me show you a drawing, right? Let's imagine this, right? A pyramid can only go as high as the foundation is wide, right? Eventually, the pyramid curves in and it hits a peak. And the wider the foundation, right, the further the peak can go. So when you find a coin and it has 100 diehard holders, what you're basically looking at is a coin which has this. And you make money by buying the coin here, right, in this region, and selling it when it runs out of new buyers, right? Once it fills the rest of the pyramid in. You want to get into a coin when it's in that foundational phase. You want to get into the pyramid at the bottom. As the pyramid gets built, you want to get out of the pyramid before it hits the peak, right? This is how I would view investing in crypto. And so if you find a pyramid which is really weak, let's say the pyramid did a fucking ICO, right? Some ICO and all the VCs got coins and they gave coins to shit people, right? A shitty initial distribution. It's a really weak base of a pyramid. It's going to look like this. And thus, the pyramid's only going to grow potentially to here before it would collapse if it went any bigger. Whereas if you find a coin with a really good, proper, fair launch, really great community, super strong, they reward the right people, blah, 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 then it would look like, a really strong base and it would go up really high. Okay, so that's how I would view it. You can only go as high, right, as you can build your foundations. So let's go back to the community building score. Community building score is a term I just made up. It describes the value add of a particular member to the project's success. The holders, for example, are the main marketers of a project. Without them, you can't scale your growth very far. You need your affiliate marketers, your holders. You want to make the right people rich, as the more holders you have with great community building scores, the better. Like we just said, if you had 300 fucking Spartans, the pyramid has very strong foundations. You can grow it very far. When you make VCs rich, the bad VCs, you are rewarding usually the least valuable contributors to a project. What do they provide? They just basically get tokens and dump them on the market once they get unlocked. They don't do anything, most of them. When you make ICO/IEO participants rich, you are usually rewarding the least valuable contributors looking for a quick pump and dump. So, there's these platforms like Seedify, I think it is. They basically, you buy their token and you get access to launch pads. Do you think people care about the fucking coins that they buy? Look, live pools, Farcana, you can invest in this. No one looks into the project. They just fucking buy it, and if it makes them money, they sell it. They don't care. Okay, you're rewarding the wrong people. The goal is to make your best holders rich so that they become diehard, soul-locked fans who are ride or die. Okay, the best thing you can do to make someone love your project is to make them a bunch of money. Okay, you want to give them value from making them rich, and they will never fucking leave if you do it right. Okay, like imagine when you launch a coin, right? You're giving a random sample of 500 people your coins. So are you going to give it to 500 people who are just ready to dump as soon as their coins get unlocked? Or are you going to give it to people who are diehard fans, who are going to basically join the cult? Who are you going to give your coins to, and who's going to give you the most value, right? You can choose 500 super passionate people, or you can reward a bunch of pre-sale flippers. The best communities are cults. You create cults by rewarding correct participation and rewarding those who put genuine effort in. In crypto, there's 99% of coins are worthless. The only thing that really matters is the people behind it. When the tech isn't mass adopted, when there's not much you can do, and the only real use case is speculation, the only thing we can really speculate on, it isn't, this thing's getting mass adopted, it's going to get more users. No. The only thing you can speculate on is people. So how big do I think that people can build this thing? How strong is the community? And what might happen? Will they maybe get adoption? And rewarding the right people sets your project up for the best possible future as you create the strongest community, which aligns the supply and demand dynamics best in your project's favor. The best coins are cult. Now let's look at some examples, okay? Good initial distribution. So Bitcoin, earliest coin, the first coin that was ever made, first cryptocurrency. You got Bitcoin by mining. That's the only way you've ever got Bitcoin, through mining. There's no pre-sale, there's no ICO. Satoshi never moved his coins, as far as we're aware. He never made money off this, as far as we're aware. Everything about the initial distribution was fair, and it rewarded the most valuable contributors, which is the miners. Right? At the start of the project, it's the miners. And you can obviously know what the Bitcoin chart looks like, right? It shows you how good it was. Kaspa is another great example of a launch. So they did a fair launch at the top of the bull market in 2020. I think that was the top of the bull market, or maybe it wasn't. Yeah, it was the top of the bull market. And they did no pre-mine, right? So the project didn't get any allocation from that. No pre-sale, so there's no VCs. And there's no coin allocation, so there's no like fucking people waiting to dump, right? It's 100% decentralized, open source, and community managed, right? They gave the coins away to the people who are going to be providing the biggest community builder value. I think that's what I called the term from memory. And you can see here the price chart. It's up 100x. This was at the bottom of the crypto market, right? This is the exact, pretty sure this was like the exact bottom region. You can see that since then it's been up, a little bit down, up, a little bit down, up, a little bit down. And it's performed pretty much every single cryptocurrency besides a couple, maybe like Bonk. It's been fucking ballistic, this thing. It's insane. Why? Well, obviously the tech's good, but a large part of why this has done so well is the fact that it was a fair launch. Now, the other part of fair launches that's interesting is when you do a pre-sale, you are basically, okay, let me show you something. You're going to love this. When you do a pre-sale, they do multiple rounds. So when the VCs get in, there's multiple rounds of valuation. So the first round might be here, the second round might be here, and the third round might be here. And the line, this little line thing is to show you this is the value of a coin pre-launch. And then by the time the coin finally launches, most of the upside's been priced in. So the VCs capture majority of the uptrend through the continually higher raises. And I can see this with a project like Monad, for example. That one's going to launch soon. And I reference this as this was a recent one. Their first round was at $75 million, right? $75 million valuation. And then I think their second round was, I can't remember, but I think it was 300 to 400 from memory. But I don't remember the exact number, but it doesn't matter. So let's just write 3 to 400. And then they want to raise it another round. And I think this one's going to be around $1 billion from memory. Now, I can't remember exactly again, but it might be 800 million. It's something around there. But the idea is that this is pre-coin. Most of the upside gets priced in. And by the time the initial distribution occurs, all the VCs have already made all the money. Whereas when you have a coin to a fair launch, you are able to get in at this level. Instead of it being a sort of VC exclusive game, the coin launches here and it's liquid immediately, and you get to capture that VC gain. So you can see in the chart, right, over here, Kaspa went up really well. But if you look at every single VC coin, they all did this before it came out. This was the value of the VC coins before they got a token through the raises that they did pre-token. So fair launches allow you to get access to coins at prices that VCs were going to get access to them just simply by being a part of a fair launch. Okay. And that's why these are able to go up so much, because they launch at such more fair valuations and you're able to get in early at a liquid price publicly. Okay. Now let's look at a bad initial distribution. So Blur, I made a bunch of money on this. I made like 100K US plus farming this. And that's great for me, but that's really bad for for this coin's success, because what do you think I did when I got these coins? What do you think I did when I got 100,000 US of Blur? I sold it all. I sold like 80% of it. Why? Because I fucking made $300,000 and I don't give a fuck about this Blur coin. I don't know what the fuck this coin does. I just know that it's a token of OpenSea, of an OpenSea competitor. I don't want this shit. I don't even know if I like the coin. So I just sold 80% of it. And you can see the price chart here. It went down 90% from here to here. It was an 88% drop. Okay. And this was during a good market, right? The market was going only up with brief pullbacks, but Blur still went down 90%. That's a terrible distribution. Going down 90% when the market's going up. How shit does your coin have to be? Now, why was Blur so bad? Well, basically, Blur was heavily airdrop farmed. So the people who got rewarded were basically whales who were farming points on the platform, right? And they had a huge cost basis because it was very expensive, because you had to pay ETH gas fees, right? This was on the ETH main chain. And you lost money basically from NFTs that you bought high and sold low. So the whales had to dump it immediately to basically cover their cost basis, right? And as well, there was a second season of the airdrop after the first one. And all the people who were going to buy Blur were instead farming to get free Blur. So they were all using the Blur platform, right? Buying and selling NFTs to get points. But they weren't buying the Blur token because they were trying to get it through season 2 of this airdrop, because they thought, I can buy Blur or I can just farm blur points and get more blur. But that basically removed all the buy liquidity, right? All the buying pressure was gone. All the people who were going to buy it didn't. And now the token fucking crashed, right? So now, yeah, you get this big airdrop of 100,000 blur, whatever it is. Well, now it's not worth much anymore. And as well as this, the initial distribution was a whale game. So who got rich? Well, it's all the whales who don't give a fuck about your project. So if you look at the room of 500 people that you made wealthy, right? These are just a bunch of whales who are going to dump their stack immediately, who don't give a fuck. Because remember, there was no lockup for the blur airdrop, so you could sell it immediately, right? Okay. So you can understand now why the initial distribution is important. You reward people fairly for providing real value, right? Without rewarding the people who are just going to dump. And you decrease the supply and you increase the demand. Less supply because you reward the right people, they don't sell. More demand because if they're higher community builder score people, they're going to bring more people in through marketing and bring more people in through building cool shit that attracts users, right? So now you understand why the initial distribution is so important. And when you're looking for a coin to invest in, if they rewarded a bunch of core diehard holder fans, then the pyramid, if it's early, has a very strong base and it can be built upon very high above the initial base. And that is a coin you want to look to invest in. So for example, Kaspa, really early would have been a great investment. Okay, so that's the end of this video. I'll see you in the next one. Cheers.
All right, guys, welcome back to the course. Today we have Tyler here. Tyler is an actual member of the Mastermind, and he has done really, really well this bull market. As of recording, this is January 2024. The coin that he's done really well on is Kaspa. He actually has caught a 50x return. And the reason I've made this video is that Kaspa doing really well, not necessarily because he found this coin in the Mastermind, but more so like Tyler has done what I would consider a really, really good and proper fundamental analysis on a project that he found early, building a really strong thesis, having conviction in the thesis and letting it play out and entering at the right time. He did everything correct, and it's allowed him to capture what is so far around a 50x on Kaspa. And also the fundamental analysis process that Tyler has applied is very similar to what I intend on teaching in this program. So this video is going to be a case study of how you can successfully find a coin early, buy it with conviction after you've built a strong thesis, and hold it through the bull market to capture, very impressive returns. So yeah, we're going to be doing a bit of a comparison on what I teach in this course and what Tyler has implemented. And yeah, so Tyler, give us like a bit of a background on yourself, and then we can get into, you showing us when you bought Kaspa and why you bought it and all that sort of stuff. So yeah, thanks for coming on this as well. Cheers.
Awesome. Thank you, Dan, for having me on. It's a pleasure. And a little bit about myself. My name is Tyler, and I got into crypto around 2020, right when things were heating up. And I was pretty much a newbie at the time. I've done a little bit of stocks in the past, but as far as crypto goes, the beginning of 2020 is where I started my journey. And like how when everyone started, you just search up on Twitter, you look for coins, you buy what's hot. And at the time, the market conditions were right, so we made a decent amount of money and ended up losing a majority of it at the top in 2021, the end of 2021. Learned a lot of valuable lessons in that. And then coming down into the bear market, we've been grinding, looking for quality gems, which we'll talk about in a second. And yeah, that's a little bit about me. And now we can get into how I found Kaspa and the fundamentals behind it.
Yeah, so you mentioned to me before that it sounds like you did like 20, 30K in the last bull run. You withdrew it and then you put it back in at the top and you learned a pretty valuable lesson at the time. And then that set you up for this bull run. You've done that full cycle, a full market cycle to set you up. So let's talk about Kaspa. So what was it that you were looking for when you bought into Kaspa at the time? And what was your original thinking? And also you can share your screen if you want and show us where you bought and all that sort of stuff.
Okay, yeah. I'll share my screen in 1 second. I just want to talk about a little bit why, my thesis and just my my thought process about buying Kaspa. So in my time in 2021, I really saw that most of the top projects in the space that were capturing most of the market share was these layer one projects. Projects like Solana, Cardano, AVAX, many other L1s were pretty dominant in the space. And that was my goal in the bear market in 2022, was just find the next layer one that has the potential to be one of those coins that I talked about just a second ago. And when I found Kaspa, I found it pretty early. And what stuck out to me about Kaspa was just some of the bold claims that they said that they were solving. Some of those were being they claimed to solve the trilemma and Satoshi's vision of peer-to-peer electronic cash. They said that they were bringing that back, what Bitcoin failed to do. And so my thesis, put simply, was there was many similarities to Bitcoin back in the day. And that is a very easy narrative for retail to catch on to once we go full bull in 2024. And that was basically my thinking at the very beginning of it. And I'll pull up the chart right now, show when I did buy it, and I'll also explain more fundamentally reasons that back up what I just said, because obviously anyone can claim to solve the trilemma or be a Bitcoin or an ETH competitor, but there was much more thought that went into that, and I'll explain that in a minute. But that was just a brief understanding of the very beginning. So let me share my screen and show you the Kaspa chart and where we bought it. So as you can see right here, we have this flag. I bought Kaspa on the 9th of November. It was my first initial buy, and I bought it for about 0.0036, which is right around right here. That was my first ever buy. And ever since then, I've DCA'd all the way up until right around this point right here. And it's been a wild journey, man. I mean, ever since, you can just look at the chart right now where we've gone and how early we've actually gotten in.
Still going. Still going.
Still going.
Still going. There it is.
Yeah, man. Now we can see it. But yeah, man, it's been a pretty wild ride, and I've enjoyed every second of it so far.
Yeah. So you mentioned that your goal was to find like the next big layer one. Why were you looking for the next big layer one instead of a gaming coin or something else, right? Like, what do you know about layer ones that made you want to focus on that?
Well, like I said previous, in 2021, most of the top 20 projects were actually layer one projects. And I figured that layer ones get a majority of the liquidity in the space. And in a sense, I don't want to say that they're easy to find, but like there was a lot of similarities between the top projects in 2021. And some of those being like genius founders such as Charles Hoskinson for
Cardano.
And I forget Solano's founder's name, but he's a genius too. And yeah, so there's many similarities that I saw within these projects. A lot of cult-like followings for these layer one solutions, and being able to narrow that down early was something that I was very fortunate to do, and it helped me find Kaspa early as well.
Yeah. So in the course, we go over one of the sections, which is pattern recognition. It sounds like your research process was based off pattern recognition to a degree, which is recognizing which sector of crypto is the sector that tends to outperform, and then finding the next, I guess, player that has the same patterns as the ones you've seen that were already successful. So you mentioned one of the patterns, which is the team or the founder. Most of these best performers have a really genius founder behind the project. And I guess when you look at Kaspa, you look at the team, if the team's really, really good, that can justify buying that. But anyway, back to what you were saying. You got a really good entry in the Kaspa. You found it early. You've ridden it this whole way. Let's get into a bit more depth on what you were talking about in regards to the trilemma, right? Fixing the trilemma that Bitcoin was trying to solve. You said there was more depth to it.
Yeah, so basically what I wanted to speak a little bit more in depth was just some of the fundamentals that I found early that gave me the conviction in the thesis that I actually found. So I want to start with the actual founder himself, and then we can go from there. So when I was doing my research after I found my initial thesis that hooked me in, warranted a deep dive, I started with the founder. That's what I usually like to do, is if a project can have a strong founder, then that's really the base of everything, that from what I've found. And starting with the founder, that was what I really based my research off, and that's what really intrigued me. His name is Yonatan Sabalimsky, and what really intrigued me was he was actually cited back in 2013 for doing Bitcoin studies, and this intrigued me, and this also helps further justify my thesis that Kaspa could warrant some Bitcoin-like talks in a sense. And he created Ghost Protocol, which is another thing that I saw, and that was cited in the Ethereum white paper along with many other top 100 projects. So clearly what this guy was doing, he had some cachet to him. He's been in the game for a while. So that was one of my founding pillars in my thesis. And then the community was another part. At the time, there was not a lot of people talking about Kaspa. It was mainly just like small community members at the time. But what I noticed was like these people were like diehard about what they were talking about, and they were just comparing it to Bitcoin. And since I'm not here to compare it to Bitcoin, but it's just playing a narrative. And when you can predict future narratives, which is another thing that you talk about in the course, that's really when you know you're early and you can predict the future narrative and where money will flow into, kind of like how you did with your Toshi narrative. That was something that I really played into. And then I have a tweet, which I want to show you. Let me pull it up. This is one of the things that really did it for me with Kaspa. So this tweet right here, it was from the official Bitcoin Twitter page, and this was in 2014. And this guy, Abid Zohar, he is Yonatan Sampromsky, which is Kaspa's founder. He is his business partner. They co-founded the Ghost Protocol together, and he's also his mentor. And he was cited, he literally was posted on the Bitcoin official Twitter in 2014, accelerating Bitcoin. So this was one thing that really piqued my interest and really helped me build my conviction as well in the thesis for Kaspa.
That's really interesting. So one component of it was the team and the founder, which it sounds like. Was there any other big characteristics that you saw with Kaspa that you haven't mentioned yet?
Yeah, so we already spoke about the advanced narratives where we kind of predict where future money will go to. I spoke on the founder. The community was also super strong at the time, and it was a new project, which we like to look at newer projects in the space because they don't have any bag holders. And also, tokenomics was super good as well. It was fair launched, and there was no pre-mine because there was a proof of work project. So what this means is that there's no VCs just waiting to dump on you, and it's actually built from a community. And something that you talk about as well is when you have a coin that has community, when it's a community project, those tend to rip the most in a sense because there's no VCs that are looking to meet profit targets, dumping in a sense. And that's what really can send a coin to these 100x multipliers because the retail's behind it and communities behind it. They're not just going to sell for a 4 or 5x. They want to ride that thing to the moon and they're never going to sell. And that is one of those things that really intrigued me as well.
Yeah, I guess with retail, they are become multimillionaire or go broke. It's like rich or broke. Whereas with VCs, it's like we're already rich. We just want to get a little bit more rich over time. And with retail, when they find a coin they like, this is the one coin that's going to make them rich. With VCs, when you get to a certain profit target, they go, okay, well, what would be better? Buying the next big coin in the super low VC round with the profits, or do we keep holding this thing that's way past where we have an edge, getting a really early entry in the VC round? So that's a good point, actually. So I want to refer to the sort of different sections in this mastermind on fundamental analysis. And let's just go over and see how many of these you actually applied as a sort of a case study of how this process would have worked, or it did work back when you bought Kaspa, the day after Bitcoin hit its bottom, right? I think you showed November 9th. That was like the bottom of the crypto market, literally the exact bottom. So if you want to share your screen and show the photo that I sent you, and then we can go down the list and we can see how many of these you actually looked at, just to give everyone a real life case study. Yeah, so this is the list that we have. Maybe go down one by one and see if any of the sections on fundamental analysis you actually applied back when you bought Kaspa. I have a feeling that we've already gone over a few of them. We talked about team, we talked about community, we talked about advanced narrative analysis. Yeah, go down the list and see if any of these were like what you looked at.
Yeah, so starting with flows, like we said, predicting where flows of money will come into in a sense. That was definitely part of my thesis. And then for tokenomics, we spoke on it briefly. It was a fair launch project and it was not pre-mined, so that was something that was super helpful to me. It also had a similar supply to Cardano, and there's a cool fractal that I look at from Cardano's 2021 run to Kaspa's rise so far. And finally with tokenomics, it did have, at the time of me buying it, 70% of all the coins were in circulation already. So there wasn't going to be a big inflation in a sense, which was super beneficial to me. And then advanced narrative analysis, we spoke on this briefly. Being able to predict where flows of money will come into and building a thesis before it's actually happened is something that I'm practicing every day and I'm working on. And building this narrative, actually watching this narrative play out in real time, it's super cool. And when you are early to something and it tends to go your way, it does give you a lot of confidence in what you're doing. And then thesis building with a network, at the time, I wasn't connected to many people at the time, so that didn't apply as much. And then pattern recognition, like I said, in 2021, I was watching all these top layer ones hit these astronomical valuations and just trying to take away from each different coin what I could and the similarities and just trying to develop an eye and an intuition for, what tends to do the best, what performs in a bull market. That is something that I definitely have developed in a sense. Team we spoke on, that was a huge part in my research. Community was another one. It's actually funny, when I was researching Kaspa at first, before anyone was speaking about it, I saw a few pictures on Twitter and there was already some Kaspa meetups and everyone had like these Kaspa shirts on. It was, I don't know what to think about it, but I mean, I don't care. I'm here to make money. I'm here to predict narratives, and that was something that kind of reinforced what I was looking for. And then perception versus reality, going back to that tweet that I said, seeing Kaspa at 40, when I bought it at the time, it was a little under $50 million market cap, so it was about like $45 million market cap. It just seemed so mispriced to me at the time. It seems like there was a market inefficiency because of all the things that I explained about how the founder was actually indirectly quoted by the Bitcoin Twitter page, and working on these protocols that were cited in the Ethereum white paper and stuff like that. I just felt like it was severely mispriced in the market, and that grew to be true very quickly. For the 0 to 1, kind of talking about like a unique aspect or something that's new to the market. It's a layer 1, so I mean, layer 1s are not new to the market in any sense. But as far as technology goes, they did claim that they did have this block DAG technology. I mean, I'm not super into technology and stuff like that. I prefer looking where flows of money will go to and just trying to build narratives. But they did say that they had this block DAG technology, and that's why they were able to solve the trilemma. And we actually have seen in the bear market a few projects claim to be piggyback off Kaspa and have these block DAG technologies or whatever, which was super cool to see. But yeah, that's basically done for that. There's a project called like Tara or something like that. They got a lot of hype because it was riding the hype of Kaspa for like block DAG or something like that. But always stick to the first movers and what they do, because projects that, piggyback off and then just copy pasta type projects, they never catch the hype for a little, but they never really materialize into what they could be. And I always bet on the winning horse and the first movers. Outlier price action. It's actually funny enough, when I was looking at Kaspa, like as Bitcoin was dumping, Kaspa was literally making highs. So that in itself was an inefficiency. And it was definitely something to take note on.
Regards to that, let me just show everyone that right now. So if we go back to November 2022, that was when you bought it, was the 9th, right? So it was just about, it was here. You bought here. And if we look at November 9th on Bitcoin, so November 9th, and I guess, November 9th. So on the big crash that Bitcoin had where it hit its basically the exact bottom, Kaspa was actually in the middle of its rally.
Yeah, it's consolidating right now.
Yep, consolidating above all-time highs.
During that time was the actual collapse of FTX. That was that exact week where FTX was collapsing. The whole world was falling down in crypto. And once we had that capitulation candle on Bitcoin, that was my time. I knew I had to allocate heavily into the market, and I was going to DCA down regardless. But once I saw that capitulation went down, I knew that there wasn't much downside left and that it was time to enter the market more aggressively.
And the next one, initial distribution.
Yeah, initial distribution, like I said, like we talked about a little bit earlier, it was launched in pre-mine, so there wasn't any big VCs holding a large supply. And when I did buy at the time, it did have about 70% circulating. So there was only about 30% left to be mined, which meant that there wouldn't be a lot of inflation into the market coming into the next few years, which was also another solid for the project. And then finally, Age of Project was launched in 2022, I believe, or maybe the very end of 21, but I think 2022. Because it was a newer project. There was no bag holders from the last bull market waiting to dump it, break even or whatever. And that's something that I only buy new projects from when I started. It's something that you talk about as well. You had a funny reference. I forget what exactly it was about, like a grandma or something.
She's been pump and dumped a few times.
Yeah, but yeah, I only buy new projects at the time. They do have the highest potential in a sense for me, because I wasn't starting with millions of dollars, so I could buy like a Bitcoin or Ethereum, get a 3 to 5x or whatever, and then sail off into the sunset. When you start with like not a lot of money, you do have to take on more risk, and that involves being early and buying new projects and building a thesis and conviction.
Yeah, so I think this is a really good case study where what Kaspa showed before it went 50x was pretty much every single characteristic that we look for when we're doing fundamental analysis in this course. And so if you just had applied this course's fundamental process to Kaspa then, you would have bought it. You would have been like, holy fuck, I found the next coin. But you would have aped in, because everything that we look for, Kaspa had. And I'll go over it one more time. The flows. So in regards to flows, people always buy new layer ones. So there's always people wanting to put money into new layer ones. And this one, no one really knew about. So it had a lot of future flows when people were to find out about it. Tokenomics, like we said, fair launch, no pre-mine, no VCs, 70% of the coins are already in circulation, no high inflation, blah, blah, blah. Advanced narrative analysis. People are always looking for the next layer ones. And we talked about the narratives around the founder, the fact that he has relations to the Ethereum white paper. Well, I think that was what you said, that they referenced him. He was mentioned on the Bitcoin Twitter account. You know, all this stuff that can build a narrative around how this project's special. Thesis building with network, not relevant, but that's, you know, that's sort of a bonus. Pattern recognition, right? Layer ones are always doing well. The team was insane. Community really strong. They did all these meetups. They got the little nerdy shirts on. You know, Mindshare wasn't relevant, but I think when you're trying to find new projects, you're trying to find them before they have Mindshare. And maybe the way that you could look at Mindshare is, do they have a core committed team who just love talking about this project all day? And I think if you looked at Kaspa, you probably would have seen the community was really passionate and they were just trying to tell everyone they knew about Kaspa. Perception versus reality, you just said mispriced. You just looked at it and you felt that this coin was mispriced. That's a lot of the time all it takes. It's just that intuition. It feels mispriced, right? That's often all it needs to be. 0 to 1 primitive, like you said, block DAGs. There's a lot of projects trying to copy Kaspa now. Everyone talks about, there's like a coin called Space Mesh. It uses proof of space, basically like storage space. They're all trying to like copy, you know, the Kaspa vibe. Outlier price action. That is the perfect example of outlier price action. Breaking and accumulating above all-time highs when the whole crypto was collapsing. That's like as good of a sign as you can ever get to buy, right? Initial distribution. I think it's a classic example of a perfect initial distribution. No VCs, the community got all the coins. There was no pre-mine. Everyone, you know, it was fair game, fair launch. And yeah, age of project new. So pretty much you ticked 90% of the boxes here. And this was, you didn't even have this course, which is why I wanted to, you know, have you on this, have you as a part of the course here. What has writing a 50x on Kaspa taught you? What do you think is the biggest lessons that you've learned from this whole process that you've gone through?
That's a great question. A few things, like when you're so early to a project, it's going to be nobody talking about it. And for newer people, like that may be a turnoff. Like you want the confirmation that like a lot of people like what you're looking for. But in a sense, no one talking about a project could be the best blessing ever. And it's proven true for Kaspa and as well as Toshi. Nobody was talking about either of those projects on Twitter. There was no big influencers talking about it. You were the only one, you and Mark were the only people I knew that were talking about it. And you really sit down and build a thesis and see where the money will flow next. And if you can really put together a narrative, an advanced narrative, then, you know, the sky is the limit for what's possible in these, for getting in early. That would probably be the biggest thing that I could say is be comfortable buying a project when not a lot of people are talking about it if it meets all of the fundamental things that we talked about in this project. Mm-hmm. And that would be the biggest thing. Yeah.
Mm-hmm. Is there any other parting lessons that you can think of?
So one thing I want to leave you guys off with is just a personal message, because I don't want anyone to go through what I went through at the end of the last bull run, which was making money and then losing all your hard-earned money from the blow-off top. So what I want to leave you guys off with is your conviction levels, they rise as price goes up. And what in doubt, this tricks your mind into thinking that prices will go up forever. And it's actually a very dangerous thing. And it turns many people into bag holders, and it turns many people into community members. And knowing when a thesis has fully played out and knowing when to sell is probably one of the most important things you can do. And when you do sell those positions, make sure you cash out fully, you made your profits. And yeah, that's basically everything. Just knowing when a thesis is played out and being able to sell it is a skill, and work on that as much as possible. And that's all I'm going to leave you with today.
Yeah, that was really, really good. And I think this has been a really good case study into how to do fundamental analysis properly, and a real life case study and application of looking for the characteristics that we look for, finding it, buying it at the right time, and holding that position with conviction, you know, riding it to a 50x return, waiting for that thesis to fully play out. So yeah, thank you, Tyler, for coming on. This was, you know, a really good little section, a little case study for the course. And yeah, I'll see everyone watching this in the next video. All right, so let's talk about the next fundamental characteristic that I look for in a project. And this one refers to the idea of Mindshare. There's a lot that I can explain on the topic of Mindshare, and this video relates back a lot to core marketing concepts that you would use to basically build a business. So this video is really going to be a
a bit of a business breakdown, really. And it's going to relate a lot back to crypto. And I got a couple case studies to really help explain this one. So crypto is a game of attention. This is what you guys need to understand. You know, in the digital world, everything is about attention. In the world in general, the only way that you've ever made money is by having someone look at your thing and then pay you for it, right? You get someone to look at you, you get their eyeballs, you convince them to buy, they buy. That's how everything has been sold, whether it's a coin, a fucking 1800s t-shirt, like fucking woolen t-shirt, a fucking caveman, whatever it was, right? Any point in human history, you sold something through human attention. And it's the same thing in crypto. You want people to buy your coin? Well, you have to get them to look at it, right? The more people that you can get looking at your coin and the more you can convert into buyers, the more money that you're going to make, because the higher the coin's going to go in terms of price, right? So where people look is where people tend to buy. Even if you are the most hated person or coin online, you're going to convert enough people into buyers because enough people are going to want to buy, right? And this is why Mindshare, i.e. conversation about a coin, is vital to its success. If your coin is not spoken about, it will die. And this is why volume, in terms of like the amount of buying and selling volume, is one of the characteristics that people look at to determine how successful a coin might be. Because volume shows you there's interest, and interest tells you that there's mindshare. And if there's mindshare, then the project has the potential to captivate the minds of more people, right? If a coin has a declining volume, it means that less and less and less people are caring about it because less people are buying and selling it. Not a good sign. You want to see volume increasing. So to understand how a coin gains mindshare, we have to understand the TikTok algorithm, because I think the TikTok algorithm is the perfect case study of how things go viral in general, how you attain mindshare in general. So this is how the TikTok algorithm works, right? There's a video that gets posted, then the algorithm on TikTok basically looks at these metrics. So it looks at, how long did someone watch the video for? Did they replay it? Did they like it? Did they comment? Did they share? And then if they had good performance, the video gets sent to more people. And then it's this like feedback loop here where it gets good feedback, good data, more people view it, good data, more people view it. And eventually the video gets to a certain size where the data is no longer good, it gets bad performance, and then it doesn't get sent to more people. And that's where the video peaks in terms of views. Okay, so put simply, TikTok sends a video that's posted to 10 to 100 people, right? It collects the data. If the data is good, sends it to 1,000. If the data is good, sends it to 10,000. And then this process continues on and on and on and on until some videos get to like 100 million views. So your video's virality is determined by how large a sample of people continue to interact with the video. And this is very, very similar to how crypto works. Love, hate, jealousy, fear, inspiration. The emotion that these people on TikTok feel doesn't matter. It literally is irrelevant. Viral videos, there's hated viral videos, there's fucking loved viral videos, there's scary viral videos. It's all the same. All you have to do is make the viewer feel something. You have to make them conversate and want to engage in what you're showing them, because engagement keeps people on platforms. And when you keep people on platforms, you get rewarded, right? Why does TikTok reward you for people who watch your video longer? It's because they spent more time on the platform. You get rewarded if you keep them on, right? And people watch shit they want to watch. And it's the same concept with crypto. The best coins are the ones that everyone just can't stop fucking talking about. Right? Solana, one of the best performers. Why? People just can't stop fucking talking about it. They love it. They hate it. They feel every emotion about Solana. For some reason, it just triggers them. And that is why Solana and coins like Hex and other coins that people hate just tend to give the best returns. People just fucking can't stop talking about it. And that's the virality factor, right? How big of a sample size of people can your mindshare go where you're still able to have high levels of engagement? Right? Where does your engagement peak out? For most projects, the engagement peaks out very, very low. So you don't get a big sample size of people looking at your coin. Some coins, they go huge. Everyone talks about it. And because you got a lot of people talking about it, you tend to get a lot of buyers. Right? So as you can see, TikTok is a engagement-driven content Ponzi scheme. It's not necessarily early people make money, but as each group of people show the platform that they like the video, it gets sent to a larger group of people. And it's sort of like a Ponzi scheme, right? So it's a content Ponzi scheme driven by the engagement of the users. Same thing with, fucking coins, right? You buy early, you tell everyone to buy, they buy, They tell everyone to buy, those people buy. They tell everyone to buy, those people buy. It's a Ponzi scheme. And so Hex is the first case study I want to go over to give you a real life example. So as you know, Hex is run by Richard Hart, this guy here. It's one of the most hated coins in crypto. It has been in the past. It's also one of the best performing ones. You can see here, it's up like 200x from the bottom. I think it's up even more than that, to be honest. Like, you know, if you bought over here, it's up a lot, okay? Like a lot. And, you know, why is it up so much if it's literally a fucking shitty scam? Well, Hex uses mass virality content, hate fuel, to convert low intelligence, naive investors into buyers, right? When you look at the average Hex community member, have you ever looked at what type of person they are? I have, because I've put videos out about Hex and I've seen the type of people who comment on the video. You look at them, they're always the same type of person. It's some 35-year-old, 45-year-old, 55-year-old, broke, very average, ugly, fat dude from America or some first world country with a very low IQ from a rural town, you know, low IQ, farmer type of person, like just some idiot, right? It's always just some idiot. Now, obviously, this is not to tell you that everyone who buys Hex is an idiot. I know very smart people who've made millions of dollars buying Hex. But as a general rule of thumb, the average Hex holder is a moron. And that is amazing because that is the type of person you want holding your coin. But that was also the type of person that Hex attracted through its marketing, right? When a coin is hated like Hex and it's so obvious that the coin is just ran by a fucking scam artist, the only people who are going to buy it is the dumb people. But the good thing for Richard Hart is that this is a very big group of people. Most people aren't smart. And so he's selling himself and his coin to a subset of people who are actually a large part of the market, which is the very unsophisticated, naive investor, right? So what did Richard do? How did he capture the mind share of crypto in the last bull run? Well, he weaponized engagement bait money flexing combined with long form spellcasting content to create a cult holder base. So he basically did the Andrew Tate model. So let me show you what I mean. He flexes with his supercars and his Louis Vuitton bags. He's wearing the most clearly stupid outfits, you know, diamond Rolex, expensive glasses from Versace probably, you know, private jet, Hex necklace, fucking, what's this, Louis Vuitton jacket, full Louis Vuitton outfit, Louis Vuitton bag, you know, posting content about all this money that he has. And then what he does is he funnels all this attention from this viral content to his YouTube channel. And on his YouTube channel, he makes long form content, basically spellcasting on his audience, all these different mental models that help the viewer understand why they should buy Hex. And it's basically like a magician's trick, right? The magician, the hypnotist is casting spells on you. And if you do research into Richard Hart's history, into what he's been doing the past decades he's been alive, some of the career paths and skills that he has revolve around manipulating humans, hypnotism, different topics on that, which, you know, different skills which relate to converting people to believe certain beliefs, right? And that's why he makes the perfect coin cult leader, because he spent his whole life training to do this. This is what he did before he launched Hex. For example, he's got a 4-hour video here, 4-hour video talking about Hex. And because I run businesses, I know how to convert people into buying products. His product is a coin. My product is a paid group. I know how to convert people, and I know the business tactics that he's doing because I do similar things. The thing you have to understand about content is when you make long form content, you create cult followers. The longer the videos, the more someone sits down and watches you, the more they get hypnotized and the more they like you more and more. This is why YouTube as a platform builds the strongest connection with its viewers, because their viewers spend the most time watching you out of all the platforms online, right? And I want to give you an example. So here he makes a 4-hour video. I guarantee you this creates cult followers. This creates loyal holders. This converts the, you know, mass market clickbaity attention that he gets into buyers, right? This is what he does. It's a marketing funnel. They find him from the mindshare that he has. People hate him. People who hate him go and watch this video. They actually like him and they fucking start believing what he's saying because he talks for 4 fucking hours. Eventually, you know, you listen to this guy enough, you're going to start believing him, right?
And then you hear
He tries to make the world a better place for people, but he launches a zero-sum cryptocurrency where people only win by others in his community losing. How is that making the world a better place? The world doesn't actually get better because nothing has been built on Hex. It's just purely a vehicle for speculation. He's funded his entire, millions of dollars, Lambos, all of this through other people losing money on Hex, right? But you wouldn't believe that because he would cast a number of spells on you to not see that. You just believe that you should be a buyer, right? And that relates back to Mindshare. Okay, he has Mindshare of all these people who will now buy his coin. And long form videos is how you create those cult buyers. And you know what? When you're trying to sell high ticket products, so for example, this guy's trying to convince you to put 50 grand into Hex, you do long form videos. And I'll show you an example here. I do the same thing, right? If I want you to buy my thousands of dollars mastermind, I put out a 1 hour, 20-minute video, which is a webinar, which is just a big funnel for a course, right? How do I turn someone into just found my YouTube channel into wanting to buy a $5,000 mastermind or whatever the price is in the shortest amount of time possible? Well, you make a 1 hour and 20-minute video giving tons of value, programming the viewer to ultimately want to buy the mastermind, right? Now, it's not necessarily done unethically. This is the best decision most people could make who want to make money from crypto. That is what this video does. It programs you to buy the mastermind. And this video programs you to buy Hex, right? Captures the mindshare, converts it into viewers. This is just the game of every single fucking business on the internet. And that's why I say the Andrew Tate model. He does the same thing. All Andrew Tate does is, talk in front of the camera, spell casting on you a number of beliefs and different mindsets and ideologies that you should internalize. And all of these ideologies that you internalize are creating you into the perfect consumer of buying all of his products. Not necessarily saying it's a bad thing because the product, I've bought some of it, a lot of his stuff. It's been very, very useful. But I'm just saying that's what people do. You get attention, you convert it into a buyer, and then you want them to keep buying forever, right? And that's what Richard's done. That's what Andrew Tate's done. That's what the goal of every single cryptocurrency is. Get viewers, get them to buy, get them to never sell. 3-step formula. Get the attention, get them to buy, get them to never sell. That is the game of Mindshare. Hex convinced everyone to have an opinion about Hex. Hate or love doesn't matter. And in the process, only needed to convert a small percent into buyers to send price parabolic. So when you think about it, right, let's look at it from the perspective of a marketing funnel. Let's imagine 1,000 people view things about Hex, right? Hate, love, doesn't matter. It has a 5% conversion rate. So 95% of people go, yeah, Hex is a scam. Fuck that coin. Richard Hart's a dickhead. He's just flexing on his, followers. I don't know. He's very materialistic, very shallow. Okay. Let's ignore that. 50 buyers, right? Of the 50 buyers, 20% conversion rate turn into cult community members, right? So maybe 20 people buy Hex, but then 50 people buy Hex, but then 20 people watch this 4-hour video and they turn into cult community members, right? That's the next level. So remember, 3-step formula. Get the attention, get them to buy, get them to never, ever, ever sell. What's one of the things you can do with your Hex coins? You can lock them up so you never, ever, ever can sell them. Maybe in 20 years, you're going to be worth millions of dollars. Yeah, set yourself up for retirement. Some fucking bullshit so that Richard can dump on you and get rich today. So stupid. So key lessons. Let's look at the key lessons from Hex, right? Let's summarize this. All publicity is good publicity. Richard Hart flexes online, and the reason it works is because he can put out a 4-hour video and spellcast anyone who might have once hated him into someone who loves him, right? He can convert the hate into love through his content. All publicity is good publicity. Hate and love is the same in the attention economy. Your marketing funnel must be able to convert viewers into buyers and then into cult hodlers for your project's success. Mindshare is the key to success. The more minds that think about you as much as they possibly can, the better. So you want to captivate mindshare, right? Think of the concept living rent-free in someone's head. If your project lives rent-free in someone's head, then that's very, very promising, right? That's going to set you up for success. So there's one more case study I want to look at, and this case study is Solana. So Solana is one of the most hated coins of this bull run and also the last one, and it's gone really, really good lately. So let me show you, let's look at the Solana chart, right? Solana has gone fucking ballistic, right? It went down to like $8 or something, and it's now at like 107, right? Let's have a look. Went down to $10, now it's at 100, so it's up 10x, right? How does a coin do this? Well, at the bottom of the bear market, Solana was a top 3 talked about coin on Twitter. So if you look at it down here, it was at, $15, $10. It was a top 15 coin, and it was still the most talked about, one of the most talked about, right? Bitcoin most, Ethereum next, and then Solana. Its mindshare value, right, was much higher than its market share. It was only worth a couple percent of Ethereum's market cap, but its mindshare value was on par. It was talked about a lot of the time at the same amount as Ethereum. So Solana became the most hated coin in crypto. And this hate actually at first led to its death, but it also led to its massive growth because it was hated from the mostly the FTX collapse. FTX and Solana were in bed together. SBF was the biggest backer of Solana. So when when FTX went down, everyone's belief was immediately, oh, well, Solana's dead because SBF's gone. He was the one keeping it together. Without SBF, Solana's toast. Also, the network just kept going down. There was like barely any other chains with this problem, right? Ethereum doesn't go down, but Solana kept going down, and this was like one of the main FUD points. Everyone kept talking about it. Billions of SOL also was on FTX, right? FTX dies, all the SOL gets locked up, but it has to get sold off when the legal proceedings finish. So people were worried, fuck, there's like billions of dollars of Solana that's going to get sold in the future. That's bearish. And when you look at the chart back over here, you know, imagine here, FTX collapse, it's at $10. All the Solana tokens have to get sold. You're not bullish on this coin, right? But you can see here that it's made a full recovery. And the reason that happened is that this was all people spoke about in relation to Solana for months as its price remained dead. But under the FUD, under all of this, you know, surface level, it's dead, I hate Solana, fuck this coin, blah, 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 mindshare, there was actually a strong, growing, relentless community of developers building the future of finance. The developer community was reaching record highs. The future of finance being built, community forged in fire, and everyone couldn't stop talking about it, right? Look here. January 2023, right? When's that? Right here at $11. You can see that Solana is the fastest growing developer ecosystem. Price died, everyone hated it, but all the developers were flowing in. 2,000 total developers in 2022, second only to the raw numbers, only to Ethereum, right? So Mindshare, third most talked about coin in crypto. Developer share had the second highest amount of developers in crypto. You can see that the price was one of the worst in crypto. So there's a gap here. The reality and the perception, the mind share and the price. You can see the difference here. Okay. This is the reality and this is the FUD. Solana went down for the 12th time and people still keep investing in it. And then he's telling you about some stupid coin, right? FUD. Reality, right? Mind share today is market share tomorrow. Everyone talked about it. Now everyone has bought it, right? You can begin to see this playing out. Also, I wrote a thread in 2021 talking about why one of the characteristics I want to see in a project. I bought Solana at $7 in the last bull run, rode it all the way to 240, where I sold about half, right? So I got a 40x, and the reason I bought Solana was the same as I buy Solana now. The project should attract controversy, hate, love, and divide communities over its success. Find me a hated coin, you'll find a top performing crypto, right? You can see here, this guy's talking about eGold, same as this guy, same FUD back in 2021, talking about all this hate and shit, right? But this guy is saying why are they hating on Sol? But you can see that, you know, eGold was hating on it, BitBoy was hating on it, saying that Solana's a scam. Yeah, Solana really took over the mindshare of everyone, and everything and all that had to happen was people actually try to use the chain. So this is a point that I'm going to get into later, but basically all publicity is good publicity, assuming you can convert the publicity into users or buyers. You know, attention is only worth money if you can convert it into money. So for Solana, it got a lot of hate, but Solana actually has the best user experience in crypto. It's fast, cheap, it's the best platform. It's got amazing applications like Jupiter and Jito and MarginFi. Everything that you want to do on Ethereum can be done on Solana, cheaper, faster, and easier. You know, it's the best alternate to Ethereum right now. Anyone that, you know, saw that Solana was getting hated on and actually tried it out for themselves all came to the exact same conclusion. They said to themselves, Solana is actually amazing. And that's the thing. When everyone talks about something, they all want to go and use it. When they go and use it, they go, oh, okay. I thought Solana was dead, but it actually isn't. It's fucking thriving. Wow. Why do I pay a fucking stake to buy a coin when I can pay a fucking half a cent, not even half a cent on Solana? And it's way easier to use and I feel way safer using it. And there's all these money making opportunities on Solana that currently aren't even on Ethereum. Why the fuck do I even use Ethereum? And that's what's happened. All these people are now coming over because of the mindshare. Everyone's talking about Solana. They're all coming over. And they don't want to go back to Ethereum now. Once you pay 0.001 cent and the transaction goes through instantly, you don't really want to pay $50 for a fucking transaction on ETH mainnet anymore. Next up, narratives are way more powerful than anybody gives credit for until well after the fact. Solana has flipped Ethereum in mindshare. That's what matters. And it still needs to do more than 2.5x to hit a new all-time high during its first cycle. 10x off the lows, but still early in this run. Solana is spoken about more than Ethereum, but Ethereum has a bigger market cap, right? You can see that gap between Solana, Ethereum's here, Solana was down here in terms of price, right? This is price. But let's look at it in terms of MS, Mindshare. Ethereum is here and Solana is up here, right? Oops. So this is Solana, this is Solana. So you can see that there's a discrepancy, right? Ethereum is way above Solana in terms of price, but Solana is way above in terms of mindshare. You can see why that gap has been priced in now, right? Look at Sol versus ETH. Solana almost hit new all-time highs against Ethereum, right? So you're starting to see Solana is only 5%. I think, is that 5%? It might be 5% of Ethereum's market cap. I'm not entirely sure. Could be that. Now, in business, right? This is bringing it back to marketing concepts. This is how you understand, let's say, a particular market or industry, right? If a particular business has so there's two variables, right? Mindshare and resources, resource strength, right? So let's call it mindshare and the actual quality of the project. So when a project has lots of mindshare and it's a very, very, got a lot of developers, great product, great marketing, blah, 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 it is a market leader, right? This is the peak. You want to have lots of resources, lots of mindshare. That's the market leader. So if you look at the price of Solana at $10, it was the developer community was booming, right? I just showed you this. So developer community, second to Ethereum, fucking going ballistic. All these apps are being built. The community's just as strong as before, if not stronger. They finally got away from SBF and FTX so that their own individual coin now. All this good stuff is happening, right? So if you look at it in terms of the resources, it's up here. Mindshare. It was the most talked about altcoin outside of Bitcoin and Ethereum. So you can put it there. So Solana at $10 was a market leader, but I think the actual perception of the resource strength of Solana at $10 was here, right? So the perception was Solana was here, right? Everyone knew that everyone's spoken about it, but no one believed Solana was that useful. And the Solana price increase has basically been this. It's been people's perception of Solana going from a not very resource strong project to a very resource strong project. Huge developer community, best UX in crypto, fast, cheap, and easy. All the normies love it. Lots of money to be made through the shitcoin ecosystem. Actually really good DeFi applications that are better than Ethereum, right? And that's what the price increase was, $10 to $100, right? This was $10. And this is what we talk about in the course. It's about perception versus reality. We talk about how things get priced in, right? The price rise from $10 to $100 was when people realized that Solana was a mid-resource strength to a very high resource strength, and the mindshare was very high. Okay, so let's look at the key takeaways from Solana. Everyone talking about your coin, even if negative, is a good thing, assuming the underlying project is solid. So at $10, everyone spoke about Solana. It was actually a great project. So it's you can talk shit all you want, but the truth will eventually come out. Like with Hex, mindshare turns into buyers. So, someone talks shit, community actually debunks the FUD, makes users interested to learn more. They realize that Solana is a cheap, fast, and easy blockchain. They become a holder, right? This is the hate to buyer funnel, right? Let's actually name that. Hate to buyer funnel. And this is how you weaponize attention to make money. FUD is a marketing funnel for good projects that can convert a % of viewers into users, and the proof always prevails. There's only so long that Solana could have been hated before people woke up and went, hey, hold on a second. This is actually a really good chain. Even though FTX died, SBF's in jail, all these tokens on FTX are going to get unlocked eventually. The network goes down. It actually is way better than I thought. Now, here's another tweet to help summarize this. Seeing how big of a mindshare Solana captures just feels like it's about to have the most hated rally ever in the coming years. This was in October, okay? So October, the price was, $40. You'll always find me on any blockchain trading anything with volume, and that is exactly why I'm bullish on Solana, because I still haven't crossed any chain with a superior UX. So he's gone on all the chains. Solana's the best. And then he just goes on to talk a bit more about, some other stuff. Let me see if there's any more tweets. Yep, market matrix, market command matrix, and that's it. Yeah. So just to summarize, mindshare refers to, how many people are talking or thinking about your project. You want to have as much mindshare as possible, because the more people that talk about your coin, the more people you have to put through your conversion funnel and turn into, firstly, buyers, and then people who never sell. And the two best examples, in my opinion, of a hated coin or a coin with a lot of mindshare, turning that into money, into holders, is Hex and Solana. Hex turned hate into a, funnel to basically build a cult. Solana turned hate into people actually finding out that Solana was actually a really, really good chain. It actually was good. And this FUD was just a temporary decline that Solana had experienced, which eventually, now it has been priced in because people realize the truth about Solana. Okay. So yeah, thanks for watching. I'll catch you in the next one. Cheers. Hey guys, how's it going? Back with another video covering capitulation and forced selling. So basically what I want to talk about in this video is how one of the ways that I basically buy, like get into the market, get into my positions. Now this this analysis of charts and technicals is mostly for coins in the top 300. This wouldn't really work as well on meme coins. I mean, you could use the concept on meme coins, but the data that I'm going to be showing you in this video, which is what, we're looking to analyze the technicals and the technical tools that I use for measuring capitulation, for measuring forced selling, doesn't work on meme coins. It's not going to show you. Now, let's say on Bitcoin, it crashes, the market capitulates, the meme coin capitulates, probably finds a bottom at the same time as Bitcoin does. So you can sort of indirectly use this data on anything. However, the data itself only can be put onto Bitcoin, Ethereum, Solana, blah, 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 the main coins. So let's, go over this briefly. So one of the buying strategies is buying capitulation. I have a bunch of data to measure when the market is having capitulation happen. And capitulation happens 1 to 3 times a year, usually like 1 time or twice. And it basically represents like a really, really good buying opportunity, like one of the best buying opportunities you'll get. Because crypto is such a volatile space, it's such a new technology that sometimes things just break and people panic. And they panic way more than they should. And this leads to short-term inefficiencies where price trades way lower than what it should be trading. Because when something breaks, it gets fixed, but people sell coins really low as if the problem's never going to go away, and they panic. And it's this panic that gets us these opportunities to buy, which are really good. So I want to go over capitulation in terms of how it works, some examples of when the market went through capitulation, and then go over some of the tools that I use to measure capitulation. So yeah, the capitulation and the tools I use is one of the methods of technical and chart analysis that I do, essentially. So let's talk about what is capitulation. So visually, let me show you. Oh, you can't see me anymore. I'm now a ghost. So visually, let's get rid of some of this shit. It is basically when the market basically just dies, right? Like it's a big crash that happens where people feel the need to capitulate on their positions, meaning they give up. They just need to get out. They need to sell. They need to leave, right? So this would be like a capitulation. This would also be a capitulation, this sort of massive crash where people are losing heaps of money. They're panicking. Maybe people are forced to sell as well, right? Like the concept of a forced seller also relates back to the concept of capitulation. They sort of happen hand in hand. And so what I'm trying to do with this method of technical analysis is spot when the market is having a capitulation event so that I know when to buy, essentially. Now, capitulation, like I said, can be from intense fear, or it can be from, a big liquidation event. So for example, let's imagine there's like $1 billion of people trying to long the market, and then there's someone who dumps the market and these longs get liquidated. When you close a long, you have to sell, right? That's $1 billion of selling. That puts the price lower. Because the price went lower, more people get liquidated who sell, who make the price go lower, and more people get liquidated. And it creates this spiraling effect of it's called a cascading liquidation, right? So let's draw this up. So you got price, it's chilling. People are buying here, crash, right? Let's say they set their stop loss here, or let's say they get liquidated here, right? They get liquidated. They have to sell, so then the price goes lower. More people had their liquidation levels here, so then they sell. So more people had their liquidation levels here, and you can see that it's just this continual downward movement of liquidation, 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 until eventually buyers come in and they create a bottom. And at this point here, like this rough region is where we want to buy. It's after that forced selling, that liquidation, that capitulation has
occurred, and we use tools to measure this. Okay. So why is capitulation the bottom? Well, capitulation is basically the price at which there is the most opportunity for buyers, because when you think about it, selling and buying is driven by emotions. What is the strongest emotion that someone can feel that leads to them wanting to sell at the lowest price? Well, it's capitulation. Capitulation is the strongest emotion an individual can feel that will make them want to sell something at the lowest possible price. Because something you guys need to understand is that price and sentiment are like completely intertwined. So let's say price goes like this, makes lower lows, right? The sentiment tracks this, right? You never have a period where people are getting really bullish, right? Let's say that this is sentiment, right? S, and the price is going like this, right? It sort of maybe a little bit can happen, but it doesn't really happen, right? It's like the price and the sentiment are generally very intertwined. You're never going to get a crash sideways and then another crash, and the market is more bullish here than when it was there. No, the market gets more scared the lower it goes. And, you know, let's say capitulation happens, right? Capitulation is it's the strongest emotion that a human can feel in relation to investing. There's nothing worse that can happen. There's nothing more scary that can happen that would make them want to sell lower than that event of a capitulation. It's just the lowest, it's the worst, it's the scariest. It's the point where people are willing to pay to sell things for the lowest possible price that they would ever consider selling. So that's why capitulation is so powerful, because it represents the point at which the most opportunity for buyers, because it is the point where sellers are willing to sell at the lowest possible price that they would ever consider selling. So, because when you think about it, right, price is a battle between buyers and sellers. Smart people, right? Smart people buy fear. Smart people like us buy capitulation. Inexperienced people, they sell during capitulation. I've done that a lot of times. The COVID crash, I actually sold a little bit of my portfolio into the COVID crash. I sold the capitulation. If I was smart, I would have been really loading up at that crash to 3K during COVID, during whatever it was, 4 or 5K. So yeah, the actions of experienced people, they control the price, right? When the price crashes into a capitulation, it's the smart people who obviously, the experienced ones who have all the wealth, who end up buying in, right? They put up the walls of the bids, right? These walls of bids. This is all the experienced people. And I'm going to show you a wall of bids in one of the tools that I have to measure this. So let's talk about forced selling as well. So Loomdart tweeted this tweet pretty much at the bottom, right? Let's have a look at the chart. When was the bottom? It was like, December, 20th of December, late November. That was the bottom. Okay. My birthday, November the 22nd, was actually the lowest price the market ever went. Isn't that funny? Didn't realize that. So basically, forced selling is what he was talking about here, because remember what was happening back during the last crash? FTX collapsed. That led to systematic risk in basically the entire crypto market, because people had lended money to FTX. That money was now gone, meaning these companies basically lost their money. Also, a lot of projects had money stored on FTX, right? They might have had their treasuries kept on FTX. Well, that's gone now because they can't get their money out. A lot of people and projects had their money in the FTX token. That went to basically zero. So you can see that there was a lot of people who had lost a lot of money. And, like a lot of, let's say a lot of these protocols like Celsius, for example, they, these big companies that basically had to shut down their entire company, declare bankruptcy, they have to sell their portfolios, their coins, to be able to refund people. Now, I don't remember any specific examples of who were the big sellers back then, but just imagine a number of different firms who declare bankruptcy, they have to liquidate their portfolios, who are basically forced sellers of billions of dollars of Bitcoin, Ethereum, whatever coins that they had. What price is a forced seller willing to sell their coins at? Well, they don't get to choose what price they sell at. They will sell at whatever price the market gives them. And thus, the bottom of the market is often represented through forced selling, because there is no one who is willing to sell a coin lower than someone who is forced to exit their position, because someone forced to exit their position must take whatever price is given to them at the time of selling. And they don't have time to wait to sell. They have to sell regardless of what the price they are getting is. In fact, they are probably grateful that they get a price to sell at, given the amount of coins that they generally have to sell.
Think about how many billions of dollars of coins had to be sold during that whole FTX saga at the bottom, when a lot of people wouldn't have been buying because of just absolute fear, right? And that's why we got such low prices on coins like Solana, a lot of forced selling. People thought it died with FTX. A lot of people thought it was over. Not many people willing to buy. So, that concept of forced selling is really interesting. Whenever you guys are noticing in a market where people are forced to sell something, that's where you need to be paying attention to be a buyer, because you have to recognize that the price is probably not going to go any lower than where people were forced to sell it, because no one will sell a coin lower than a forced seller. Okay. Now, one other concept I want to talk about is liquidation. So when traders get liquidated, traders represent people who have a short-term time preference. So their impact on the market is very short-term. When you have $1 billion of short liquidations, it's $1 billion of the trading pool of capital that is being sold. The trading pool of capital is just being traded daily between different groups of people. It's not actually increasing or decreasing the amount of coins on an exchange, right? Because when you think about it, there's two types of buckets of wealth. There's the exchange money, right? The coins that are on the exchange. And then there's the sort of rest of the coins, right? Which are stored in, they're like a hodl, right? There's like the hodl coins. These ones are not on an exchange. They're in people's wallets. And when a long-term investor buys or sells, they are either increasing or decreasing the size of the trading pool. When a person who is a derivatives trader buys or sells, the pool stays the same because it is the same. It's traders selling to other traders, right? This pool stays the same. Now, when a liquidation happens, what is happening is this pool of capital is selling billions of dollars of coins sometimes, and it's being scooped up by wealthy spot buyers, right? Liquidations are a forced transfer of wealth from traders in this pool to wealthy spot buyers. So it's basically a massive shrinking event of this pool of people, right? Let's change the color of this pool being sent over this way. So the trading stack shrinks and the hodl stack increases during a liquidation event, right? Because these people close their positions and they get bought up by the spot buyers. Because what did I say? Really smart, experienced investors buy fear. They buy capitulations. People like me, we buy capitulations. And that is why bottoms form generally during liquidations. The pool, the total size of the hodl pool is increasing, because when you think about it, right? If you want a coin to go up in price, you have to have people buying here, 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 and here, and here. The less coins that can be bought from here to here, right? From top to bottom, the easier it will be for price to rise. Right? Let's imagine two scenarios. There's $1 million of coins, or there's $5 million of coins, right? Obviously, if there's $1 million of coins between here and here, the price is going to go up easier than if there was 5 million. So when the trading pool shrinks, the amount of coins that need to be bought for the price to go up is significantly less. So a liquidation event occurs, the trading pool shrinks, it becomes really easy to move price up because there's not many people selling, right? Because they've already sold, and it leads to obviously a bounce. So that's another reason why you'd want to track capitulation events, liquidation events. It represents periods of time where the path of least resistance is up because the hodl pool is increasing, right? So now that you know how capitulation works, you understand that in a lot of depth. Let's get into some tools that I use to measure this. So for example, we have the Hunter algorithm. You can see the green triangles. They basically represent buy signals. You can see how it works really well, right? If you followed this algo, you would have bought here, 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 here. You would have bought here before price went up, 60%. You would have done really well. You basically, almost every signal was near the bottom or at the bottom, right? Pretty easy. The only one we missed was this one, but that's okay. We pretty much got it. We bought it 19K and it went to 16, same shit, right? So this tool, obviously you have to pay for this. This is a separate thing. If you want this, actually, you can go to hunteralgos.com and you can buy it here if you want. It's my investing tool. But basically what it measures is funding data, and it also measures the difference between the current price. Sorry, it measures funding data, and it's also about the distance between this moving average and price, okay? So if price goes below the moving average, we can get a buy signal, right? You see, every time we go below green, we get buy signals. Now, sometimes we went below green and it didn't trigger a signal, right? So for example, here it didn't trigger a signal. So what we need is some certain requirements which make it easier or harder for signals to get sent. But you can see here it didn't trigger either. So there's another requirement, and it's related to the funding data. So when funding is negative and price is below the green line, we look to buy. Because what happens during a capitulation event is obviously there's liquidations. When there's a lot of liquidations, generally the funding data goes negative. So if price crashes and funding's negative, that's the two main characteristics that are a capitulation event. Now, it's obviously not accurate every single time, but it has such a good accuracy that I've been using this since August 2021. So it's been almost 3 years of using this. And, these are pretty much all live signals that got sent, right? All of this is live signals, okay? I'm pretty sure none of these are fake. I'm pretty sure these are all real signals. Yeah, they're all real. So obviously, this is two things that matter to measure capitulations, right? Funding data and the price being below the moving average. So that's tool number one. Tool number two is realized losses. So let's bring this one up, realized losses. So you can see here that, let me get rid of this thing. So you can see here that goes negative, bottom. Okay, didn't go negative quite at this time, but you can see it went a little bit negative. This one, negative, bottom, and that negative, but it wasn't a bottom, right? Sort of was. Bottom, right? So you get the idea, right? This thing measures the amount of losses that are occurring in Bitcoin. Obviously, during a capitulation event, everyone's losing a lot of money. So if lots of people are losing money, then probably near a bottom. Okay, pretty simple tool. Long liquidations. So this is the liquidations thing that I talked about. See if it works. So you can see here that at the bottom, we had a lot of long liquidations, right? What you would do here is you'd basically just draw a line. Anytime the price went below a certain level, that's probably where you'd want to buy. So you can see not every time it works, but here it was good. Here it was good. Over here was pretty good. Some liquidations here. That was the bottom. So yeah, that's long liquidations. It's basically telling you how many people are getting liquidated in the market. Now, you shouldn't use these tools by themselves. These tools, I use them all together, and they all give confluence to whether I decide to buy or sell. All right, next tool is the bid-ask depth. So like I said in here, bit bright, eh? Like I said in here, experienced investors buy fear. So on this tool, it's basically the green represents how many buy orders there are, people wanting to buy, and the red is how many sell orders there are, so people wanting to sell. You can see here that every time we come to a bottom, there's a lot of buyers, or at least interested buyers who enter the market. And if you just drew a line here, right, you would have caught every major bottom in the market, okay? You would have bought here, you would have bought there, you would have bought here, and this one, I mean, if you drew it up, you would have bought there too. This tool is awesome because it is real data. It's showing you what is actually happening in the market, right? Coinbase, imagine someone has $20 million on Coinbase. They are a smart investor. They only want to buy during capitulations because they understand how markets work. They wait for capitulation to occur, which was what happened here. And then, the bids really come in. Okay, you can see the bids building up slowly as price. Ever since price had this capitulation here, the bids increased heaps. Okay, so that's a really good tool too to show you, not necessarily when the market's in capitulation, but when smart people are looking to buy, the people who have money. Now, the next one was DEX volume. So what tends to happen during a capitulation event is there's a lot of people swapping coins between each other. There's a lot of coins moving hands because, for example, during a capitulation event, a lot of smart people are buying. And during a capitulation event, there's a lot of people wanting to sell, right? Remember, we talked about the billions of dollars of selling that had to happen after the FTX event, right? Or, the amount of long liquidations that happen during a big crash. There's just a lot of volume. And this is showing you the DEX volume on chain. And you can see that we had quite a few spikes here. If you look at the time of these spikes, you'll see that they tended to happen during certain important market events. So May 11, 2022, let's have a look where that is. May 12, 2022, right? You can see that was at least a temporary bottom. Now we have March 10. Let's have a look where that is. So you can see that was the bottom here. A lot of volume happened there. A lot of people panic sold, a lot of buyers, a lot of just swapping hands. Where'd this data go? Can't find it. Here we are. I wouldn't count this period because it's a big chunk. It means there's just more volume on chain, meme coin trading. But let's look at, for example, did I do this one? I don't remember. Okay, let's look at May 19, 2021. So right here, right? Basically into that capitulatory bottom, we had a lot of volume, right? Big volume spike. So, capitulation is often shown through lots of volume. So that's what you would use this for. And the last tool is aggregate funding rates. So we talked about the Hunter algo uses funding data. The funding data, one of the funding data sets can be seen here. So you can see that at the bottom, funding went really negative. At this bottom, funding went really negative. And you can see that during the bull market, funding went really high. And you can see that the funding here is going high again as we enter the next. Obviously, we're in a this is a bull market, at least for now, right? Who knows what happens after this video? Big COVID crash, huge negative funding. Negative funding here at the bottom. You can see that funding, is an interesting tool here. Basically, funding tells you what someone is willing to pay in order to long or short. At the bottom, people are generally very scared and they generally have a lot of conviction that price is going to continue to go lower. And thus, the more conviction the trader has, the more they're willing to pay for that position. If someone's very uncertain about their trade, they're probably not willing to pay a lot to keep it open. Now, I'm not going to get into why they have to pay to long or short. It's a very complicated topic, but just understand that traders and people, longing and shorting, pay fees sometimes, or they receive money depending on what is the more popular side of the trade, right? If everyone's trying to short, the markets are liquid now because everyone's, on one side of the order book. They try to encourage people to go to the other side of the order book through charging a fee to those on the wrong side and giving money to those on the right side. So if everyone's shorting and everyone's paying a big fat short fee, like what happened here, right? Negative funding means there's a lot of shorting. Generally speaking, that's showing that shorters have a lot of conviction. They're very scared. They think the market's going to zero. That's generally what happens during capitulation. That's where you'd want to buy, okay? So that's all the different tools that I use. That's capitulation, how I do technical analysis using a bunch of tools. I'll see with my devs if I can get you guys access to these tools. If you can, you'll see the links below this video in school. If I'm not allowed to, I don't know, we might, the Hunter Algo, you have to pay for that, but the other tools, Trading Light, you can get this, you have to pay a subscription to their business. This is free data, you can see the website here. But the other tools that were in TradingView, like this one, this is made by my dev. So I don't know if we'll, be able to give that away. But anyway, thanks for watching. See you in the next one, guys. All right, so in this video, I want to go over the importance of having a strategy / edge, and pretty much an overview of what my edge in crypto is. Now, I've been in crypto since 2017. I've been refining and building and making my edge better over the past 6 years. For the first 3 years, I don't think I had an edge. I really didn't. And I also didn't really make much money. And the better of an edge that I've gotten, the more refined my edge, the better my strategy, the more money that I've been making from the markets. Okay? So this video is really important because if you're watching this, I can pretty much guarantee you don't have a strategy. Most people I speak to, their biggest downfall is they just don't have an edge. They don't really have any competitive advantage over anyone else. And through building a strategy that works, you actually give yourself an edge over other people. And it is the edge which allows you to make money, right? Because making money in markets is like winning a sporting match, right? You're versing other people. There's one winner, there's one loser, and you beat them by having a strategy, by having a competitive advantage, by having a game plan, by having a process. All these different words to describe something very similar, which is basically you just have to be better than your opponent. And if you come into crypto and you're sort of just running around like a headless chicken, on the basketball field of markets, you're not going to win. Every single successful basketball team had a game plan, a system, coach, mentor, all the different variables that go into success. So you're in this course, which is a really good start. You're learning everything from me. But after you've done this course, you ultimately need some sort of a strategy or an edge if you want to make money. You can either build your own or you can follow mine, right? So buying the dip is not a strategy, right? If you just say, I'm just going to buy dips, it's not a strategy because you have to ask yourself, which dip, when, is there a point in time when you are looking to buy? Is there certain data that you need to see showing you that it's time to buy? Is which dip is it? Is it the 10% dip? Is it the 20% dip? You need to be more specific in a strategy. If the extent of your strategy is I'm just going to buy dips on this coin, you're an amateur. You're not going to win. Instead, a strategy is it's predefining a range that you believe has limited downside and high upside and only buying before it leaves that range. So for example, when he says defining a range, he doesn't always mean in this example that you have to say, I'm going to buy it when it hits 18K, because I don't think setting price targets for yourself to buy in advance is a good idea. But what you do is you say, okay, for me to get into the market, I need to define a range of what I want to see in the data and what I want to see maybe on Twitter in order for me to buy. So maybe I need to see everyone really bearish, maybe a couple particular accounts that are really dumb. Maybe I need to see the funding data really low. Maybe I need to see a couple other data sets really low. Maybe I need to check the sentiment in the community that I'm in. You need to define whatever it is that what data you're looking at define a range of what you need the data to show you, where you think the downside is limited and the upside is really high. And that is what will determine your entry. In this example, at least, there's many ways you can approach it. So how I would look at a strategy, just because, there's the word strategy, process, game plan, system, edge, all words to describe something very similar. So how I would describe a strategy is it's not the plan. It's not like my plan this bull run is to buy some coins, buy them low, sell them at the end of the bull run, because the plan is not specific enough. And the strategy is the principles and the system that you create, that you follow and implement, which gives you asymmetric upside. You implement the strategy, the principles that surround your strategy, and you now have an asymmetric upside on your investments. And through having, a system and a strategy, you gain an edge over the market. And the edge is basically referring to a competitive advantage, right? What is it about you that is better than everyone else? Are you more patient? Is your data better? Do you have insider information? Are you able to make faster decisions? Are you on the team? Can you influence the movement of a coin? Do you have a larger position? What is your edge that gives you the advantage over other people? For example, in basketball, if you're taller than your opponents, that's an edge. If you're faster than your opponents, that's an edge. If you're better at dribbling, that's an edge. If you're better at shooting 3-pointers, that's an edge. What is your edge? Well, it's generally speaking the strategy that you follow. So what makes a good strategy? What is the components of a strategy? Well, we can get a little bit nerdy in this video, and it's going to probably bore a lot of you, but you know what? This is what you need to make money. But here's, I would say, 8 or 9, I can't remember how many there is, 8 or 9 really important components that make up strategies. Now, just a little disclaimer, not every strategy needs all these numbers exact. Okay, but this is just a list to give you the full list that I would look off of in order to build your own strategy. Now, if you're going to become a full-time trader, you're going to need all of these mapped out. You need every single one of these mapped out. If you're trying to be a long-term investor in the stock market, you probably don't need all of this. You can probably get away with having a much simpler strategy. Like, you don't have to get super complicated. Okay. Now, this is what makes up a good strategy. So you can see the win rate, the risk to reward ratio, back testing the strategy, seeing if it worked in the past, seeing if it worked in the future. Does it scale to larger amounts of capital? Is it tax efficient, or are you going to get destroyed by taxes? And does it have a positive EV, right? What's the entry and exit criteria? What makes you want to buy? What makes you want to sell? What's the validation, invalidation criteria? All these different things, right, is what makes up a strategy, in my opinion. There's obviously different ways to approach it. So what's a bad strategy? Well, a bad strategy is just blindly following Twitter and YouTubers, right? That's what most of you do. The strategy is just, I'm just going to listen to my favorite Twitter account. Or your strategy is, really focused in on the coin that you buy and not on the process of determining when to buy and when to sell. What sort of entry and exit criteria do you need to determine where to buy? See, the strategy never actually mentions the coin, because the coin isn't actually the really important component of the strategy. It's everything else around it. Because in crypto, you can buy the best possible coin in the market that's gone up 1000x. Just because you bought a coin that went up a lot doesn't mean you're going to make money. You could buy the shittest coin in the market, but if you have a really good strategy to know when the bottom and top is, you can make multiples on your money. Even the worst coins in crypto go up at least 3x in a bull run. So you can triple your money in a bull run, which is 30 times more than a stock market return every year, by having a really shit coin, but a really great process / strategy / edge. So people always focus in a bad strategy on the coin, but they don't focus on the process. And we've talked about this already in the course. You can see the course all is in order and it relates back. Now, what people also do is they make emotional decisions, not process-based decisions. So in the strategy, it tells you buy because the market's in fear. In the bad strategy, you buy because, you're feeling greed, right? And there's no justification for, why it can give you asymmetric returns. Now, again, a bad strategy has a negative EV, a negative expected value. So if your strategy is to play slot machines are rigged against you. Every dollar in is an expected value of 90 cents out, 88 cents out. It's a rough range of that. So the EV of slot machines is negative. So if you have a bad strategy or a bad edge, your expected value of your portfolio is negative. And also, a lot of people over-focus on the plan and not enough on the actual system. So people, they'll go, okay, so my plan is buy this coin, buy that coin. Okay, I'm gonna just buy it when I think it's low. and then I'm going to sell it when I think the bull run's ended. The problem with that is you're not allowing for scenarios. You're not planning for scenarios where you might not be able to do that. How do you know that you will know where to sell? You know, when you say, I'll know where to sell, how do you know that? How do you know that you're going to know where to sell? Oh, I'll buy it when it's on a dip. How do you know what's a dip? What if it's a dip before the beginning of a 90% retracement? You know, the plan does not get specific enough. You need to build an actual system that holds you accountable and sort of plans for all scenarios. You know, you have to have, like I said, what is the criteria you need to buy? What is the criteria you need to sell? And when do you close the position in a profit? And when do you close the position in a loss? Right? You know, what's your stop loss? What's your take profit level? You know, all these different things. Now, why you must have a strategy in markets and just zero sum games in general, your profit is someone else's loss. We've gone over this already in the course. Okay. This is like one of the first videos. Thus, you're in direct competition with everyone, right? You make money, someone else lost money. It's a competition. You win a basketball match, someone else loses. So the only way you win competitions is by being better than your opponent. Maybe sometimes you get lucky and you're worse than your opponent and they just had a bad day. But if you want to win over a 20-year time frame, become a world champion, you have to be better. So the only way you're going to get better is through having a strategy, through having a game plan, right? Making millions from crypto requires you to become international level skilled at crypto. It is the same as competing in the top leagues of any sport. You need a coach, mentor, team, good environment, strategy, game plan, etc., etc., etc. So look at these photos, right? Top level soccer players, Mike Tyson, whoever the fuck that is. These are the top people in the top echelons of their certain sport. And for you to make $1 million from crypto, you don't necessarily have to be Mike Tyson level, but you have to be on the national or international scale for the equivalent of crypto, right? You want to become a millionaire from crypto. Do you know how little people have pulled that off? But you know what? Everyone, you know, there's so many people who've made $1 million, but they don't keep it. I know guys who've made $100 million in crypto and they lost 95% of it, 90% of it. It's because crypto's fugazi money and people without a strategy lose the money as fast as they make it. So if you want to make $1 million and keep it and pull it out and be able to keep growing it over time, you're going to have to get to NBA level, or maybe not NBA, but the one below NBA, WNBA level. That's women's, not W. Whatever the fuck the one below at the top level of basketball it is, you're going to have to get to that level in order for you to make and keep $1 million from the market. The only way you get there is through having a coach. Every really good investor was learning from someone. Have a mentor. Every really good trader had a really good mentor. Every investor that made lots of money had a mentor, a team. Every single good trader or investor exists within high-level communities of really good traders and investors who they run ideas by and make money alongside. Good environment, right? The communities you exist in. Strategy, game plan. You need all of these components if you want to make millions of dollars. So if you have a bad strategy, you're going to go out onto the soccer field and you're going to get fucking hit in the head by a soccer ball. That's just what happens, right? If you come in with a strategy, you have a strategy where you have a teammate here, you're here, he passes it to you, you go in for the layup. You only do it if this guy is positioned further enough out that there's a gap for you, right? That's a strategy. That's a particular move, right? That's an example. You know, you have a game plan, okay? That's what you need to be successful in the market. So let's break down each of these criterias and let's get super boring and talk about what each of these means. So entry and exit criteria is like, what is the data that you're analyzing? What's the sentiment that you're looking out for? What is it exactly that you need to see in order for you to buy? And you have to be specific. You know, is there a particular data set that you like using? Is it an intuition-based decision where you need to feel the fear? You know, how do you determine the entry and also the exit? What's your exit criteria? You know, when you bought because you had a thesis for something to play out. What is the thesis that you need to see play out? When the thesis plays out, how do you exit the positions? Is it all at once or is it over a period of time? You know, how do you know when the thesis is played out? What are you looking for to sell? You know, is the data real or fake data? Are you using good data? Is there fundamental analysis to check off on this sort of entry and exit criteria, right? And then we get sort of into what I was already saying then, the validation and invalidation criteria. So when you're investing, you don't use stop losses. When my algo tells me to buy, I don't use a stop loss. The fuck, why would I use a stop loss? Stop losses don't work for investments. You use stop losses for trading, but investing, you use what's called an invalidation and validation of a thesis. So if you own a coin in crypto and you're investing in it for the long term, people think that, oh, you know, I'm allowed to hold this thing down 90% because it's a long-term hold. No, you have to have an invalidation criteria. If a coin goes down 90%, it was invalidated before it went down 90%. If you were paying attention, it told you that it was not going up and you could have sold, right? So the invalidation criteria minimizes your downside because it gives you a point to exit. And the validation of a thesis would instead be the opposite. It's when you know when to sell. How do you know when to exit? Well, you bought because you thought, if I was to give you an example of this, Toshi, right? My thesis with Toshi is Coinbase has millions of retail. They send them to Base. They all buy Toshi. So my validation, my exit criteria is I want to be selling into the millions of users coming from Coinbase onto Base. That's who I want to sell to. So if I want to exit my position in my strategy, I have to sell into that person. So win rate, right? If you were to look at 100 different positions you entered following a particular strategy, how many won and how many lost? So I measured the win rate with my Hunter algorithms. It's around an 84% win rate since 2019, I think it was. So that's like 6 years or so, right? Pretty good. Now you also want to look at the risk to reward ratio, more so if you're a trader. So when you trade, right, you have, let's look at trading. Let me show you. Excuse me, keep drinking this sparkling water. It keeps fucking bubbling in my mouth. But let me give you an example of this. So let's go to the 5-minute chart. Okay, so with trading is a lot more about the specifics of the data than it is about intuition and more fundamental analysis. Trading is really about technicals, okay? And because it's about technicals, it's about numbers, you can get a lot more data crunching based sort of strategies. So for example, maybe your strategy is to maybe buy support. Maybe your strategy was to buy here and you put your stop loss here, right? And your take profit maybe is, right, maybe here. Let's just pretend this is a strategy, right? Your strategy is long the third touch of support. Let's say that's your strategy. What first touch, second touch, your strategy is buy the third touch, right? Who knows if this is profitable? Let's just assume it is. So you buy here and then your stop loss is here and your take profit is here. So you have, if we just measure out the risk and reward, long position, entry, exit. So let's put a stop loss at, all right, it's 0.5%. Let's pretend that's 1%, right? In this example, you have a risk to reward ratio of 10. So for every time, for one loss, you make 10 win. You risk 1 and you make 10 in this setup. Now, this is one component of a strategy. You also have to look at the win rate, right? So let's say the win rate was 20%. You won 20. Let's do it different. Let's say the win rate was 50%. So 50% of trades lost 1, 50% of trades won 10. So in 10 trades, let's do 1% and 10%. 1%, 10%. So in 10 trades, you lost 1% once and gained 10% 9 times. So you can see that this is a profitable strategy, right? The win rate and the risk to reward ratio combine together to make this a profitable strategy. This is assuming that the win rate is true and that you can execute the strategy with liquidity and all the different things we talked about, right? Is this tax efficient? Is it scalable? Have you back tested it, forward tested it? So that's just a little example there. Back testing. So pretty simple. How did the strategy do in the past? Did this work before? Forward testing, has it worked for you? Have you made money from it? Scalability, can you do this strategy to make you millions of dollars, or is it only, for a small amount of money? Taxes, if you're trading, are you getting destroyed by taxes? Would you be better off building a strategy that's more tax efficient? For example, in Germany, I think it is, you do not get taxed on capital gains if you hold it for longer than a year. I'm pretty sure that's what it is. Might have to Google that. But for example, a better strategy would be something maximizing for removing that taxation. So maybe a more investing strategy versus trading. And the EV, so expected value. After factoring in all the above information, what is the expected value of implementing the strategy? How much do you expect to make over 100 sample size, right? So let me give you an example of applying all of that into the Hunter algorithms, right? Hunter algorithms, let me show you this one. Oops, already on the right chart. So I've been designing the system since August 2021. I've got 2 full-time developers building it. We've been refining it ever since. It's been live for 2 years. It's been pretty accurate. We've been updating the data sets, randomly whenever we feel like we need to make the system better. And it's been performing really well. and we've done a bunch of tests to back testing, forward testing, all that shit. So let me tell you what happened. So the entry and exit criteria is basically the buy and sell signals, right? What's the criteria? Well, we need negative funding. That's number one. We also need price to go below these moving averages. So that's criteria 2. And there's also some very specific criteria, which I can't tell you, that is more fine-grained and specific. Okay. What's the exit criteria? Same thing, above red and positive funding. Now, as well as this, we also have like 5, 10, we have like at any given time, 5 to 10 other data sets that we use as confluence alongside this algo. So this algo will say buy, and then we check with all the other data and we see how high confidence of a signal is this. Okay. Now, the validation and invalidation criteria, this is more on the coin side. So let's say we use this to buy Ethereum or Solana. Maybe Solana, is getting outcompeted by new coins. Maybe we want to own a different coin instead of Solana, right? That would be the invalidation, validation sort of thing. Is the Solana thesis worth, holding this coin for, or has the thesis been invalidated? Win rate, 84%, like we talked about before. Risk to reward, we don't really calculate that because it's more an investing strategy. Back testing, it's been accurate for 6 years. If you look back here, we actually back tested it. So you can see it's been pretty good for a long time, even during the bull market. Forward testing, it's been around for, 84% accuracy since we made it. Pretty good for a forward tested investing system. Scalability, I mean, you can use it on Bitcoin, which is obviously super liquid, so it's very scalable. Taxes, okay, so one variable here is that this algo shows you how to compound your money. But if you're in a shitty tax country, you would probably not want to be compounding. You would just want to be holding. So it depends on your situation. And EV, we've never really calculated because it's more an investing system. It's not super important, but we have made a bunch of money following this. Okay. So now the ultimate goal of all of this data that we just went over is to basically remove this, right? There's 4 outcomes in markets. Win small, win big, lose small, lose big. Of all that data I just showed you, everything that we do building strategy, all we try to do is basically just not lose a lot of money. Losing a little bit of money is inevitable. You can never always win. Your win rate is never 100%. Winning big is what you want to maximize for. You want to win big as big as possible. And winning small is okay. That, comes sometimes as well. So all a good risk management strategy does is just cut out the big loss, right? That's how crypto works and how markets work. Now, I know we just got super nerdy and this sounds like an absolute pain in the ass. Like, how the fuck are you supposed to do all this? Oh my God. Just a heads up, not every strategy needs to be super not numbers oriented. Doesn't have to be as data backed. It can be a lot simpler. Okay. Some money making strategies are so nascent and emerging that there can't really be a number backed system. Also, sometimes people can get an edge in the market, which is a lot less data backed and a lot more maybe alpha backed. So for example, you're friends with the founder of a project. He shares with you information before they release it. I guess that's sort of like insider trading, could be considered illegal, but that is an edge. That is a strategy. Okay. It is. And you don't need data to back that. So that's just a disclaimer, right? So for example, with trading, you must have a clear strategy. You have to. It has to be super specific, everything mapped out. It's the most anal thing ever, okay? All the numbers have to be measured. You got to track every trade, journal, data, everything, okay? But with airdrop farming, I would say it's half-half. So there's no exact system for airdrop farming because a lot of the variables are unknown. Like, they don't tell you that they're dropping a token. They don't tell you how to get an airdrop. So you have to guess what to do. You have to guess what the system is, right? You have to guess, you have to make it up. What's the strategy? You have to make it up. So what we mainly do with my airdrop farming is we minimize the fees. We only do airdrops we think are going to make lots of money. We automate it so that there's no human time loss. And we come up with estimates that help us determine what the best airdrops are. Okay? That's basically as far as we can go in terms of a system. Now, the strategy, the edge is in the automation. The automation is the biggest edge that we have. And it's also in my ability to find projects that I think are going to do big airdrops. Okay. So that's what I would say the two biggest strategies are. The two biggest edges are. Okay. And you also need to understand that the less importance to just exactly follow a system. If you're a beginner investor, the most important thing that you can do for your investing is to exactly follow someone else's system, right? You don't know what the fuck you're doing, so you need to follow what someone else is doing, right? That's the key. It's super important. But as you get better, not as important, but still very important, okay? When you're a beginner, you don't have pattern recognition. We've gone over this earlier in the course. You don't have intuition. You don't have the ability to make neutral decisions. You're going to be emotional. The system forces you to execute appropriately. As you become better over multiple market cycles, you'll find that you become less reliant on data to make decisions. A natural intuition will form where after viewing data, your decision making is determined by the gut instinct to a large degree, okay? Having a proper system is still important regardless of skill level, but with real edge, the real edge with pros is their discernment from intuition, okay? The best traders, the best investors in the world can figure out if an investment is good or not within 30 seconds. And I've already gone over this earlier in the course. It's one of the videos. Which one was it called? I think it's called Pattern Recognition Database. That one's super interesting. This is what all the pros do. They can tell if something is good or bad within 30 seconds. And that intuition becomes their edge, right? The intuition is the strategy, right? When you implement a strategy, you gain an intuition for when, for example, right? Let's imagine strategy is language, right? French. Imagine you can't speak French. You learn French by reading it and speaking it. And when you can speak French, you don't need to learn it anymore. You don't need to copy the French. When you speak to someone, you don't need to look at a book anymore. Oh, how do I speak French? No, you can just speak French. You just know French. You don't need to learn French anymore. It's like with a strategy. When you first implement it, you have to read it like a book, like you don't know how to do it. Once you've got the strategy downloaded into your head, a large degree of the process is just, you don't need anything outside of yourself, right? And this is an edge that a lot of the pros have, especially more so in investing. It's they look at investments and they can just tell because they've downloaded the strategy into their head, right? And they use they've downloaded it in the form of intuition. Okay? Subconscious. Can't be coded. You can't code intuition. Okay? Now, I want to take you to, let's read this first. Yes, a system can be as simple as I implement another professional system alongside him. So yeah, your system can just be copy me, right? That can be your system as long as you copy everything I do. Now, that's more referring to like my mastermind. If you want to copy me, that is a system, right? You don't have to build all this shit. I know it probably fucking bores. This is probably boring all you guys so much. But anyway, let's get to the exciting part. Here is my strategies, okay? I have 4 main strategies, I would say. So my edge is I have 2 full-time developers who find the best data in crypto that I know is good, and we use it to determine when the market is in fear and in greed. We also use our own intuition to determine when to buy. And the goal is that we want to capture 6/8 of a trend. So buy Bitcoin low, sell Bitcoin towards the end of the bull run. And we use my fundamental analysis framework to select my investments. So are we going to go heavier into Bitcoin this cycle, heavier into Solana? What is the play? Second edge is pre-sales. So basically, we invest into startups early in the bull market or late in the bear market when the valuations are lowest. And the goal is that we exit during the bull run. Okay, that's an edge. We get access to the best deal flow. Edge number 3, automated airdrop farming. So we find uncrowded, high market cap potential projects with a high chance of doing an airdrop, and we auto farm them with as low of a cost as possible. That's a strategy. That's my edge. And another one, I would say my other edge is 100x shitcoining. So it's basically using my fundamental analysis framework that I give you guys in this course to find 5 to 100 million market cap coins within an emerging narrative with a solid team, and you hold these through the course of a bull run, okay? My strategy here is actually very similar, and I've referenced this picture a couple times now. It's very similar to Mikey's strategy, right? He does fundamental analysis on altcoins. He enters sizable positions with conviction, and they're all within a $5 to $100 million market cap. And he just sits on his hands for 2 years. And I've found that this strategy works for me. For example, in the last bull run, I rode Solana from $7 to $250, and I sold half at the top, and I should have sold the rest, but I didn't. In this bull run, so far, it's pretty early days, but Toshi at a $2.5 million market cap, it's now at 67. Hopefully riding this one to $1 billion market cap, okay? I used my fundamental analysis framework that I teach you guys
to buy this one low, and I just hold it and I don't do anything. Okay? So that's just to give you an example. Now, that is everything in relation to the importance of a strategy and an edge, and to give you an overview of mine. I know this is sort of the boring part of the course, but this stuff is really, really important. Later on in the next videos, I'm going to go over what you should do to basically have your own strategy. Just to summarize, there's two main paths. You either follow the pro or you become the pro. So you either implement my strategies by joining my mastermind, you get access to all of these. All of these. Or you can, I guess, create your own. So I've given you the fundamental analysis framework. You can use this framework as a strategy to pick the right coins, right? You obviously have to do the research yourself, but you can use my framework as a strategy, right? Long-term investing, I'm going to tell you how I made my system, and I'm going to tell you a lot of how my strategy works. So you can sort of copy mine and make your own, right? So you can do pretty well by yourself here, but if you want it to be simplified, you can just join the mastermind, right? All right, so now that we've gone over in this market psychology section the concept of fear and greed, I want to introduce another concept which is market psychology related, but it's also like a partially mindset trick that you can implement in order to understand the fear and greed concept better, and a sort of way that you can implement it. So we talked about in one of the other videos how market cycles work, how we go through periods in the market where there's a lot of greed and where there's a lot of fear, and you have to do the opposite of what the market is feeling in order to make money. It's easier said than done, the process of buying when it hurts and selling when it hurts. You know, buying when it's fearful, when the market's fearful, and selling when the market's greedy. But I want to give you today a little bit of a mindset trick, another understanding into market psychology to further help you implement investing knowing the market psychology. So when you buy something in the market, I want to just talk about buying for now. When you buy something in the market, you will always feel pain. Now, you have to decide which pain you would like to feel, because there's two choices that you have. Choice number one is the pain of making money. Now, what do I mean by the pain of making money? When you buy something, if you buy it when it felt good, there was no pain when you bought, right? You didn't feel any pain. So you're going to have to feel pain eventually, because you always feel pain when you buy something. So if you felt good when you bought something, the pain that you're going to feel is when the price goes below your entry, right? And I want to visualize this on a chart to help you understand. So let's pretend this is a price chart, right? You have two pains. You either have the pain of buying when it felt good near the top and then price going below your entry, or you have the pain of buying when it hurts and then you make money. So it's the pain of making profit. So you either have the pain of making money, buying the bottom, or the pain of buying when it was easy, when price goes down. And it is always one of two outcomes. Now, very, very rarely, very occasionally in markets, sometimes you will buy when it feels really good with your long-term investment, and you won't have to experience any downside. So you'll buy, sometimes you'll buy here, let's say price is like down here, and it will feel confident, and you will never have to experience any pain. Nothing in terms of a loss. But that is very, very rare. And what you want to maximize for is, if you want to be long-term profitable, is making buying decisions when the pain is the pain up front, right? So the more pain you feel up front with making a decision in the market, the better you're setting yourself up for the long term, right? And this is sort of like a concept with everything in life, right? When you want to have a good night, you drink alcohol. What does alcohol do? Well, it gives you happiness now so that you have the hangover tomorrow. When you want to go to university, you take out debt now and you pay it back later. When you drink coffee, you take energy now and you get tired later. When you do drugs, you feel amazing now, you feel like shit later, right? Most things in life that people do create the mindset within them that the goal is to maximize for feeling good now and then worrying about the consequences later. But if you do that in investing, you're going to end up losing all your money. Because if you execute that strategy in investing, what ends up happening is price goes up like this. You buy when it feels good, so you have the happiness today.
and then you pay the consequences later. Now, obviously in this exemplar, you buy high, price goes down. If you held, price eventually goes up and now you're in profit. But if you execute a strategy like that, you're making it much harder on yourself to make money long term. Because a lot of the time, you'll buy when it feels good, right? You'll buy around here, you'll be in profit a little bit, but then maybe that's the beginning of the bear market, right? Most people do this. They buy here, bull market, and then the bear market begins. They lose money for 2 years, and maybe, yeah, in like 5 years, you end up back in profit, but it's just not a good strategy. If you just bought when it was significantly more painful earlier in the bull run and then exited at the top, you would have been fine. But trying to enter when you had confidence is what fucked you up. The thing about people sacrificing tomorrow's happiness for today's happiness is very much apparent in markets. This is why we have these crazy pumps and bull runs and we have prices go down a lot, because everyone's chasing the pump and they're sacrificing tomorrow's happiness to feel good today, buying when it feels good and then not buying when it feels like shit. And yeah, that's just what people are doing. That's the market psychology. The market moves in the direction which fucks over the most amount of people. So if you buy when it feels good, everyone else is buying. And because everyone bought, the path of most pain is down, making all those people lose money. Because the market as well the market forces participation. That's what the market is designed to do. So the market does not want you to hold when a coin goes 100x. It wants to shake you out, take your money, and then go up 100x, right? The market will always try to manipulate you into doing what it wants you to do so that it can make money from you. So if the market is dumping and everyone's afraid, ask yourself, what is the market trying to get you to do? It's probably trying to get you to sell. If you feel like selling, that's the market doing a good job of making you feel like shit, and it's trying to convince you to sell. All right. So the market moves in a direction which is going to fuck you over, or the most people, and it's trying to convince you to participate. If you don't do anything, you'll eventually make money. This is why dead people are some of the best investors in the world. It's because the market cannot convince someone who is dead to participate in the market because they're dead, right? So if you don't participate in the market over a long enough time horizon, you're going to make money. But that's not me trying to say to you, just don't do anything. But the key to long-term success in the markets is to minimize the amount of participation that you have to do. So you should only be buying low a few times and then waiting and then selling high basically once. And that's an entire bull market of participation right there. The more rotations you add in, the more profit taking, the more trading, day trading, swing trading, flipping NFTs, the more participation you add, the more variables you add, the more risk you add, and the more difficulty you add to your investing. So for me, with the strategy that I teach you in this program, it's all about how to find and spot 10 to 100x opportunities, buy them low using a hands-off strategy, hold them through the course of a bull run, and then exit near the top and take all your money out with no taxes and a good banking infrastructure, right? That's like the goal of this course. And you do that by buying when it hurts, experiencing all the pain up front, and then holding and then selling, obviously, when it hurts to sell. And yeah, like I said, it either hurts when you buy the bottom or, you either lose money. So as well as this, buying fear or buying during fear is scary up front and peaceful later. I'm pretty sure this was a quote that I got from Twitter, but it was really, really good. I wanted to include it. Like I said, if you buy when it hurts, the pain is up front. The pain happens at the buying process, but it's peaceful later because it can only be better. If you buy when COVID's happening and the world's going to collapse, it can only get better from there, generally speaking. Now, buying greed is easy up front and scary later. So you naturally want to buy when price is near the top because you want to follow the herd instinctually. Every new investor will do this. They'll just naturally follow the herd. By the time you really feel like buying, most of the upside is priced in, and price will need to go lower when it returns into the next fear cycle. So let me repeat that again. I'm going to guess you guys maybe didn't get that. So by the time you really feel like buying, so near the top, up in the red boxes, most of the upside is gone, right? The price has already gone up. The upside's gone. And price will need to go lower when it returns into the next fear cycle. Now, what is a fear cycle? I'm basically referring to the period of time where the price is going down. So this is a fear cycle. This is a greed cycle, right? That's sort of the term I'm giving for it. So on the Bitcoin chart, We'll call this a fear cycle. This is a fear cycle, greed cycle, fear, greed, you can sort of see up, down, up, down. The price during a fear cycle is almost always lower than the price you buy at with some form of confidence/assurance. This is a very important sentence. I'm going to read it again. The price during a fear cycle is almost always lower than the price you buy at with some form of confidence assurance. So let me show you on a real chart instead of some fake shitty charts, right? This is a fear cycle. This is a fear cycle. This is a fear cycle, right? The price almost always goes lower than the price you buy at when you buy with confidence. So where do people buy when they have confidence? Will they buy here, here, here? This is where I know you can't really tell that the confidence is there, but trust me, this is where people were getting really bullish. Okay, here and here. Now, what has happened every single time you went and bought confidence? Well, you first lost a bunch of money, right? You lost a bunch of money, lost a bunch of money, lost money. Now, eventually it went to higher highs, but if you're trying to be a smart investor, wouldn't it just be easier to buy when it hurts up front so that you can make even more money? If you end up buying when you have confidence, you pay a premium, you make less money. So it just makes sense that you buy it when it's cheaper. So buying during a fear cycle peak, so the bottom, right, guarantees you won't lose much. You won't experience, I think that's meant to say experience, much. You won't experience much or any downside on your portfolio. Instead, you face the pain up front. The most profitable strategy in crypto is to face pain up front, to consider all the risks and upside before the position is even entered. You should mentally be considering 50 different what-if scenarios before your entry occurs. Now, this is for long-term investments. If you're trying to buy an ape as shitcoin and you need to buy very fast, you can't be like, oh, what if? Because remember we talk about the IQ meme, right? The IQ meme in practice. If you're aiming to implement a low IQ strategy where you have to fast execute and you have to buy now and research later, then you can't consider all the what if scenarios, right? But if you're looking to do a long-term investment, like for example, Toshi or Ethereum or Solana or whatever, then you do need to consider all the what if scenarios because that's a proper investment. That's not as much gambling, that's more investing. So you have to ask yourself, like, what is all the potential scenarios? Is there enough pain up front where I'm getting a good entry? How much pain did it take to buy? Ask all of these questions. And asking what if shows that you have done the thinking and the consideration up front, maximizing the chance of a good entry/exit. So you have to ask yourself, like, what if this positive news doesn't come out? What if the market isn't scared enough? What if blah, 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 right? When you ask what if, you give yourself different perspectives and it allows you to remove bias to make more clear decisions. But obviously you have to be careful. A lot of mid-curve people will be thinking like this, like, what if, but what if that goes wrong? Oh, you can't buy Toshi. What if it's a scam coin? What if it goes to zero? He's mid-curving it, right? It's a mid-curve. So you have to be careful that you don't mid-curve when you use this process. But anyways, this is, you have to use it and analyze to the extent where you're in the high IQ bracket. Okay. Again, just to summarize, you either feel pain when you profit, because you take all the pain and the fear up front, or you feel pain when you buy high and you lose money, either short term or long term. Okay. All right. So when you guys are building a strategy, you have two choices in terms of how you approach strategies in crypto. So I would say that if you want to succeed in crypto long term, you either have to follow someone who's already a professional, someone who's already got strategies that you can sort of implement and make money from, or you have to become the pro. Okay. I think it's really just one or the other. Now, the thing that you can't do, right? You can do this one or you can do this one, but the thing that you can't do is stay an amateur. Okay. The word amateur cannot exist in your crypto strategy or edge if you want to make money, right? So you can't follow an amateur. Right? So you have to verify who you're following as a pro. If you follow some dude on Twitter who's actually just a glorified gambler, you're not following a professional. You're following a dude who just chucks his money in the casino and sometimes gets lucky and probably makes money from exchange referrals, right? And just getting popular on Twitter. So you need to verify that you're following a pro. Now, the other way that you can make money is obviously become the pro. So you can't just become an amateur. You can't stay an amateur. You have to level up to pro if you want to make money. Okay, so it's either follow or become the pro, two paths. Like I say here again, two paths to make money. Follow a pro or become one. Anything outside of this is just going to lead to losing money. And this is why when you get into crypto for the first time, your first market cycle, you tend to not really make much money. It's because during your first market cycle, you're not either of these. You're not really following a pro very closely. And even if you do, you're probably just making mistakes, which I'm going to go over in this video. Or if you are trying to become the pro, you're just not a pro yet. And it takes, 3-4 years to become a professional at crypto because you have to experience the full market cycle, right? The full circle. If you've never experienced, right? If there's a gap and you've never experienced this bit, are you going to know how to not make the mistakes of this part? Well, you've never experienced it before. You have to go through and experience that part. And once you've had the full market cycle, then you can pretty much classify yourself as a pro if you've done everything correctly. Okay? So let's go over how each path works. How do you follow the pro? Right? Am I saying just copy some dudes on Twitter or, watch YouTube videos and just buy coins that people tell you to buy? No, this is not what I refer to when I'm saying follow the pro. So imagine you're trying to become a really good boxer, right? You're trying to become a professional boxer. Do you try to become a professional boxer by watching YouTube tutorials of boxing? Or is it better that you go into a boxing gym and work alongside a professional boxer who's had many professional fights and won many professional fights, who's there right in front of you training you? It's probably, the second one's probably better. I don't think you're going to become a professional boxer just watching YouTube videos from your bedroom. Okay, you have to, be working much more closely in person, in real life, alongside a pro. Okay, you can obviously get to a certain level in boxing, doing it in your home by yourself, shadow boxing, stretching, any cardio-based workouts. But I think you need to, if you want to become pro, you have to do the full thing. So it's a similar idea with following a pro in investing. When you do boxing and you're on a call with someone, it's never the same. If you are on your phone watching a YouTube video of how to, make money in crypto, it's not the same as working alongside a pro. And I don't mean the guy comes to your fucking house. I mean like the guy's like giving you a lot of depth and individualized answers to questions, and he's telling you everything about how he makes money. So for example, on Twitter, there's no guy on Twitter that has an obligation to make sure you understand everything they say. So a lot of the times these guys tweet things, you have no idea what they're saying. And they don't have to reply to you and clarify things. Also, so many people shitpost on Twitter. So how do you know what's a real opinion? How do you know what's a fake opinion? As well as this, everyone on Twitter will tell you when they've bought, they will tell you how much money they've made, but they never tell you when they sell. So if you're trying to follow the pro, he gives you half of it, right? The buying side, but he doesn't give you the selling side. So it's like the most important part he leaves out, right? So you can't just copy a Twitter guy. And also YouTubers, they'll tell you buy these 3 coins. But the coin, as we've gone over, is not important. It's about the process. So the YouTubers actually don't even know how to make money either. You try to follow a guy who you think is a pro telling you what coins to buy, but he doesn't understand that it's not the coin, and neither do you. You both think it's about the coin. That's why you both lose money, because you're both not pros, right? Now, when you do find someone that you would consider a pro on the internet, at crypto, as pro as you can get, really, because it is an evolving industry, you want to only follow like 2 maximum, right? If you end up, saying, okay, I'm going to approach this bull run following the calls of 4 influencers, it's not going to work, because one of them's going to say the market tops in, sell here. The other one's going to say the market's going higher, sell here. Which one do you listen to? Well, both of these people could be profitable, because this guy selling too low, maybe he bought way down here and he's in a massive profit. Maybe this guy is trying to be more aggressive because he bought here. So maybe the distance between the buy and the sell region is actually the same, but they just entered and exited at different prices. So maybe you bought when this guy said buy, and now you're going to sell when this guy says sell. They're 2 different guys, 2 different strategies. So if you follow too many people, it gets mixed up and it gets confusing, and it doesn't work. Okay? So in terms of like following people, you should join their community. If they run a mastermind, if they run a paid group, whatever you want to call it, you should join the community that they run, which is the highest level, that is going to get you that personalized approach and access to everything,
right? Don't be selective with what you follow. This is the big problem a lot of people make. So you'll see a guy make a call to buy a coin and he'll have really, really big conviction on it. He'll tweet about it all the time and he'll tell you it's an amazing coin. The problem is the conviction is built during a certain period of that coin cycle, right? When you see a guy tweeting all this conviction that he has in a coin, right? And let's imagine this is the coin's bull run, right? The conviction happens above this level, right? That level of conviction and bullishness and confirmation does not happen here. It happens up here. Most of the time it happens here, near the top. So by the time you see a guy super bullish on a coin, you're thinking to yourself, okay, he likes this coin the most, so I'm going to buy this coin because he thinks it's the best, because so I have the highest chance of making money. That's the wrong approach. The more confident someone is, right? Confidence, the higher the coin probably is in price, the closer it is to being a top and the less money that you make. So in actuality, the best coin to buy if you're copying someone's portfolio is probably the one they are most concerned about, because the concern comes in when the coin is underperforming or when the coin is, for example, in the fear stage of its own cycle, right? You can't be selective. If you say to yourself, I would just like to follow the strategies of this person, you have to do everything they say. You can't just be like, oh, I'm going to not follow him today because I can't be bothered to buy that coin. Or, you know what? I think he might be wrong. No, that's not how you follow the pro. You have to do what they say if you're going to do it. Everything or nothing, okay? I had so many guys in the mastermind not buy Toshi, right? When I said to buy Toshi at $2.5 million market cap, I gave them an entire week to buy. And a lot of them, not everyone, a lot of them bought, but a lot of them didn't buy. And it was because they were being selective, right? And now it's gone up 25x. Now they say to themselves, okay, I'm sorry, Daniel, I will never go against you again. I'll just do what you say. Now they understand. If you're going to follow the pro, you have to do everything they say because they're profitable and you're not. So anything you do by default is not going to make money. And by default, if you do everything they do, it's going to make money, right? Another point, don't copy traders. So maybe you want to become a day trader, a swing trader. You cannot make money long-term copying traders. The only way that you can make money as a trader is to become the pro. It is to become the professional trader. You're not going to piggyback off of someone else's trades and make money. The reason you can't copy traders and make money is there is a level of time sensitivity to entries and exits that if you are not able to completely implement, you will massively underperform. And if you try to copy them, your strategy will probably be inferior. Also, trading is not really about the strategy. It's more about the emotions, right? When you're trading, a lot of the time you might be using leverage. If you're dumb, you're probably using leverage. The smartest and the dumbest people use leverage, right? That's sort of what generally happens. But let's say you're using leverage, you're trying to day trade, the market's really volatile. The emotions required to be profitable, the lack of emotions, the control of emotions to be profitable, so much higher of a requirement than to be an investor. When you invest, you just copy someone, buy low, do nothing. All you have to do is just not look at the computer screen. But with trading, you have to look at the computer screen because maybe when you're day trading, this guy you're following enters a position and then he says, oh, I'm closing it 10 minutes later. You have to be there ready to close the position or you're going to be selling maybe after the price has gone down, right? And you lose money. So when you copy traders, it's very difficult to make money. When you copy investors, very good. Or let's say you airdrop farming. Let's say I told you, farm this airdrop right inside the mastermind. I said, farm this airdrop. And you said, okay, right? Pretty easy for you to follow. There's no emotional management like trading. It's pretty fucking easy. Let's imagine I said, I'm investing into this pre-sale. I think it's good. You should follow it as well. Like pretending like you're a mastermind member. Do this pre-sale. It's super good. Okay, copy. It's easy. There's no skill there. No skill requirement. You can copy people when there is not a huge skill requirement. Right? Investing is pushing it. There is a skill requirement, but trading is just way too hard. Okay? So this is how I would follow the pro. Get close to your favorite investors. Get into their high-level communities. Follow everything they say. Don't be selective and don't copy traders. Okay? Now, when I say don't copy tweets, remember we made a video about influencers create liquidity, not alpha. Right? All the videos are starting to link back together here at the end of the course. This is why you can't copy Twitter accounts. Now, the other way is obviously become the pro. This is strategy number 2.
So long term, I think every single person, well, not every single, but most people should aim to become a independent crypto investor, or they should invest their money into an investment fund. I think that's the two main paths. You either put your money in a fund so someone else manages it for you, or you become the pro. I think that's like the best possible paths that you can take long term, like for your lifetime. That's the ultimate goal. Now, consistently study and invest in markets for 3 to 5 years is what you need to do to become the pro, right? It is a minimum 3 years, usually 4 to 5 years, for you to become what I would consider a professional at the market. And during this period, it's a lot of learning, losing money, you have to pay your tuition. We talked about this before. And refining an edge is a big part of it as well. Like, people think that, oh, I just make enough mistakes and lose enough money that I'm suddenly profitable. No, you have to really refine your edge. You have to really figure out, what am I good at? What do I like doing? What's my strategy in crypto, right? Making money in crypto is like playing Call of Duty and having this one spot that you camp on the map and you just snipe everyone, right? Because when you camp and you start sniping everyone hates you because you're getting a good score for doing nothing. But that's how you make money in crypto. It's positioning yourself in one location or a couple locations where if you just wait for someone unsuspecting to walk past, you snipe them and you win. Same thing with crypto, right? If I just wait for a crash, wait for fear to seep back into the market, I use my data sets, I can figure out where to buy. Waiting for an unsuspecting person panic selling, I buy into their panic sell. It's the equivalent of me sniping them in Call of Duty. That's how you make money in markets. What's your edge? Where are you camping on the map? So don't, and people hate on campers. Oh, fucking camping on the map, you idiot. We're here to win. There's no ego. There's no award for the money being hard to make, right? There's no bonus prize because it was really hard for you to make money, right? The money is the same whether it was simple or difficult to make, whether it was easy or hard. Don't make it overly hard on yourself. Just do whatever the edge is the best, the easiest, Don't worry, you can camp on the map. As well, you need mentors, okay? If you're trying to just become independently profitable by yourself, it is definitely a viable path. Definitely you will eventually become pro. But if you want to become pro faster, as in make millions faster, you have to have mentors. When I was 19, I emailed this guy like 5 times asking him to mentor me. He was a trader. He's in his 50s. He made his first million in his teenage years on the stock market. He's fucking making tons of money now, who mentors people. I emailed him over the course of 6 months many times. Can you mentor me? Can you mentor me? Here's information about me. Please, let's organize a Skype call. And he eventually said yes, hopped on a call with him. And from there, my life changed forever. He started teaching me how to trade. He ended up getting me actually an online job in the crypto space, which actually kicked off everything that I'm doing now. So it is that process of finding mentors, having mentors where they teach you things, right? I learned a lot of the mental models about business from Luke in relation to the War Room at Hustle's University, right? Working in Hustle's University, Luke shared lots of information about how the world works. And it really just taught me a lot about business. And now I apply all of these lessons into my own businesses, right? I would consider Luke a mentor. So I've had many other mentors that I won't get into, but that's the process, right? You have a mentor maybe for fitness. I have a fucking gym coach guy. He's like a mentor, right? He's not just lift this weight, do that. It's like a life coach. I hate that word, life coach, but he's like a mentor, man. He trained with Arnold Schwarzenegger, one of those super, super huge gym guys back in the day at Venice Beach. Really, really successful guy. These mentors you have in all areas of life are super important, especially in investing, such a difficult way to make money. And work closely alongside them, but aiming to become independent, right? The goal is not to have a mentor to just copy them forever. Eventually you have to stop sucking your mum's tit, and you have to, go out and fucking hunt your food. Also, figure out what strategy is best for you. To become a pro, you're going to have to make money by yourself eventually. So how are you going to make money? What's your strategy? You have to refine this. Are you going to be a trader? Are you going to do airdrop farming? Right? There's a guy on Twitter, CC2. His entire fucking identity as a human is just airdrop farming. right? His life is airdrop farming, which is cool because he makes money, right? And he's got, 70,000 followers. He's niche famous, but that's his niche, man. Look, yield farming, wallet tracking, airdrop hunting. The main thing is just airdrops, right? So what's your edge? My edge is I do automated airdrop farming, long-term investing, and pre-sales. That's it. I don't try to trade. I don't try to do yield farming, any of that shit. Just focus on my edge. Now, over time, you will eventually have to develop your own investing system as well. You're going to have a risk management protocol. You're going to have to journal everything. You're going to have an actual edge in the market. This is the eventual end state of every person who tries to become the pro. Eventually as well, you're actually not going to follow other people's calls. I don't follow any dude's call on the internet. Maybe someone posts a coin that I look into and then I build my own thesis and I really just don't care about the fact that they liked the coin. But I'm not just going to go, oh, this guy said to buy, I'm going to buy. I don't do that anymore. I don't need to. I have my own edge. You don't make money copying people from Twitter. I've already gone over this, right? I've learned this one firsthand, right? Influencers create liquidity. They don't make alpha, okay? So that would be the last point to become the pro. Eventually, when you're good enough and you are the pro, you will know because you won't be copying other people's shit on the internet, okay? This is like 2 exemplar paths that work. How would I actually approach it? Well, this is the best path that I would recommend. So what you should do is you shouldn't disregard skills. You shouldn't disregard networking, finding mentors, building a business, or building a career. This should be your main focus in life, okay? Building this stuff. Now, alongside building this stuff, you should be investing, okay? I think investing is the number one skill that everyone should have. So you should be trying to be a profitable long-term investor. That's the goal, okay? And you should be trying to invest alongside your favorite investors, okay? So you do this by joining their high-level communities if they run masterminds, if they run paid groups, if they run one-on-one coaching, whatever it is that they run, find your favorite investors, favorite traders, whatever it is, and you need to become friends with them or just work really closely alongside them. Just copying their Twitter is not enough. For example, there was a guy in Australia who ran an investing group called Crypto Consulting Institute. Years ago, I joined his program, and I wanted to learn not just how he ran his business in terms of the coaching structure, but I also wanted to learn how he approached investing. And he actually taught me a lot about making my approach to investing more professional. So I joined his high-level community. It was like 5-6K Aussie, and I ended up becoming friends with him, and he offered me work, but I didn't take it, but he offered me work in his company. That's how you learn from people. Also, when I was 19, there was this guy on Instagram, and he was like a investor. He was really fucking good at crypto investing. I ended up joining his community. I paid like $2K US, I think. This was in 2019 before COVID too, so it was probably a bit more money than now. But yeah, his group was really good. He had a full course on investing, sort of like what this one is now, I guess. I guess we've come full circle, right? I joined some dude's course who was making millions, and now we've sort of like swapped places. And now I've made my own course, and you're going to go on make millions and make your own course. It's just a continual fucking little Ponzi scheme. So, but anyway, back to the point. I joined his high-level community, and I learned all this stuff that I couldn't find online. It was super valuable. I learned so much from his course. It was fucking really good. Now, the goal is you want to become these people's number one student. I know a lot of successful people, just to give you an idea, not all of them, but I would say most of them were the best student of someone in the thing that they're the best at. So for example, working with, actually, no, I won't use that as an example. Actually, no, I have an example. So for example, there was a guy working with the Tates, and he was the number one sales guy for the War Room, right? This online network thing. And basically, he became the number one student of the guy teaching that, sales for selling that program. And he was really, really good at sales. And now he's super good at sales now. And he's gone on to build his own businesses and leverage the success that he had within that program. And, he's a very smart guy. I just want to use that as an example of how you need to approach things, right? He found who he thought was the best person to learn from, and he grinded his way to become their number one student. And that opened up for him tons of doors, and it taught him more than any other person working for that company, sales, marketing, building a business, etc. Okay, and that pays dividends later on. So for example, there's a guy that I know who makes $500K a month in a marketing agency, basically scaling ecom brands. He originally worked for Nick Cosman, and he became Nick Cosman's like #1 student. And then he went on to build his own sort of Nick Cosman style business. Now, if you don't know Nick Cosman, he basically teaches you how to make a growth consultant business. He made like 8 figures. And so he had a #1 student, I won't say his name, and he went on to make $500K a month from his own growth consultancy company. I'll give you one more example. I met a guy in Cape Town. He makes $1 million a month in a business, basically teaching doctors how to become, independent of a 9-to-5, leveraging their skills that they learned in university. He makes, like $1 million a month, barely does anything in the company. He's outsourced everything. And I asked him how he did everything he did. And he said, I just became the #1 student of Sam Ovens, right? 150K subs. This guy, he used to run a program. It was a similar thing, right? Teaching you how to make money online, right? Same sort of thing, online money guru. And so this guy that I knew, my friend, joined his program, learning how to make an online business, and he became Sam Ovens' #1 student. And now he is making $1 million a month. Well, at least a year ago he was. Maybe now he's making more. Basically fully automated, and he's like in his 30s, and he's fucking printing. So in all areas of life, the guys that I see that have the best results, they always say the same thing. I just became the #1 student of the guy that I looked up to, and then I just printed money. So whoever you decide to learn from in becoming an investor, becoming a trader, try to become their #1 student. I think that's a really good path. Follow their lead at first, but the ultimate intention is that you want to understand why they do things. So if you're fully focused on business and you do not give a single fuck about crypto or investing, you don't have to do this part, but this is the best path that I recommend long term. So you want to understand why they do things. Hey Daniel, you told me that we should buy this coin. Why? What's the reason? Okay, cool. Thanks for telling me, right? Next up, you want to find a style that suits you and work with your mentor to develop your process/strategy over time. So when I was getting mentored by that trader guy, I was trying to refine a trading strategy with him, right? He gave me his strategies. I was trying to implement them. And then I ended up starting to take his and add my own little stuff that I thought was good. And I was beginning to develop my own strategy. But then I realized trading's not for me. And I didn't like that style. And I then pivoted into investing. And that's what really interested me. And that's what's really paid off. Okay. As well, you want to accept that your first 1 to 2 market cycles, you will pay large tuition fee. And that's normal, right? Most people take 2 market cycles before they make millions. A few people do 1 market cycle and then they make millions in the next one. Very, very, very few people make millions within their first market cycle and keep it. So you're always going to pay a tuition fee, sometimes longer than you think. And eventually, ultimately, over time, you're going to grow past your mentor into an independent investor who can consistently profit in markets without following other people. Okay, that's the ultimate goal. Now, I want to show you some case studies of what you have to avoid, what you must avoid in approaching crypto in regards to strategy. Okay, so you must avoid this path, not having the time to become the pro, but also not following closely alongside a pro, right? You either make money in crypto from following a pro or becoming a pro. So if you follow an amateur, you don't make money. And if you become an amateur, you don't make money. Or if you just don't follow anyone and don't become a pro, you're just not going to make money. So I asked people in my free Telegram group, I said, if you want to plan for the bull run, message me and I'll give you a plan. But I first wanted to figure out what their existing plan was. So this guy, he said, I'm just looking for the best coins to buy. Let's say I said to him, okay, I'll tell you the best coins to buy. And I just told him my coin list. Do you think that he's now going to be profitable? Did he follow any pros or did he become a pro by just asking what coins to buy? No, he didn't figure out a process. He isn't working closely alongside me. He's not showing that he wants to become the pro because all he cares about is just buying coins and making money, right? He's focused on business. He doesn't give a fuck about crypto. This guy is not going to perform well this bull run. He did not fit one of 2 categories. Okay, so what should he do? Well, what he should do is he should go, hey, Daniel, look, I have 6 figures I want to put into crypto. I really don't have the time for it. I don't give a fuck about crypto. can you just tell me what to do and I will do it and I will learn alongside you along the way, but I just don't want to figure it out for myself right now, at least right at this moment. Then I would say to him, that's perfect. That's what the mastermind's for, okay? But that's how he should approach it. Now let's look at another one. So this guy, student, he's got 67K. He wants to get, his plan is to get into early projects that have good utility to run and invest. And his goal is to make 7 figures. So he wants to 12x his money and not lose. He wants to basically become a millionaire as a student, right? Busy student, not spending much time on crypto in one bull run, right? And I tell them, make sure to answer with depth or I can't help you. And what did this guy send? Fucking 1 sentence. So basically what this is telling me when I read this is that this guy does not have a strategy, because why is utility important? How are you going to find early projects? You know, is that the extent of your process? Like, is there no fundamental process for determining what coins are best? Do you have a strategy to know what price to buy at and what price to sell at? Do you have a strategy to know when to exit at the end of the bull market? He hasn't said anything about that, right? He wants to preserve capital for the bear market. He hasn't said how. And I told him to tell me that. So this guy doesn't have a plan, doesn't have a strategy, doesn't have an edge. There's no edge here. You know, when he says get into early coins, what he means is go to YouTube and Twitter, see what coins people are talking about, see when they came out, buy the ones that came out recently. That's his edge. That's not a fucking edge. This guy's an idiot. So what does this guy have to do instead? He has to either decide right now, does he want to, as a student, follow someone who is a pro so that he actually gets a proper plan and strategy? Or should he become a pro by working alongside a mentor and by understanding that he needs to get much more professional in the way that he approaches crypto? You can see how this is a failure of a plan. And if you're reading this, this is probably similar to what your plan is, right? If you're watching this, probably similar to something this guy's saying. I'm just going to get into early coins and new sectors and sell it at the end of the bull run. That's not how you make money. It doesn't work like that. Okay, let me show you one more. So IT worker has 18K. He wants to make 500K. So he wants to 25x his money or 27x his money, right? Which is a fucking crazy return. How is he going to do it? Well, he's going to buy small coins, memes. He's going to buy meme coins which can run. Do you guys see how retarded this strategy is? I really hope you can see why I'm saying what I'm saying. I really hope you can internalize the lesson here. This guy does not have a plan, right? I mean, I guess he has a plan, but it's a shit plan. He has no strategy, right? When are you going to sell? When are you going to buy? How do you determine what's the entry and exit price? What chains are you going to buy it on? What chains do you think are going to be the big ones? Is it Solana, Base? How many meme coins are you going to buy? How long are you going to hold for? What's your portfolio structuring, right? What's your risk management plan, right? What's your invalidation? What happens if the bull run isn't? What happens if the bull run's over, right? There's no fucking plan for anything. You know, there's no edge. What's his edge here, right? When people say find low cap gems, basically what he means is that, hey, Daniel, I saw that you made money on Toshi. It was a meme coin, and you're telling everyone that you need to find the meme coins of each chain. So I'm just going to buy the meme coins that you tell me to buy, right? Or what people say is the next big meme coin. That's what he's saying his strategy is, which is not going to work. Because why? Because it's not a strategy. It's not an edge. He's copying people from Twitter. Remember what Twitter is for. Twitter is for exit liquidity, not for alpha. And that's what this guy is going to be doing. Okay? So again, just to emphasize, you have 2 choices. You either follow a pro. So what this guy should do is say, hey, Daniel, I would like to have you tell me what strategy to follow. I would like to work closely alongside you because I really don't give a fuck about crypto. As you can see, I really haven't built a strategy and I work in IT. So all I want to do is focus on IT and then you tell me what to do. That's what he should have done. Or he should have gone, Daniel, you know, thank you for telling me that I'm an absolute amateur at crypto and that I need to become a professional. How can I learn more closely alongside you in order to become an independent, profitable investor with a real edge and strategy in the market? That's what he should have done. That's what he should do. And that's how he would get the results that he wants. Now, when I say, Daniel, how do I learn? Daniel, how do I follow you? I'm not saying that you have to follow me. You can pick any investor, anyone you want on the internet. I don't really care. You can pick any person that you would like to learn from that you think fits your vibe of what you would like to learn, what strategy you'd like to follow, what edge you'd like to implement. You don't have to follow me, but you're in this course, so I'm using me as an example. So if anyone watching this, I don't want to make this a big shill for my mastermind, but if you want to follow the pro or become the pro, my mastermind was designed for that. Okay, just to let you know. So I'll see you in the next video. Cheers.